highs for each of them. Now, let's take it to what you need to know in terms of just the cues over the last 24 hours or so. So oil's up another 5%, and we are now knocking at nearly $78 per barrel. And from, so oil was about 71 and something change before the attacks, the Iranian attacks over Israel, and we're at 78. That's a large step move that we've seen in oil in just 2 or 3 sessions. The worry, of course, still remains potential strikes on Iran's oil facilities. And, we were talking about this yesterday, that previous episodes have all seemed a little bit coordinated. This does not seem coordinated, and hence the risk of spiraling out of control. And of course, we'll talk more about this in a bit from now. And that's the worry. Now, equities, nothing very much. They mostly sat on their hands. S&P was flat. Nasdaq was flat. The data point was good. The ISM services data for the US came in at 50, almost 55. Expectation was about 52. It's the highest since February of 2023. Now, services is the larger part of the US economy, and it's also the more sticky part of the US economy. Remember, employment component did dip, but markets kind of paid attention to the rest of it, which was strong. Yields, as a consequence, rallied sharply, 7 basis points to about 3.85% on the 10-year. Dollar was also, as a result of the rally in yields, a global outperformer. We are back at just at about 102 levels on the dollar index. And of course, later today, we'll get the US jobs data for the month of September. And actually, it's a wide range of expectations, starting from 70,000 to 220,000. The median is about 143. And this is only important because, we got the first Fed cut of 50 basis points. Was that the deepest and the largest? And now we'll see 25? Or is there room for, what's the bar for another 50? I mean, I think that's essentially what markets would like to see. If it is closer to 70, which is the lower end, well, markets will quickly price in 50 for the next as well. If it is in line with expectations, as we've heard from various Fed officials, it's going to be 25 over the next many meetings. So let's circle back the levels here in terms of what you need to sort of put the back of your minds. We put out 2 levels yesterday, the 20 and the 40-day exponential moving average. The 20 got broken convincingly, and we left at the second support level, which is the 40-day exponential moving average, which is 25,222. We left 25 points above that level as of yesterday. So that is the first marker. I mean, it'll be great if you just kind of close around these levels, and we'll kick off and pick up next week on Monday. The hourly RSI, the relative strength index, is extremely oversold. And perhaps that means that in a day, 2 days, we perhaps should see a bit of a bounce. But if you get that bounce, this gap area, which is formed from the fall, which we saw yesterday, as compared to Tuesday's close, because Wednesday was a holiday, is the gap on your screen. 25,640 to 25,740. That's the gap area. That's the resistance zone for the Nifty to take out if you have to build and look ahead. Nifty Bank, similarly, has trendline support. That, by the way, broke the 20-day and the 40-day exponential. The trendline support is at about 51,585. We left off at 51,845, so less than 1% away. The 20 weekly moving average, by the way, below the trendline support is 51,344. These are all very near-term supports, well within just 1% from where we left off yesterday. So keep these in mind. And similarly, like the Nifty, for the Bank Nifty, the resistance zone is that gap area. And for the Nifty Bank, it is 52,582 to 52,817 up on your screen. I mean, lots of variables out there, which I think markets will watch. If yesterday, for example, we saw a very large FII sell number, and at the very near term, if it is to do with, China and outflows out of other markets to fund the China exposure, when China comes back next week, it'll be interesting to see whether they actually walk the talk, because it's all talk right now on the fiscal front, etc. Remember, Hang Seng, after 13 up days yesterday, was down 1.5%, and that's a China proxy. So we'll see. Lots of moving parts. GIFT Nifty is indicating about a 50-point lower start. Survi.
Okay, well, if we talk about markets in Asia, just like Wall Street, they're kind of biding time till there's more clarity on what's happening with both West Asia, the whole conflict, as well as, of course, the non-farm payrolls report. Let's just put up the Asian markets as we kick off. There's a little bit of gain on the Nikkei for the time being, and Hong Kong, let's see what Hong Kong is doing. It's actually managing about a 1% move up, so it's not too bad after yesterday's cool off. Taiwan somewhere in the middle. The market that's declining is actually Australia, which is down about 1%. So mixed cues across Asia coming through. Now, on this flare-up in oil, why did oil suddenly rally 5% overnight? Because, well, the US president moved the market. Reporters went up to him and asked about a potential Israeli strike on Iranian oil facilities. And I want to pull up the quote, so sort of we quote him verbatim. He says, and I quote, "We are discussing that. I think that would be a little anyway." So slightly cryptic, but he said that it was enough for the market to get very nervous about the possibility of the US backing any Israeli move against even oil infrastructure in Iran. So let's see how this plays out. Not sure if it was entirely intentional or inadvertent. Whatever it is, it moved the oil market in a big way, with Brent now closer to 78 than 70. Let's talk about just the non-farm payrolls number that we're going with. I mean, the mean expectation, like Prashant said, is around 150,000. The unemployment rate expectation is 4.2%. This would be a slight improvement from the previous month if we get numbers around this zone. Let's talk about the money moves, and that's what it's been all about, right? Aside of what's happening in West Asia, it's all about whether this is a bit of a sell India, buy China trade going on. And if money flow is anything to go by, you can't ignore the numbers, because yesterday in the cash market, we had selling worth over 15,000 crores from the domestic institutions. And kudos to the domestic institutions. They absorbed at least 12,000 crores of it. But even then, the market had to deal with what it did. If you put the last 3 days together, since the China stimulus really came through, the numbers are massive. 10,000 crores on the 30th of September. That's Monday. Then Tuesday was about 5,579. Wednesday, we had a holiday. Yesterday's number was this massive 15,000. So all put together, $3 billion of selling is what the market has had to deal with in the last couple of trading sessions. So let's see if there's any sort of relief from that, or how long does this tactical trade continue? And that's exactly what we'll ask a lot of our guests today on the show. Okay, let's talk about some of the other cues. The exchanges have spoken, at least one of them. That's the BSE. It is going to be discontinuing the Sensex 50 from the 14th of November and the BankX from the 18th of November. So those contracts go away. The Sensex 30 will, in all probability, be the one that they decide to continue. What will the NSE do? That guessing game is still very much on. We don't have the answers to that. Now, we'll talk about a lot of the business updates that are flowing in. Yesterday, Dabur was a big move in the market thanks to what they're indicating for Q2. Today, by the way, Avenue Supermart is not that bad. I mean, not that they're an exact proxy to each other. But if you talk about consumer demand, Avenue's numbers were fine. Let's look at a lot of the banks and the NBFCs. Just a quick sneak peek. Bank of Baroda's update is telling us that struggle is continuing. Look at the gap between the credit growth and the deposit growth. There is a gap. It's a big one at that. This is year on year that we're talking about. M&M Finance disbursements are actually down 1%. There's a small deterioration in asset quality. So we'll watch out for this stock. More commentary around this coming up. Bajaj Finance, the big headline number is still around the 30% mark. So the market will probably have a sigh of relief on that, 29% on assets under management. And finally, I'll watch out for the two-wheeler stocks, particularly the likes of even Bajaj and Ola Electric, because guess what? The festive season is on and big discounts are kicking in. Ola announced the Boss sale, the biggest Ola season sale, and discounts are going all the way up to 40,000 rupees on these EV two-wheelers. So is it just festive cheer? Or is it a sign of the major competitive intensity in the EV two-wheeler landscape? So I think some of the two-wheeler stocks will be interesting to watch. So plenty to keep us busy today, Rima.
Oh, indeed. And crude is the big story. And I was just reading that what if Iran's facilities are attacked? What is at risk? We're talking about 4% of the world's supply. So every day, Iran produces about 3.3 million barrels per day. So that's the amount which is at risk. But oil analysts are also quick to point out that OPEC has spare capacity. So OPEC today is producing 27 million barrels per day versus their theoretical capacity of 33 million barrels per day. So, that's the numbers when it comes to Iran and the impact on crude prices. The question is, does it engulf even the other areas like Saudi Arabia, etc., or is it going to be restricted to, Iran and Israel, etc.? But that's, another story. But for our markets, I think the big question is that from the highs, we've not lost too much, just about 1,000 points from the 27th September peak. Week to date, benchmark indices are down 3.5%, going up to 4% for some of them. So will we have a bounce from oversold regions? Or will the sell-off and the bloodbath continue? But let's get to some equity calls then. We've got Rhythm Desai of Morgan Stanley, who says the medium to long-term bull market is intact, but in the short term, the market has to digest rising issuances, policy shifts in the US and China, India's fiscal consolidation, state elections, and the frothiness in small and mid-cap. He thinks banks are the best way to play the next leg. He says they're overweight on financials, technology, consumer discretionary and industrial, and underweight the other sectors.
Okay, well, those are some views coming in. Let's get some more, right? I mean, and flows is the big talking point. So let's get Cameron Brandt in. He's Director of Research at EPFR Global. Cameron, good to have you with us here. Thank you very much. Lots of talk, discussion, chat about, of course, I mean, you know, the rally in China is so big in such a short time span. It's a literal shock. So there's a lot of FOMO, I guess, for people who want to chase that higher. And has that led to some serious selling just for 2 or 3 days, but big, large numbers in markets like India? Can you tell us anything if you've seen that in the flows?
I've certainly seen the flows shift to China at a spectacular level. Flows into both domestic and foreign domiciled China equity funds have soared over the past 2 weeks. And it really has, especially this past week in flow terms, been the only show in town. That said, even though flows into dedicated India funds this week were less than 1% of the flows we saw into dedicated China funds, they were still positive, which I would take from your perspective as a very good sign. Dedicated India funds have seen relentless inflows for well over a year. A lot of investors have built up a lot of exposure to a market that has risen sharply, but the money is still coming even when a very alluring alternative is on offer.
Cameron, hi, great to have you on the show. So what is the sense you're getting? I think the question that a lot of people in India are asking is how long will this continue? It's hard to guess, but this whole sell India, buy China tactically, or even send new money only to China and maybe not to other emerging markets like India. Do you see this trend lasting?
Well, I certainly see appetite for China going for a while. Chinese policymakers have made it very clear that they are paying attention to their equity market, and they want to see it on the rise. When Chinese policymakers say that at that level, it's likely to continue for a while. But as I just mentioned, even though flows to India funds have definitely waned, they haven't gone negative, and I think India remains in quite a healthy position. It looks to me, at least from this week, that investors were pulling money out of liquidity funds in Europe to fuel this rotation. And while that, money that might have flowed into India earlier this year clearly took a dog leg, it isn't as much of a straightforward India-China rotation as it might at first appear.
Cameron, is it possible to put some numbers when you say that India dedicated funds, money into the India dedicated funds has waned? What are the numbers that we're looking at, say, for the week gone by versus the prior weeks? And even for China, when it's gone up, what's the extent of the inflows?
So this week, the dedicated China funds we look at took in over $13 billion. A net 107 million flowed into dedicated India funds. But it was, I think, the 70th or 75th consecutive inflow into those dedicated India funds.
So just to get the numbers right, China saw $13 billion of inflows in the week gone by in the China dedicated fund, and India saw 106 million, which marks the 70th or 75th consecutive week of inflows. So there's still a surplus. So
it's still a surplus. It's definitely well below the average you were getting even a few months ago. For much of the second half of last year into this year, I would say the weekly average for dedicated India funds was around $400 to $500 million.
Cameron, so these dedicated funds, country-specific funds, are still very small. as a source of money into India. I mean, the last number that I looked at, it's largely emerging market funds, which are the route through which most foreign money comes into India. So could you tell us what's the number, latest number, compared to, say, the average? How much of EM funds taken in?
If you're talking about the diversified global emerging markets funds, they took in about 700 million this week, which is not a particularly eye-catching number, but it's definitely up on the trend towards outflows that we saw for much of the first half of the year. And within those GEM funds, India's allocation, while still not as high as China's, is at a record high. So when they do get money, they're shipping a solid amount of it onto India.
Okay, the money that's flowing into China, Cameron, this $13 billion that's floated in just the last week, is it flowing at the expense of any other market? Just to get a sense of how money is moving, or would it be sort of perhaps fresh money being put to work? Is it coming at the expense of the US or any other market?
Yeah. Well, I think if there's a market it's coming at the expense of, it's Europe. But at least this week, it's more either money being put to work or domestic money, Chinese domestic investors rotating out of other vehicles within their country and moving back to equities. So, if it continues to run, and I think it will run a bit longer, there probably will be some, selling of other markets to fund this trade. But at the moment, there's been enough in liquidity vehicles and enough coming into the market generally, I think, to mute the impact on markets outside of China.
Cameron, great conversation. Good to get those numbers in. Thank you very much for joining in. Enjoy your weekend. We have lots of stock-specific action to track today, and we'll get to it in just a bit in our special Top 10 segment. We're looking at Bajaj Housing Finance, Bank of Baroda, CESC, EPAC Durable, Ola Electric. These stocks could open up in the green, or at least the news flow is positive, while Bajaj Finance, Avenue Supermart, M&M Finance, Sundaram Clayton are stocks on our radar that are likely to open in the red, while crude users may also be negatively impacted.
Okay, well, let's tell you what's lined up here in terms of corporate interactions which are coming up. So we'll at 8:35 be speaking with Siddharth Kemka, Motilal Financial Services. At 9, we have Abneesh Roy of Nuvama Institutional Equities to discuss the FMCG sector after, of course, a Dabur shocker. Samir Arora of Helios will be with us, the market master, at 9:20. 9:30, we'll be speaking with Alexander Redmond, Chief Equity Strategist of CLSA, which is, of course, to talk about this India-China dynamic. Ramesh Swaminathan of Lupin will be with us at 9:40. Lots to talk about there. That's a big one. And Nilesh Gupta of Vijay Sales and Anand Agarwal of V-Mart will talk to us as we sort of kick off the festive season with Navratris. So that's lined up here. And of course, my colleague Latha will be speaking at 10:15. We'll be discussing the RBI action on the 9th of October with a whole host of experts. So that's coming up as well. So lots here. Stay with us.
Welcome back. Lots and lots of stocks in focus this Friday morning. So let's straight away get to it. Our team is standing by with the CNBC-TV18 list of top stocks to watch. Lots of business updates have been flowing through. So in fact, let's kick it off with exactly that. Abhishek is joining in to tell us more about names like, I think, Bank of Baroda, Bajaj Finance and many others. Abhishek, good morning.
Good morning. So to begin with, Bajaj Finance, the new loans are up 13.6% YOY and they have declined by more than 11% quarter-on-quarter. Now, quarter-on-quarter, it's seasonal in nature for them, with respect to new loans declining. Our customer base has grown by 20.3% YOY and 4.5% quarter-on-quarter. Now, the benchmark that they have set with respect to AUM growth, this 28.8% YOY looks to be the weakest growth in last 6 quarters, and 5.5% sequential growth looks to be the weakest in last 9 quarters. Deposits are up 20.5% YOY and 5.3% quarter-on-quarter. The cross-sell rate, now that's the lowest that you are seeing in Q2 of a fiscal X of the COVID time. So the cross-sell rate has declined to 6.2% versus 6.5% YOY and about 7.4% sequentially. With respect to Bajaj Housing Finance, they have given only 2 numbers. So loan assets is up 26.6% YOY and their AUM is up 26.3% YOY and about 5.5% sequentially. So the AUM growth remains strong for Bajaj Housing Finance. Back to you.
Thank you very much for that. Nomura says numbers are broadly in line. They will be watching the Q2 credit costs because, as Jeffries points out, the credit costs have risen for the last 3 quarters. So commentary on credit costs will be key for H2 and FY26. But Mangalam is now joining in to tell us about what Avenue Supermart did in the quarter gone by.
Well, it's a weak update coming in from DMart as well. Why do I say that? Because the revenue growth for the company on a standalone basis has been 14% in the second quarter. It's lower than the 18% that they reported in the first quarter. And more importantly, if you look at the 3-year CAGR, it's around 16.5% as well. So it's lower than that as well. Add to that, year-on-year store additions are 12.2%, which means that for a 14% revenue growth after a 12.2% store addition, it is weak same-store sales growth as well. For the quarter, they've added 6 stores. For the first half, that makes it 12 store additions. They usually guide for around 40 to 50 stores per year. That puts the onus on the second half for store additions. Currently, it's around 377 right now. The key to track would be how gross margins perform and how their quick commerce arm of DMart Ready performs as well. So I sense the stock would see a fair amount of selling today.
All right, Mangalam, thank you very much for that. Well, let's talk about Bank of Baroda and Mahindra Finances next. Abhishek is here with those. Abhishek, morning.
Morning, Prashant. To talk of Bank of Baroda, after the weak Q1 FY25 that we saw, they have bounced back strongly in Q2 FY25 with respect to their business momentum. Deposits are up 9% YOY and 4.3% sequentially. Domestic deposits are up 7% YOY but 4.1% sequentially. Advances growth is at 11.5% YOY but 6.7% quarter-on-quarter. So quarter-on-quarter, the 6.7% growth rate is one of the best that you are seeing in last 23 quarters for them. Domestic advances are 12.5% YOY and 6.5% sequentially. In this, the domestic retail loans that have grown by almost 20% YOY and about 4.5% sequentially. Now, M&M Finance, the disbursements are weak. They are down 1% YOY but up about 3.3% quarter-on-quarter. The total assets are up 20.3% YOY and about 6% sequentially. The collection efficiency has remained stagnant at about 96%. The gross NPA ratio has inched up to 3.8% versus 3.56% in the previous quarter, and they have inched up their liquidity in the balance sheet, which is now at 8,500 crore, up about 6.5% on a sequential basis. Back to you.
Okay, all right, got it. Thanks very much, Abhishek, for that. Let's move on to Vivek. He's, I think, tracking some developments with respect to renewable energy at CESC, and there is some news on Sundaram Clayton as well. Morning, Vivek. Tell us more.
Good morning, absolutely right. So CSC is the first stock on the radar. So the company's subsidiary has gone ahead and signed a binding term sheet to acquire a renewable energy company called Bajaj Renewable Energy. The acquisition value is at close to 108 crore and the deal is expected to be completed in 9 months. So what is Bajaj Energy? It was incorporated in 2024 to develop renewable energy assets. And what are the assets that they have? Basically, the company has land in place and also they have term sheets in place to go ahead and develop 150 megawatt of solar power projects as well as 300 megawatt of wind projects. So positive there as far as CSC is concerned. Now talking about Sundaram Clayton, again a fundraiser was over here, the company has launched a QIP to raise funds up to 400 crores. The indicative issue price for this particular fundraise is at 2,205 rupees a share, which implies a little over 6% discount to yesterday's close. Dilution at this particular rate is close to 9% of the total equity share capital. Why is the company raising funds? The company says they intend to go ahead and repay debt as well as for general corporate purposes.
Thank you very much for that. It's over to Vinny now for the latest on EPAC Durable and Ola Electric.
Good morning. So yes, keeping an eye out on EPAC Durable because they've entered into an exciting tie-up for manufacturing for Panasonic Life Solutions. They will be manufacturing PCBA controllers as an EMS provider as well as high-tech critical components from room air conditioners. Normally, they used to be manufacturing these PCBA controllers only for their captive use. So now this is a good entry and foray that marks for the company as an EMS provider as well as an opportunity that opens up for the company in terms of growth avenues and market leadership is what something that they could be watching out for, especially manufacturing for Panasonic. So expecting a green for EPAC Durables. Even Ola Electric, we're expecting a bit of a positive up move there. We've spoken about those two-wheeler discounts coming in during festive season. Now Ola announced and launched its Boss discounting. That's the biggest Ola season sale. This is a campaign for festive season and the company has announced the entry into S1 portfolio for as low as 49,999 rupees. There are a lot of other festive benefits that they will be giving in as well. So keeping an eye out on Ola Electric.
All right, Vinny, thank you very much for that. So that's discounting, which will be in focus as well. Well, let's talk about oil prices, and Manisha is here with what's latest. Manisha, good morning.
Morning, and thank you for that, Prashant. Well, 5% of gains in the crude prices overnight, and we are trading at a one-month high. With that, this is the highest weekly gain that you've seen in perhaps 18 months come in for the crude oil prices. You know, it was a decline of 9% for the month of September, but in the month of October, the crude oil prices have gained up by 9% exact. And with the kind of news that you're getting in from Middle East, perhaps further gains are not ruled out before you see the end of this week. In other commodities, well, because of the dollar index surging to a 6-week high, the service sector data came in better from US. So did the labor numbers as well. That has weighed on in case of metals there. So copper prices fell 2% overnight. Aluminum has come off its 4-month highs. There is some pressure that we've seen come in for gold as well. That one has been trading off its highs for all of this week as well. We haven't seen a new all-time high in gold in this week. So that really has been a difference that we've seen in all of last quarter as well. The markets will watch out for the US non-farm payroll data. That will set the course for further move in many of these commodities.
Okay, all right, absolutely. Commodities on the radar, Manisha. Thank you very much for that. With that, let's quickly recap our list of stocks to watch today. The ones that have positive news flow around them include Bajaj Housing Finance, Bank of Baroda, CESC, EPAC Durable, and Ola Electric. While stocks with negative news flow are Bajaj Finance, Avenue Supermarts, M&M Finance, and Sundaram Clayton. Crude users may be negatively impacted, of course, considering the 5% surge that we saw overnight in prices. We'll take a quick break on that note. Coming up on the other side, we connect with Siddharth Khemka of Motilal Oswal Financial Services for some fundamental stock analysis.
And I did not underestimate Senator Vance as a slick talker. He could. But I also called out there, you can't rewrite history. You can't rewrite history. And trying to mislead us about Donald Trump's record, that's gaslighting. That's gaslighting. The moment that really stuck out is I just asked the simplest of all questions that every single American should be able to answer. I asked him if Donald Trump lost the 2020 election. He refused to answer.
Good morning. You're watching Bazaar Morning Call. We're in conversation now with Siddharth Khemka, Head of Research at BND at Motilal Oswal Financial Services. Siddharth, thank you very much for joining in. Wanted to get your thoughts in on what Dabur had to say. Dabur is talking about a revenue decline in its quarterly update for the first time in 4 years. And the street is clearly worried that it may not be limited to just Dabur. So in your channel checks going into the Q2 earnings season, what have you picked up in terms of consumer demand?
Yeah, hi, good morning. So I think, yes, it's definitely a cause of concern, especially if you look at on the urban side, what is happening. So consumer staples demand, our channel check suggests that demand has been relatively stable in Q2 on a Q-on-Q basis, with the rural markets outperforming the urban areas for the third consecutive quarter. However, we have seen that some of the issues, for example, heavy rains and floods in certain regions have disrupted the supply chain and also affected the out-of-home consumption and hence the overall consumer offtake. In terms of, if you look at the raw material prices, that has kind of remained a little bit on the softer side, and hence there is expectation of some gross margin expansion in Q2, and hence some of the other segments apart from, say, in the overall consumer staples, we believe things could see a little better, and hence while Dabur has definitely kind of given an outlook of a weak quarter for the year, we believe some of the other names, for example, HUL, Britannia, Marico, their numbers could be slightly better than Dabur, and especially if you look at on the non-agri commodities such as crudes and its derivatives, that have kind of remained soft, and that should benefit companies in this space like soaps, detergents, paints, adhesives. So it's a kind of a mixed bag in all, if you would like to say. And within that space, what we like is like a kind of a Britannia, Colgate, Marico. These are companies which could come out with good numbers. HUL with a wide product basket and presence across segments should help the company achieve a steady growth. GCPL is our top pick in the space. Its focus on the non-agro commodities, for example. It's a large player in the soap segment where we believe margins would kind of improve and demand from the rural to pick up. So that's a kind of outlook that we are looking at within the overall consumer space.
Okay, so yeah, consumer, I mean, it triggered quite a bit of a debate, right, with the update that we got from Dabur. But just to press on that point, Siddharth, hi, morning and happy Friday to you. We've got the update from Avenue Supermart, and depends on how you want to slice and dice it, because Mangalam was telling us that maybe the market won't take that too well as well, looking at same-store sales, etc. So I don't know, if you got a chance to look at the numbers, what do you think?
Yeah, I think, yes, morning, Surabhi. So revenue growth definitely moderated. It is at to 14%, which is a 4% miss to our expectations. Revenue growth moderation, we believe, is largely due to the lower store addition in the past few quarters and the weak store productivity. We believe that the preference for convenience, that is your rapid adoption of quick commerce over value, would have contributed to the growth moderation for DMart, where DMart is clearly absent and is looking to increase its presence through the delivery channels, which is now we are seeing where a lot of growth is happening. So definitely some weakness in the numbers which the market may not like. But the overall, if you see the growth trend, that is pretty steady. So today the reaction could be negative. Productivity has also kind of been weak. For example, revenue per store at 1.5 billion rupees is up only 1% on a Y-on-Y basis compared to 4 to 7% growth that we have seen in the last 5 to 6 quarters. So to overall, the store addition also remains soft. For Q2, the store number of stores added was about 6 stores, taking the total store count to 377. For the full year, we have an assumption of about 40 store addition. So definitely in Q2, the run rate in store addition was much lower than our expectations.
And what about Bajaj Finance? How would you read the Q2 update? AUM growth of 29%. It's slightly lower than the growth that we've seen in the last couple of quarters. And it's also uncertain on what the credit quality is going to look like, the credit costs. So thoughts on Bajaj Finance?
Yeah, Rima, I think Bajaj comparatively managed to give a better numbers. Yes, slightly lower than what we would have expected, but at an AUM growth of 29%, and nonetheless, in this environment is pretty good. So we believe that this growth might kind of enthusiast the market. A new client addition was healthy. This was the first normal quarter for the company with both the e-com and the Insta EMI card products available for the company compared to the previous 3 quarters where the RBI ban was there. New loans booked grew about 14%. And as I said, AUM growth was broadly in line with the expectation with up 29%. Yes, some concerns, especially if you look at on the credit side where the retail credit costs have gone up in the recent past, and that could be something that we'll get to know only after the quarterly results. But I think overall, we believe that the numbers are quite good in this environment. We had seen softer quarters in the previous few, softer numbers in the previous few quarters. And with a 29% AUM growth, things looks much better for Bajaj Finance from here on.
All right, well, that is the view coming in on Bajaj Finance and financials. Sid, stay with us. We want to play out some more sound bites. With regards to the market fall that we saw yesterday, it was big and brutal. We had Harish Krishnan join us after market close at 3:30. He's the co-CIO and head of equity at Aditya Birla Sun Life Mutual Fund. And we spoke to him about, of course, this the big dominating driver for the sell-off that we saw yesterday. And of course, we kind of rounded it up with some of the themes that he'd still be comfortable betting on from a 2 to 3 year perspective. Listen in.
Over the course of the last 2 quarters now, earnings have actually not gone anywhere for the broader markets in aggregate, even as markets have continued to climb up despite a poor election result, despite the capital gains tax and poor earnings print. So I guess it is some amount of normalization is what one is seeing. The second, as you rightly pointed out, is the function of what's happening in China. Year to date now, China outperforms the US, India in a surprising turn of events, right? 2 weeks ago, they were at 52-week lows. Come this week, they are at a massive 52-week high, outperforming almost all other markets. And this was a consensus sell given various geopolitical measures and going into the US elections. And therefore, I guess some of the flow data that you spoke about, I think a lot of that has also got to do with the fact that there is some amount of serious money that is possibly going now towards China in the wake of a significant short squeeze that we've seen in Chinese market. So I think India is a low beta defensive market in the emerging markets. It typically does well when emerging markets flounder. It's like the FMCG of the emerging markets. So we think that there are 3 dark horse sectors out here from a 2-3 year point of view that we want to further add on to our positions. First is consumer durables. That's a space that we think has done quite well, but we think that there is more margin pickup story out there as a segment as a whole. Second is metals. I think we've come to a zone wherein the metal stocks have delivered quite well. The balance sheets are in very good shape. And I mean, of course, there is the Chinese stimulus angle, but even otherwise, I think that metal stocks are something where ownership levels are very low, and we would want to add on to that. The third is cement. This is a space where near-term earnings can look potentially disastrous, but this is a space where there is massive amount of consolidation happening. Again, a space where ownership levels are low, and that is something that we want to pick up into. On the sectors which were in momentum or which are in momentum and which can continue and where we want to add on and buy on dips, I would say IT would be high up on that list. We also think pharma is an area where we want to add on dips. Third would be capital goods. Fourth would be auto, and real estate selectively we would be looking at buying on dips. So these are the broad sectoral, sectors, kind of a footprint that we would want to buy on dips into this fall in anticipation of creating greater value to our unit holders.
Okay, that's really the question, right? What do you buy when you get the chance? The buy on dips question that we put to Harish Krishnan yesterday. Let's ask Siddharth exactly the same thing. Siddharth, Harish was talking about sectors when he can't talk individual companies and stocks. Will you tell us stocks? One or two good names to pick as the dust settles on China, Middle East, crude oil, all of that. But fundamental picks right now in this market.
Yeah, so if you look at some of the sectors that we believe could do well, IT is one of them where the green shoots are seeing visible with the growth coming back with the Fed rate cut starting and consumption discretionary spending on the rise. So we believe that Q2 revenue growth for IT sectors could be decent. Client spending behavior is showing positive trends indicating potential return of modernization, especially in the discretionary spending in some of the pockets. And among the tier one players, we believe HCL Tech can be a better pick given its strong capabilities in data engineering, ERD offerings, the ERP modernization, as well as making it well suited for the pre-Gen AI spending. So we expect HCL Tech to see a broad-based growth across verticals as well as geographies. There could be some pockets like BFSI where the growth could remain soft. But overall, we expect a good growth. Margins are likely to see a 30 basis points Q-on-Q improvement. And we expect the company to maintain its growth guidance about 3 to 5%. So we like HCL Tech between the tier one IT companies. We have a buy rating and a target price of 2,200. So that's a space clearly that looks kind of pretty good in the current environment.
All right, Sid, stay with us and we'll come back to you. We'll discuss more. There's the HDFC Bank numbers, which Abhishek will join us to shed more light on. And we'll take that break also. 15 minutes to go for the market open, the pre-open that is. Prakash Gaba and Shrikant Chauhan will join in for some technical trading ideas. Stay with us.
Two 6-week periods during which the inflation rate has fallen, that can give a lead to cut the repo rate. Choice is between 25 basis points and 50 basis points. If you want to be cautious, we can cut 25 and store something for the next time. Or we can take front-loaded cut of deeper thing. there are two ways of creating competition in the system. One is really letting new private sector banks to come in. The other is privatize some of the nationalized banks or increase the private content in the national. We have now reached a stage in which we should really be able to get more banks in the private sector. So I would really say that let an atmosphere and environment be created where new private entities can enter.
The regulations are out. As we said, they were likely to come out today or tomorrow, and they're finally out. And I have to say, they're largely in line with expectations. So in July, SEBI had proposed 7 things. 6 out of the 7 actually have been implemented with very minor changes. So I'll start with what is going to be.
Welcome back. After a 2% fall in the benchmark indices, that we had yesterday, the GIFT Nifty will come up for you on your screen. Most of Asia has actually opened up in the green, and it's trading in the green right now. So Hang Seng has now pushed its upward move to a 2% gain. Kospi Nikkei up nearly about 0.5%. The GIFT Nifty is currently down close to about 50 points. If it opens in the red, it would be the 5th consecutive day of losses for the benchmark indices. Prakash Gaba and Shrikant Chauhan are now joining us on the show now. Gentlemen, morning, and thank you for joining in. Prakash, do you think markets are a bit oversold, or do you think they could extend on the way down? What would be the Nifty trade?
Good morning to you, and good morning to you as well. Nifty, when you look at the indicators, yes, it is oversold. Can it go down? Yes, it can go down. Just because it's oversold does not mean it cannot go down. Structurally, when I see something, I see gaps. Gaps are a sign of weakness, and we saw a gap on the way down. Now, Nifty is trading somewhere close to 25,266, which is not a very strong support zone. It can still slide down. And the next logical technical target on the downside is closer to in the vicinity of 25,000. So it can go to 25,000. It can stall there. It can see a bounce there. But I will still doubt the bounce unless see some strength. So far, it looks weak to me as far as Nifty is concerned. 25,000 is possible. But when I look at the Bank Nifty, exactly similar is the case, trading somewhere closer to 51,900. But I think still weak. There's a gap on the way down, so downside should continue. The next logical technical target should be in the vicinity of 51,000. Perhaps we could see some kind of stalling there. The downside could stop there. That's what I see. But looks weak to me.
So, Prakash and Shrikant, morning. Prakash, so you wouldn't want to do anything today? I mean, no trades on the indices?
No trade on the indices, because unless I see some strength, I'm not buying it at all. I could buy somewhere closer to the supports if I see some strength there. Until that happens, stay out or wait for around 75 minutes and then take a call, mark your points and trade points accordingly. But wait for around 75 minutes at least. Stocks, I like 2. The first stock that I like is Colgate. It's a very defensive bet. Missiles could fly anywhere, doesn't matter. I'm going to still use Colgate, not using Datun. So it's a safe stock, more of defensive bet. Colgate is trading at 3839. I would have a stop somewhere closer to 3,800 or 3,750 and play it long for a couple of days. We could see levels closer to 3,900 first and then perhaps 4,000. So Colgate is a safe bet, 1. Second is Jindal Steel. Again, buy. Seen an up move. Kind of a consolidation for around 2 weeks in the sideways zone. Yesterday in the down market, it was up, trading at 1,048. Would have a stop below 1,020, somewhere closer to around 28 rupees or so. Upside to 1,100 is possible in Jindal Steel. So yes, 2 stocks, Colgate and Jindal Steel.
Shrikant is also with us. Shrikant, would you have an index trade or is it an avoid?
Yeah, good morning, Riva. Good morning, Prashant. I think, see, for Nifty, yes, it is down. It is completely oversold. But at the same time, 50-day simple moving average acted as major support whenever there is a panic sort of situation in the market. This time also, there is like pressure and we are already down by almost 1,000 points from the highs. So close to 25,000 levels or 25,050 levels. If we see any reversal formation, then there we should look for taking some long bets in the markets. But yes, at current levels, it is better to stay away because the pressure is still on and we are in between. So close to 25,100, 25,000 levels. There we can take some contra bets. For Bank Nifty, there also we are seeing weakness because it comfortably closed below the mark of 52,000, which is something negative. So based on that, the next level to watch out for would be maybe 51,300 to 51,000. So around those levels, and these are the corresponding levels to the levels of 25,000 on Nifty. So I think around those levels, we are seeing some buying interest in the market. And if there is any pullback because of any reason, then close to 25,500, we should look for reducing some long bets.
Hi, Shrikant. Morning to you and to Prakash. What about the stock picks? Shrikant, what's your list looking like today?
Good morning, good morning, Subhi. I think, see, like from the specific stocks on the stock side, we like ONGC. The reason is because the crude is consistently moving upward, and if we consider and if we go through with the chart of Brent crude, then it is clearly indicating us that we are going to see further more gains. Maybe it could be somewhere close to $80 to $83 per barrel. So if that is like that holds true, then ONGC can do much better from here because the overall trend for the stock is stronger. It was down mainly because of downward weakness in the crude prices, but now again the stock can move up to the levels of maybe 315 or 316. So at this level, ONGC is a buy with a stop loss close to 280 on the downside. And the other stock on which we are bearish is Ashok Leyland. The stock, after very long time, closed below the 200-day simple moving average, which is indicating us that the stock can fall to the next levels of maybe 220 or 215. So at this level, Ashok Leyland is also a sell with a stop loss close to 236.
Okay. We've got Soni Patnaik of JM Financial Services also joining in to lay out the F&O setup for us. Soni.
Hey, good morning, Reema, Surbi, Prashant. Thank you so much for having me on your show. I think Nifty can slide down to 25,000, which is its next crucial support. And on the upside, there's a strong resistance forming around 25,450 to 25,500 odd levels. So at this level, it is wise to go with a hedge strategy where you see a buy and a sell idea. The first buy idea comes in from the pharma space, which is a bit defensive right now. And the stock is Dr. Lalpath Labs. So we've seen it adding up good long built up positions on day-to-day basis. And it has been sustaining above its 3,400 option chain breakout level. So one can buy Lalpath Lab in futures and in spot level as well. Keep a stop loss of 33.40 in spot level. Look for higher targets of 3,500 to 3,550. The second idea would be a sell idea in United Spirits, which has seen a breakdown below 1,600 levels. So it's an option chain breakout. So one can sell United Spirits in futures up to levels of 1,570, 1,575. Keep a stop loss of 1,600 and look for lower targets of 1,520 to 1,500.
Okay. All right. Thank you very much for joining in, and wish you a good trading day, Soni. Take a break on that note, come back on the other side. We'll have the pre-open rates, and we'll also connect with Abanish Roy of Nuvama Institutional Equities. The Dabur fall and the issue that Dabur flagged off with respect to inventory, is that a one-off or does it signal a wider trend? We get chatting with Abanish in just a bit.
Number one, higher lot size value. This is going to be effective from the 20th of November. Basically, for index derivatives, which is Nifty, Bank Nifty, and other index derivatives, at the time of introduction, the SEBI is saying that the contract value should be between 15 and 20 lakhs at the time of introduction. At least 15 and up to 20. That is number one. This is a simple and clean measure to limit the number of people who are able to trade this trade index derivatives. Number two, and I think a lot of interest around this, only one weekly option contract per exchange. This is also effective from the 20th of November. Remember, right now, NSE has weekly contracts, weekly option contracts on the Nifty, the Bank Nifty, the Mid-Cap Index, and the Fin Nifty as well. BSE right now offers weekly contracts on the Sensex and the BankX. NSE now will have to choose one. They'll have to drop three, only one, and that too a benchmark contract. So most likely they'll have to decide whether to keep a Nifty weekly option contract or a Bank Nifty weekly option contract. Similarly, the BSE will have to choose between the Sensex and the BankX. The benchmark is the Sensex, so most likely BSE will offer the Sensex weekly option contract. So I think this is the one which I think is going to dominate headlines and market participants, most impacted exchanges, brokers, everybody most impacted from this one. Number three, intraday positioning, monitoring of position limits. This is effective from the 1st of April 2025. Currently, position limits are monitored on an end-of-day basis. Now, this is to be done on an intraday basis. Remember, the limit which was set, I think in 2020 during COVID period, was 500 crores based on notional.
Welcome back. Well, 17 minutes to go before the action kicks off, and in a bit we'll get our pre-open rates as well. Siddharth Khemka has been with us. Siddharth, we've discussed, of course, Bajaj Finance, but a whole host of other NBFC and bank updates have come through, right? What is the sense you get in terms of this whole fight for deposits, what NIMs may move, how NIMs may move? And for some of the smaller lenders, like I was looking at Suryodaya Small Finance Bank, I mean, there the pain and pressure on the microfinance side is really showing up. So what are your top picks and what would you avoid this season in BFSI?
Yeah, Surbi. So I think overall, if you look at from the financials perspective, earnings growth are likely to be modest, while the asset quality trend could be divergent. What we are expecting is the system credit growth at about 12.5%, while deposit growth could be better at about 12%. And what we have seen that the deposit growth could be in this range of 11 to 13%, and that has been the range in the past 14 months. So what is happening is that asset quality for the large private banks as well as for the PSUs, that remains stable. However, for the MFA, the microfinance as well as the unsecured loans, they are experiencing rising stress. And some of these small finance bank, as you highlighted, they are more on the MFIs and the high risk segments, which are experiencing more increasing asset quality stress and leading to higher credit costs. Within the private banks, what we are seeing is a steady growth. We are expecting pre-provisioning operating profit growth of about 12%, NII growth of about 11%. As I said, for the private bank, slippages would largely remain under control. Similar is the story with a lot of these private public sector banks, where we are expecting a steady quarter. But small finance bank, there could be mixed performance. Some of the microfinance facing companies are experiencing higher elevated credit costs and slippages. So overall, our top picks within the space, in the private banking space, ICICI, which has been a consistent performer aided by strong growth and profitability in the past. We have seen that slippages has been under control, and the bank has outpaced the system credit growth, driven by good growth in the retail, SME, as well as some of the other segments. And overall, the return ratios are pretty strong. ROAs of 2.2%, ROEs of 17%, and valuations, although a bit on the higher side, we believe that with the strong performance and leadership in the current market, it could continue to trade at the premium valuation. So clearly, ICICI Bank is something that we like within the banking space.
Got it. Okay, so that remains one of your preferred picks. Good talking to you this morning, Siddhartha. Thanks for joining in. Have a good day, and we'll look forward to connecting again. Okay, now it's time to put the spotlight on the FMCG space, and in specific, Dabur, and what Dabur's Q2 update really tells us. Let's get the numbers back in and actually the commentary as well. We have Abneesh Roy joining in. He's, of course, Executive Director at Nuvama Institutional Equities. Avnish, hi, morning. Thanks for taking the call. And we're going to flash the Dabur commentary as we start the call. Now, what did Dabur say? Dabur is saying that sales are going to drop by mid-single digits. And they, I think, flagged off two issues. One is monsoon, so the beverage uptake was not as much as they would have liked. The second is this issue of inventory. They're saying that general trade got hit because of higher demand from quick commerce. And I think some inventory sort of management going on over there. What did you make of it? And the question is this just an inventory-specific, beverage-specific issue for Dabur? Or does it signal a wider concern for the rest of the sector and the rural recovery?
Sure, thanks. So first is we don't see this across the sector. So this is more specific to Dabur. In fact, we had highlighted last week itself that beverages will see a weak quarter, and that's why even Varun Beverages, we expect India volume growth to be only 5%. And even for Tata Consumer, Narishco will be soft quarter. And even for United Breweries, we expect 6% volume growth. So this was a result of very high rain. So we saw 8% higher than normal. So out-of-home travel was also difficult. And clearly the temperature was colder. Now coming to Dabur, I think apart from the beverages being slower in both Q1 and Q2, due to which the inventory got built up. And that's why there was a mismatch between the primary and secondary. They had to take this correction. Now in FMCG, pipeline correction is not something which is rare. It keeps happening. But the extent which Dabur took was very surprising. My sense is Dabur's forecasting across categories in terms of sales and demand, I think that needs to see some improvement. And we need to see consistency in terms of growth coming back from Q3 and Q4. Then the stock will re-rate. So we have seen 4 business updates in the consumer, 2 retail and 2 FMCG. So I can see 2-3 themes there. One is in urban demand, there is some level of slowdown. So what Dabur has highlighted also is that quick commerce is taking share from the general trade. But my sense is because of high food inflation in the perishables, vegetables, etc., and the telecom hike, urban demand, there is some level of slowdown, and it is slower than the rural demand for most FMCG categories. Rural, there is some improvement. So that's why if you see Marico reported 5% volume growth, we expect Godrej also to see.
Abanish, sorry, I'm apologies for interjecting. Just to make it very clear, one step at a time. First of all, the inventory issue and the softness, is that a Dabur specific issue? Yes, no, or is it a hazy answer?
Yes, it's a Dabur specific issue. So you will see a slight impact, say, on the other beverage companies, but this is more a Dabur issue. And that's why if you see Godrej Consumer, which is also in FMCG, we expect 6 to 7% volume growth, HUL 5%. Britannia, for example, we expect high single to double-digit kind of volume growth. Bikaji, again, double-digit volume growth. So all are in the broader FMCG. So this is more of a Dabur-specific problem.
But you're highlighting at the same time, while this is a Dabur-specific issue and others will probably have a decent Q2 growth, but at the same time, you're also saying that there is some slowdown in maybe in urban demand. That's the point you're making?
Yes, in urban, we are saying that in FMCG, there is some level of slowdown, which could be because of very high vegetable costs, say, in Q2 and the telecom hikes. In rural also, if you see telecom hikes are there, but for them, the perishable vegetable cost is not that relevant because locally produced. Plus the freebies given by the local state government and the central government, they are more than overcoming any impact of the telecom hikes. So rural, there is a recovery.
You know, before we get to Avenue Supermarts and what you made of the Q2 update there, just to complete the point about Dabur, how is QSR hurting general trade? Do we have any kind of anecdotal evidence? Because QSR spends are on the rise. So, you know, what are your channel checks suggesting and how much of a concern is this going forward?
I think your question is on quick commerce. Yes.
Quick commerce, yes.
Yes. So there is an impact of quick commerce definitely on the general trade. And companies are taking proactive steps to harmonize both. I think the quick commerce and the e-commerce and modern trade will keep gaining market share from the general trade. In fact, in big cities, now it should be bigger than general trade in many cities. So clearly, consumer is going towards convenience, and definitely companies also have to harmonize. That's why I don't think this is across sector problem which Dabur has faced. And this keeps happening generally when there is back-to-back 2 quarters of beverage slowdown. So they built up a lot of inventory and then they try to meet up the volume demand through other categories. That did not happen because every category there is competition. Again, in same quarter, Colgate we expect, for example, 7-8% volume growth. So it is not across the thing, but definitely general trade there is some level of slowdown, and my sense is some part of it is market share loss to quick commerce.
Okay, and what about Avenue Supermarts? You're not very convinced about the like-to-like growth seen. Lay out your analysis.
Yes, definitely. We expect Avenue Supermart stock to be soft in the near term. There was a miss of around 3 to 4% on most of the metrics. If you see sales growth of 14% versus previous quarters run rate more like 18-19%, there was a 4% kind of a miss. And when we do the maths in terms of sales per square feet and sales per store, because these are the metrics which are available, again we see that sales per square feet was only 1% in terms of productivity improvement, versus earlier quarter it was more like 4-5%. And similarly, in terms of sales per store, it was 3-4% lower. In terms of store addition for Avenue Supermart, I am not unduly worried. It is generally back-ended and they will get it right in Q4. But in terms of why this miss happened, this could be because there is some level of urban slowdown, and definitely quick commerce, Swiggy, Zomato, Zepto, etc. are expanding to more cities. They are more aggressive. So it could be that. It could be a mix of both.
Abneesh, just stay with us. I'm going to ask you about your sort of top ideas here as well. But let's just rewind the clock back and look at what happened yesterday, right? I mean, so that's also the big one, which is the flows picture, the big selling that we saw. Hormuz has put together some data. Hormuz, take it away.
One of the biggest factors for the sell-off that we saw on Thursday was this relentless selling that is coming in from the FIIs over the last 3 sessions, almost $3 billion, and almost $2 billion of that came in yesterday's trading session. 15,243 crore in the cash market is where the FII selling figure was, but almost all of it was concentrated into 5 large cap names, and the index heavyweights dominate that. Look at Reliance Industries, HDFC Bank, ICICI, Axis, Tata Motors, all of them cornering a large share of that focused FII selling that we saw in yesterday's trading session. Now, yesterday's selling was also the highest that you have seen from foreign institutions in the last 4 years. That is almost dating back to the COVID period is where you have seen this kind of selling from the FIIs. And if you could look at the data as well from this year, where you have seen the first 2 figures coming from January this year, which is right before the budget, on the 4th of June, of course, which was the day of the Lok Sabha election results, and of course then towards the end of September, which is when the downfall actually started after the markets had made new highs. Now, where has this, but most of this selling is attributed to money moving out of India and going into China, but not everybody is convinced of this China rally, and Rajiv Jain of GQG is one of those, and he mentioned this, and he's been underweight on his funds in the Chinese markets, and he's mentioned this, that how many times in the last 3 years he's seen this excitement only to dissipate going forward. He calls this a trade, a very good trade, but if he says that if this party goes on without them, they're fine with that, but it's a trade and there's nothing more. Is this really that something can be invested in the next 3 to 5 years? But Citi has come out with a view. They're saying that this Chinese outperformance, this CSI 300 up almost 24% in the last 1 week, supportive policy announcements, and this rally has led to the Chinese markets catching up with the Indian markets over in terms of share, in terms of returns. And they also say that strong macro growth and outlook is going to be supportive for, and resilient domestic inflows will keep the Indian equity supportive as well. And Gavinkel Research has also come out with a view. They're saying that even if China continues to sustain its rally, they're saying that many foreign investors continue to remain reluctant to invest there, and the headwinds that China is facing will become a tailwind for the Indian markets. And the last caveat that they add is, while foreign investors can definitely find value in other emerging markets, it is too early to call time on India's bull market.
All right, Hormuz, thanks very much. And of course, as they say, the OG, Stanley Druckenmiller, speaking at a conference, this is day before yesterday, also essentially said that when asked a question, I mean, it's also about what they're asked, right? And they respond. Essentially said that as long as President Xi in China is there, he's going to stay out. So in that sense, echoing what Rajiv Jain of GQG said, happy to miss out. There are enough other opportunities. You can't be everywhere you cannot be, and perhaps should not be as well. So those are some views coming in. But that FI number also, the past large episodic outflows, as Hormuz pointed out, it's very large yesterday. but we've had these before as well a few times this year. Abnish is with us. Abnish, thanks for waiting. So let's just zoom back on and since we're talking about China, somebody was talking about, say, for example, a company like Mayotan is trading at. Valuations, market cap, and then you were looking at what Zomato here is trading at. So all kinds of things in the mix, just in terms of conversation. But of course, what we can do and our investors can do is take a call or not, whether they should buy names like Zomato and others. But what are your top ideas, top picks, Abnish, from here on in the space?
Sure. So we remain positive on FMCG. Next 4-5 years, there is a coalition government at the center. There is competitive politics, populism at the states. We have seen freebies definitely increase. Good monsoons. So we are preferring companies which have higher exposure to rural. So currently we like Colgate, we like HUL, we like Bikaji, Britannia and Imami. Those 4-5 names will be the top ones in the staples. From a Q2 perspective, we'll be underweight on the Asian Paints and Berger Paints. Again, because of very high rains, the exterior paint demand has been impacted and there is a down trading. And the stocks had run up quite strongly because of the lack of success of the new players and crude oil correction. Some bit is now reversing there. Nestle also, again, more urban focused, so we'll be a bit cautious there in the near term. So the top buys will be essentially rural-focused companies. In the apparel, again, value apparel. So Trent and V-Mart will be the top buys.
Okay, thank you, Abnish, for joining in. One stock of the day is going to be HDFC Bank. Just came out with their Q2 update. Abhishek joins in with the key highlights. Abhishek.
Well, the entire focus of HDFC Bank is on deposit mobilization, and if you take a look, that has been pretty strong for them. And their also focus is on reduction of credit deposit ratio, and that's also seen in the results, which is the prelims that have come in with respect to business updates. So deposits are up 15% YOY, but more than 5% on a sequential basis. The CASA is up 8% YOY and about 2.3% sequentially. However, due to higher non-CASA growth in terms of deposits, the CASA ratio has declined to 35.3% versus 37.6% on a YOY basis and about 36.3% on a sequential basis. So the time deposits or term deposits is up 19.3% YOY and about 6.7% sequentially. Now the advances growth have been tepid, and we have been seeing them selling their loan book sell down has been happening. So that advances growth is at 7% YOY and about 1.3% sequentially. AUM growth is at 8% YOY and about 2.3% sequentially. The entire focus looks to me on credit deposit ratio, which has declined sharply to 100.8% versus 108.4% in the same quarter last year and about 104.5% in the previous quarter. Even the liquidity coverage ratio, that's improved to 127% versus 123% in the previous quarter. Back to you.
These are decent and good set of ratios, especially the CD ratio coming back to more reasonable levels now. Abhishek, thank you very much for that. I think we are just hitting market open and we'll have the values coming up in terms of first rates in a bit from now. Lots to track. The market itself, the pre-open is left about 70 points lower, so 25,000, just under 25,200. And I think about 5 days back we were at 26,200. So that's how quickly markets, of course, move nowadays. Just a few seconds and we'll just read out the indices and then we'll do stocks. What do we have? First rates, 25,211. It's a flattish start, 0.15 lower. The Nifty Bank is down about 0.25% and nothing. I think the Nifty is now turning into the green. Let's see. Bank Nifty 51,865 is where the Nifty Bank is at. The mid-cap index is absolutely flat, nothing, no change. So 58,964 in the mid-cap index at this point. The IT index, which of course will be first off the block in terms of reporting earnings with TCS next Thursday, the IT index is up 0.5%, 41,980 or so on that one. So that is a heavyweight. The Nifty heat map is coming up on your screen. I think it's more down than up, but this is the first 1 minute or so of trade. Market on the Nifty is already up about 30 points. Which is a little better than how the absolute first rates that we got. So 25,270-ish on the Nifty. Surbi.
Now, the interesting rates are on companies that have come out with their quarterly updates. Watch out for Mahindra and Mahindra Financial. The market does not like any hint of deterioration in asset quality, which is exactly what M&M Financial has reported. Stocks down 4%, and Avenue Supermarts also down about 2.5%. So we'll sort of talk more about these updates and the impact. On the large cap screen, actually, speaking of updates, why I forget Bajaj Finance. Even here, despite that 29% AUM growth, the stock is under pressure, 2% lower, because the internals seem to be not that pleasing for the market. BPCL is cooling off after yesterday's sharp rally, 2% down. Trent, Asian Paints, Reliance. Reliance has had a very volatile start. Reliance was actually up, leading the Nifty higher on the green side when we opened, and it's immediately turned course and it's down 1%. So intraday, this move is already about 2.5% on Reliance for such a big stock. Anyway, ICICI Bank on the lower side. There is some selling on HDFC Bank as well. So banks are not supporting, and the market has started slipping. There's Bajaj Auto, Hero Moto, the two-wheeler makers, Eicher, all of them on the way down as well. Nestle, Britannia, Tata Consumer. If you thought consumer will support, well, that is not the case at this point in time. On the upside, what remains is actually ONGC. And there's a fair amount of IT, like Prashant pointed out. So TCS, Wipro, they're still trying to provide some comfort and support. Tech Mahindra, minor gains. But otherwise, it's just cooling off. Barring ONGC, which is a very obvious move on oil and IT, the rest of it, banks are slipping, Reliance is slipping. We don't have too much support. And even FMCG, not really helping the bulls' cause, at least at the open.
Well, M&M Financial is extending its losses now. So more than 4% gone on M&M Financial. Apart from the worsening of the asset quality, even the disbursements for M&M Finance in Q2 were down 1% on a year-on-year basis, so a bit of growth concerns too. Angel One too is reacting adversely. That stock is open with a cut of close to about 3% Paint companies are hurting on the back of the rise in crude prices. So Kansai Nerolac, Indigo Paints are down 1.2%. EPAC Durable has got an order win or sort of an agreement. They will be manufacturing components for Panasonic ACs. It started trade in the green, but now has dipped into the red. So perhaps some of the up move has already played out, because this week the stock is already up close to about 7%, and the stock is practically doubled from its IPO price. Interglobe Aviation too is a bit subdued in trade, so that's open with a cut of about 1%. Z Media, a stock which has had a one-way unstoppable move. Z Media today has corrected close to about 5%. And some cuts are coming through in real estate companies like Macrotech Developers. Real estate index, remember, has taken the biggest hit over the last 4 or 5 days. So Phoenix Mills, Macrotech Developers continue to remain under pressure. On the way up, it's ITD Cementation. Yesterday was up 20% on the back of that 1,900 crore order win. It's followed it up with another 5% gain. Sapphire Foods, JK Paper, these are stocks which are looking quite smart and seeing some pretty good volumes. Aarti Drugs, Shilpa Medicare, even Uflex, where the company is planning to set up a plant in Egypt. The investment will be $126 million. Uflex is higher by close to about 1.5%. And Bank of Baroda, amongst the Q2 updates, Abhishek, remember, was telling us after a weak Q1, in Q2, growth has bounced back. The company's advances growth is 6.7% on a quarter-on-quarter basis. So Bank of Baroda stands out on the way up in terms of the quarterly updates.
Okay, well, those are lots of names which are coming through. Just a few more. I mean, look at the Nifty, right? We started absolutely flat, slightly lower. Then there was a 30 or 40 odd point bump. That's got sold into, and we're down about 80 points now. So 25,170 is where we stand at. So that's about 1/3% lower. So this is a more, not decisive, but a pronounced kind of reaction, for the first pronounced reaction for the day. Let's welcome in Samir Arora. He's joining us. He's a market master of the day, founder and fund manager at Helios Capital. Samir, it's good to see you. Thank you very much for being on the program. So I have two questions, and you are someone who's invested and watched not just India, but regional markets very closely as well, China as well. So let me start with that. Is this time different? That old question. It rarely is, but let me frame it that way for China. And second, I mean, is this a real thing? And second, flows. We saw some very large selling figures in India over the last 2 days, foreign selling. Is that on account of China as well? Go on.
So second part, not so clear, but first part is it can go on, I think. By the way, in our fund, we used to own Alibaba and C-Trip, and we bought more Alibaba even yesterday, because I think it can go on for some time. And actually, I don't think it's a bad thing if China market does well for us, as in mostly for India, funds. But before that, so the China thing, first of all, the government has to take a call now whether they are going to make sure that they are able to revive confidence, revive this thing, or they make it as a given. They have the money, they have a lot of advancement in technology. They have to basically revive sentiment of the consumer. There was maybe some pressure even for people who are rich to not openly spend because of this shared prosperity and things like that. So if they let it go, like for India, for many years, we were able to say that although there is a big divide between the rich and poor, but at least the rich are doing premium and the care recovery and all that. So you don't believe that there are many super rich people and middle class and upper middle class, which all they need is the market. A market means the government and whatever to let them be as they are rather than always show that they are, part of a shared system. So it can go on, I think. And maybe some pockets do it only, but it can go on because their market was really cheap. It was just that it needed a trigger. But I think it is not bad for India per se. I don't think that beyond some shorter term thing, investors have to sell India to buy China. Because India, I don't think in aggregate, people are overweight. There might be 1% plus minus overweight. So if you were underweight China, that would have come from the rest of the world. India and China, even an emerging market fund combined would be, say, 20 and 25, 26 now. So half the investment of people who are able to move this around is in non-India, non-China. The other thing is if the Chinese market does well, and if the US market does well, the Indian fund managers, the mutual fund guys, they will have less reason to sit on cash. Our premium to emerging markets, our premium to China has shrunk because the Chinese market is up some 25, 27%. So we are some 5-6% cheaper than we were. Just to finish one more line. So meaning the market used to say that Indian market trades historically at some 40-50% premium to emerging markets. And in recent periods, it has become 165-170%. So that does not mean it was 20% overvalued. That means it was 170 divided by 150. Correct? Because 150 is equivalent. So it was 10-12%. Let us say, if that was one issue, that it was 10-12% more than the longer term average. Now that it would be, according to me, 5-6% more than longer term average, just with China moving up 25%, because that would have shifted the valuation by 5-6% at an index level for emerging markets. So I think you don't want China to blow up and feel happy on that. If they're doing well, it's okay. We may underperform, but we will not be in absolute negative.
But Samir, hi, morning. Great to be listening in to you. But the thing is, when $3 billion leave the market in 3 days, it does catch people by surprise, right? I mean, we were sitting on a high horse saying we don't need the foreigners and that's fine. We have local money. But exactly, I mean, we've forgotten what FII selling really feels like, and we got a nasty reminder since the start of October. How long can that continue?
But that's what I'm saying. I don't know whether it's related to China only, because there are three issues going on simultaneously. One is China, let's say, one issue. Second is that if people had some model on which they are doing this futures arbitrage and all these millennium kind of guys. And the third is that separately, I think it is going on in parallel that if you have more than 25,000 crores in India, you need 100% disclosure of your end investors. And many of these platform guys will have more than $3 billion and they have to basically reduce their weight in India. So who knows what is the exact reason? But I think the best answer for that would be to call some broker and ask him that, is it hedge funds who are selling? Is it long? Because my big picture thing, without overly knowing this, is that nobody does it like that. No regular long-term or even medium-term investor sells a market which is, at least in the last 3 weeks, zero, to buy a market which is up by the time he ends up buying it 30% higher. And mostly the stocks that he will like to buy are 40% higher. Mostly you do it a little bit more gradually. This kind of thing normally is a burst in the beginning. And that can be easily countered after some time with the domestic guy sitting on cash and some other guys who will feel that a 30% move is too big. I just think big picture,
Yeah.
Relative India-China flow is not going to do it, but who knows?
Got it. No, just one point. Hormuz was just telling us, he looked at the top stocks. He said 5 stocks basically were responsible for the, I think 70-80% of that 15,000 crore sell number. There was Reliance, there were the 3 banks, and there was, so very concentrated. And the fact that there were 3 banks kind of looks like it's foreign related.
No, of course it's foreigner selling, but the question is whether it is China related or it is arbitrage related and other things.
Samir, hi, morning. So we're now almost approaching a near 5% cut from the top. And, at least in the last couple of years, we haven't seen a fall greater than 5%. So now investors are saying that is this the time to buy stocks or buy any themes that they like? So, if you have to find opportunity now in this little bit of a correction, what would you recommend?
So first thing is that 5% correction can happen without a reason. If this 5% correction has happened for reasons like Israel attack or Iran sending missiles to Israel, or it is because of Hamas and whatever, and it is because of China having done this, then it's a pretty decent market that with only 4-5% fall, it has absorbed all this. So I think the market continues to be strong because my big picture thesis is that India itself was doing okay. If the rest of the world is also doing okay, then there is no reason for us to feel too negative. The only issue could be this geopolitics, but as of now, even the oil prices are not that high, which show that there is an imminent attack happening, although President Biden said some few things which confused the oil guys for some reason. But coming back to us, so we, first of all, have been more or less fully invested, so we don't have much, but the general big picture thumb rule would be any stock that you own which is down 5, 7, 8% without any reason, you buy 0.5% more of that. For us, these stocks remain primarily right now in the financial sector because the IT sector, we have just bought, now we have some 13, 14% in IT, but we need to wait for their results and guidance and language and how they say, because we have all taken it for granted that the worst is over and that there'll be some improvement from here, but let us again hear it from them. And in consumer, I genuinely think that there is a slowdown and that there is too much competition and we come up with a new excuse every month. Sometimes it is big rain, then big summer, then politics, then cold, because now they are saying it's very cold. So then they'll suddenly say, okay, let's buy some cream guy because somebody's skin became dry, so they want to buy those shares. So I don't like that. I like very, sort of somewhat reasonable prediction of growth or sometimes very high growth like these food delivery companies and all that.
Samir, so I just looked at this is of course as of yesterday's close and maybe today numbers would be a little. So Axis, HDFC, ICICI, they've all fallen. Axis has fallen 8% from its highs. HDFC Bank 5.5%, ICICI 5.5%, Reliance 8% from the highs. Tata, and actually autos have taken a knock between 6, 7, and 8% average. Tata Motors, Bajaj Auto, Maruti. What you were saying, right? I mean, the pullbacks
so I would say that
seen.
autos should fall 20% as far as I'm concerned, and they would still be overvalued.
Yeah, you've not liked autos for a while. Yeah,
and that is very blatant. I mean, it is just too much of living in our own world. But for financials and even some consumer here and there, you can add. We will add, or we have added.
Okay, all right. The other sort of thing has been earnings. So consumption is slow, but looking at some of the previews which have come in from specific sectors, generally it's expected to be a pretty slow quarter. Actually, people have mostly written off Q2. They're looking at H2.
So it's very easy to say now, as soon as the results are bad, to say they have written them off, because this whole quarter, the only stocks that went up were these consumer stocks because of good monsoon. Now they say there was too much monsoon. Actually, I have a bigger issue with this, which is to do with the fact that these traditional consumer guys, I think the basket of the consumer has changed into his, as in regards to his preference. So if there's more rain and somebody makes a few 1,000 rupees more, does he upgrade his toothpaste or does he spend more on a phone or on something which he can show on social media or in a photo, or does he travel a little bit more, or does he buy a more expensive shampoo or a soap? I think the basket has changed, and even this telecom price hikes have basically meant, say, a 300, 400 rupee per year price hike, say 30 rupees per month, multiply by 50, 60 crore people, and that is a big, big number that has gone to the telecom guys. So I think basically we are not interested in the old consumer companies where you are betting whether the growth is 3% or 4%. And that is also because of rain or no rain. And we don't like the consumer durable companies because the consumer durable companies, the competition is just too much. Everybody wants to get into the same making of ACs and making of microwaves and making of air conditioners from the French, not French, sorry, the Japanese to the Koreans to every Indian guy like Reliance, Flipkart, all going to the same underlying OEM manufacturers to make under their own brand. It's just too much.
Yeah. I just have since we have you, and I must ask you, there's this new F&O curves, etc., which have come in. Quick thoughts, if any, at all, on how this is going to work out. We will see big fall in volumes. And your thoughts on BSE, Samir, if you have a view.
So actually, I don't know about BSE, I don't have it, but big picture, my thing is that the market in India has to, for a few days, play dead on those sectors or stocks where the government or the regulator is trying to do something which broadly is negative. So let's say you increase capital gains tax. If within 2 hours the market goes up, it gives confidence to the government that we should increase taxes even more because these taxes were ignored. In the same way, if SEBI or the regulator is saying, I think the futures and options volume is too much and I have to cut it down, and within 2 hours the broker stock is up 5% and the stock exchange stock is up 8%, it gives instant feedback to the regulator that this was not enough.
Yeah, but Samir, to be fair,
you have to act that this is such a difficult thing for a few days collectively.
But to be fair,
it doesn't
Samir,
matter the next time. So I think both will be increased.
No, but to be fair, but Samir, to be fair, these stocks went through a lot of correction, right? Because the announcement was just a culmination of a discussion paper. It went on doing the rounds for several months, and we saw the price damage on an angel.
I'm not joking, but I'm joking. What I mean is, on first day, you have to make it look that it was very tough and not.
Yeah, that's true. It's very, very onerous. Tax hikes, any higher regulation. You have to show that it's very difficult.
But Samir, you're giving the secret away. You're giving the secret. If you got to do it.
Because I'm a transparent guy. I tell everything I feel.
But speaking of transparency, Samir, to round this conversation up as we move to our next guest, who's actually tracking equity markets around the world, CLSA's chief equity strategist. So as we move to Alexander, I'm coming back to the final point, Samir. You are still buying Alibaba, right? So for every incremental, you bought yesterday. So that's the question. That for fund managers, that for all the new money, even if it is tactical short term, are you going to buy China shares or put that money to work here in India?
No, that's what I'm saying. It doesn't happen like that. That fund doesn't buy India. It's a global fund and all. I'm saying India has enough story and an ongoing thing for the world to not take it as a trade-off. And by the way, how much Alibaba we bought compared to what we buy in India, the proportion might be 30:1 or something. So the point is that what I'm saying is the fact that China is doing well for a few days, yes, for maybe 10 days, 15 days, it can happen that somebody who's really was short there or really was underweight doing it. But just like you saw today, the GQG guy saying that it's a trade, not everybody will buy into it. And particularly the bigger guys, the endowment type or whoever has walked out of China on some serious view that they have of that market are not even time-wise able to change it in a few days or in a few months. So this will go on, life goes on, but overall it's not a bad thing for China to do well. I mean, because you need the rest of the thing to work well so that we don't stand out also beyond a point that our premium is so much, we are at all-time high relative valuations and
as they say, nazar na lag jaye, Samir, right?
Correct. You have to let it come along.
Super.
All right, thank you very much, Samir. It's a pleasure speaking with you, and hope we can do this more often as we continue to track what's happening in, China, India, and of course everything else. 3-4 things up in the air all together, guys.
Okay, let's move on then. And as promised, CLSA, let's get the conversation going. CLSA in a recent note said that the China stimulus package is a good start, but not a panacea for China's issue. They added that the constraint on stimulus is already stretched budget and elevated public debt. To discuss more, this and more, we have Alexander Redmond, Chief Equity Strategist at CLSA, joining in. Alexander, thank you very much for joining in. This is Rima here. I think that's the big question now. What we've heard from China and what perhaps might come in the future. Is the Chinese market, should we look at the Chinese market tactically, or is it good structurally for the next 3 to 5 years? Wayne, with your opinion.
Yeah, very good morning. I think that is the key question. What we've seen so far is a commendable delivery on the monetary policy side. We've seen some direct stimulus at getting the equity market animal spirits back alive, and certainly the retail investor has followed through on that. But I think what really differentiates the current episode is going to be whether you get the fiscal follow through from the Chinese government. We've had 4 full storms, so 4 bear market rallies in Chinese equities since March 22. And each one has petered out after about 3 or 4 months and after no more than about 40% gain, as the market has come to the realization that the fundamental economic challenges that China faces have not actually been resolved. What will differentiate this one is if in the next weeks and months we get some clarity from the Chinese government, from the key policymakers in the Politburo, as to the magnitude and the scale and the deployment of a large fiscal package. Because let's remember, I mean, China's single biggest problem that it faces at the moment is immense oversupply on the real estate side. If you look at the current inventories with developers versus the current rate of sales, it represents about 3 years worth of inventories that they've yet to clear. And that doesn't include the 12 to 15% of the housing stock in China, which has been bought speculatively. So add all of that up and you've got a lot of inventory to digest, and you need a sizable fiscal package aimed squarely at local governments to be able to digest that. In other words, buy it off developers and turn it into social housing projects.
So, Alex, great to have you with us here on the program. So you're saying we need to obviously watch the property market very carefully to see if there is any sort of a durable rebound. Is that going to be the best indicator of whether this is the real thing? What else will tell us that this is the real deal?
I need to see multiple changes and indicators. I mean, what we need obviously is for property prices to begin to turn up. Certainly, I mean, this is critical. 51% of household wealth in China is still sitting in property. You know, are you, as a member of a Chinese householder, going to feel sufficiently confident to go out and acquire more property if prices are still falling? You know, highly unlikely. But equally, what I would like to see is consumer confidence broadly begin to come up, and also importantly, consumption. And this again is, I think, a key topic, because as we're all aware, China's economy at the moment is still remarkably imbalanced away from consumption. Its consumption share of GDP is only about 56%. If you look at the other large global economies, India included, it's between 70 and 82. So China needs to take policy measures which will unlock savings. At the moment, you have about 115% of GDP sitting in savings. So much of that could be deployed into consumption. It's just whether the government is prepared to take those steps to actually unlock China's consumption potential going forward.
But would you say to some extent this China rally that we've seen is a bit of a hope trade, because this fiscal stimulus package of 2 trillion yen, which has been talked about, hasn't been officially announced by the government there?
Mm-hmm. No, you're right. I mean, what we heard, the genesis of the report, I think, came from Reuters. There was 2 trillion renminbi, split roughly in half. I mean, the idea was that half would go to refinance local governments and allow them to carry on the purchases of excess real estate inventory, and the other half aimed more at stimulating consumption. But as you say, this remains unformulated. I mean, last Tuesday, you had a relatively precise delivery on the monetary policy side and regulatory changes from the PBOC and the securities regulators. And then on Thursday, we had some sound bites that came out of the September Politburo meeting, all about arresting the falls in real estate and trying to encourage spending in China. But as you say, pretty light on detail.
Okay, so got that. So you've spoken a good bit on China. Alexander, the question really is for us sitting here in India is what does it mean for us? And we've seen the first sign of real FII selling in the last 2-3 days. And I go back to a call that your India analyst Vikash Jain made, that he said the quote-unquote Modi stocks, they are perhaps most vulnerable to profit-taking. So what's the stance on India?
I mean, India's been on a roll for several years now. You know, we've been a structural overweight. We've enjoyed that rally, but I've always been testing that because there is a certain amount of complacency around, or at least has been around the Indian equity market story, and a certain amount of consensus. And there are three things which I've been looking at to break that complacency. And essentially, it's an interruption to retail investor appetite. A large pickup in issuance. In other words, you get IPOs to the level that you can swamp the secondary market. And also any changes to the oil price. And what you've seen actually in the last week or so is all three of those come into play. So you've seen regulatory changes which have dampened the ability of retail investors to participate in equity derivatives. You've seen the geopolitics in the Middle East become more of a flashpoint, and that's aggravated the oil price as we all sit now waiting for Israel's response to Iran's missile strike. And you've seen significant pickup in primary traffic. So, the volume of IPOs and secondary issuance has picked up as well. So all three of those, I think, in combination are certainly testing the Indian market. And as you say, compounding that, there's certainly some scope for rotation. Now, I think we need to be careful here because if you look across emerging markets, India is one of the most domestically owned markets, and that is quite a moat for India. It's very protective. 83% of the market is owned domestically. I mean, if you go to Latin America, that number falls below half. And so with only about 17% of India owned by foreigners, and most foreign investors actually sitting, at least anecdotally, at underweight positions because they find it difficult to stomach the valuations, I think there will be relatively little drawdown on Indian equities to rotate into China. I see a more obvious source of that being Japanese equities or Korea or Taiwan as we get towards the end of this tech cycle.
Quick one-word answer, Alexander. On US elections, who's better for emerging market equities? Kamala Harris or Donald Trump?
Look, I think there are some key differences here. I can't really do it in one word, but I'll try and be brief. Look, the differences are, I think, obviously on tariffs. That's very well flagged. We know about that. But equally, there's some more nuanced differences. I think Trump's agenda is far more inflationary. He stands for deregulation, cutting taxes, implementing tariffs. And I think that what that will do is complicate the Federal Reserve's ability to ease in a Trump administration. So I think what would really differentiate Trump and Harris from an emerging market standpoint is three things. One, the Fed's capacity to ease. And that would have a knock-on effect on Asian and emerging market central banks' capacity to follow through. Secondly, the dollar, of course, because if the Fed is unable to cut as much, then the dollar will remain relatively strong, and that's always proved a headwind to emerging market equities. And thirdly, on the earnings side, what brought the EM rally to an end in 2018 was as much the start of the trade war as Donald Trump's tax cuts. He took the tax rate, corporate tax rate in the US down from 35 to 21. What that did was give a boost to US earnings growth. The relative earnings differential between the US and emerging markets then went up, and that made emerging markets overall look less attractive. So what really differentiates on the tax and earnings side between Harris and Trump is that Harris wants to take the U.S. Corporate earnings growth back up to 28%. Trump wants to cut it further to 15%. So under that environment, the EPS differential for emerging markets would look better within a Harris administration than Trump. So overall, I would conclude that Harris certainly, I think, is more favorable for emerging markets for those macro reasons.
That's a great point, Alex, and thank you for highlighting that, because there's so much debate around US elections. I think the central issue, which is tax, is perhaps not discussed enough. Thank you very much for all the perspective. Great having you on. We hope to have you more often on the show in the coming weeks and months as well. Take a break on that note, come back on the other side, and we'll connect with Ramesh Swaminathan of Lupin and talk about the company's business outlook.
So this was monitored, but at the end of the day, now they're saying it has to be done on an intraday basis. Lots of feedback in terms of how this is going to be finally implemented. There is time, as I said, only effective from the 1st of April 25. Number 4, increase in tail risk coverage on the day of options expiry, effective November 20th. Basically, if you are carrying a position or if you take a position on the day of expiry, all existing positions on the day of expiry, old and new, will attract an extra ELM, which is extreme loss margin of 2%. So this is number 4. Number 5 and number 6 are pretty straightforward. Number 5 is upfront option premium, effective 1st of February 2025. And number 6, removing the expiry day calendar spread benefit, which is also going to be effective from the 1st of February. So I think these are the 6 changes which SEBI has implemented, largely in line with expectations. But I think the lot size increase.
Welcome back. I think just the one thing I want to say before I get to the next thing is the fact that the Bank Nifty came back into the green. There was a big recovery. There has been a decently big recovery from the day's lowest point, and we are now sort of between green and red, so absolutely flat for now. More on this later. Lupin is the first corporate on the program today. The stock surged more than 60% in 2024 so far. We're now joined by Mr. Ramesh Swaminathan, ED and Global CFO at Lupin, to talk about business and some of the developments. Mr. Swaminathan, good morning. First of all, apologies. Sorry to have kept you waiting with markets what they are. So, let's start talking about the latest, right, which is the MyBetric generic. Now, we understand that the US Court of Appeals, the judgment has gone against generic companies like Lupin and Zydus. Could you tell us what is the status of the litigation? Are you still selling this drug right now in the US as we speak? And what is your expectation about how much you will make from this in FY25 and FY26?
Firstly, let me begin by thanking you for having us on. Regarding Mirabegron, the first thing that I would like to state is that it's actually sub judice, so I wouldn't like to delve on it for too long. But I would say that we are indeed selling this drug, and we are pretty confident about our case. And from that perspective, we continue to sell it.
Okay. But this is still in the courts right now. So I understand you don't want to go too much into detail. But the Court of Appeals decision went against generics, right? So will you have to stop selling it at some point, or
it didn't go against the generics, and it got referred back to the same bench. So for the same trial courts. So it is not. I wouldn't say it is actually against generics at all.
Okay. Just one last. I won't press you beyond that. Estimates are that in FY25 you'll make between 120 and 180 million dollars. Is that on track? Or are those wildly off, those estimates?
It'd be an unfair question to ask, because essentially we never delve into product-wise details. Suffice to say that we are doing pretty well in the product also.
Okay. Morning, sir. If you could just give us a status on another drug. I think the kidney drug, Jynarque generic. Sorry if I'm getting the pronunciation wrong, because we understand the innovator of the drug Otsuka has filed an appeal against a verdict that would have otherwise favored companies like Lupin. So what's the status here? Is Lupin going to launch the drug as you had planned in 2025? Is there going to be a delay, or would you look at an at-risk launch?
Just speaking about tolvaptan, the fact of the matter is you've actually won that case, and we are pretty confident about actually launching it. It is a pretty large drug. It's a REMS product, and from that perspective, I would expect it to be limited. It would continue for some time from our perspective, and very, very upbeat about that particular product for the next year.
So when are you launching it, sir?
It'll be possibly in April 25 next year.
And will this be an at-risk launch?
No, tolvaptan isn't an at-risk launch.
Okay.
Mr. Swaminathan, hi, sir. Morning. Now, a slightly broader question. How you're seeing the US business overall sort of move along, and some of your, of course, marquee names like Albuterol, Spiriva generic, etc. So what is the prognosis going forward? And I just want to understand whether politics at all impacts business in any way when it comes to your US operations. Does it really matter to you who comes to power? And also tell us, because it's a little difficult to track all the minute details. For instance, our previous guest was just highlighting that in general, one camp is looking at a big hike in corporate taxes, while Mr. Trump obviously wants them lower. But on the healthcare side, in terms of policies, could there be any significant impact on generic company operations like yourselves?
Too many questions in the same breath. Let me take the first part of the question regarding how well we are doing. We continue to see pretty good buoyancy on the top line in America. So the recent launches, which includes, of course, our respiratory portfolio, Albuterol, and then Spiriva, continue to do pretty well. We've also bought into a few brands out there, Zopinex, Brovana. They also continue to do pretty well. In a general sense, we've also been launching a host of other products, OSD and the like. So if you look at, for example, we had Darnavi last year. This year we had, we had quite a few other products. And this year, for example, we are looking at, some ophthalmic products as well. Next year, we're looking at tolvaptan. And of course, when you speak about, in fact, the entire respiratory portfolio, and we are actually working on the entire range of products in that portfolio. And over the next 5 years, we'll be launching a number of products. Apart from that, we also have a number of products on the injectables front also. So from our perspective, we're still pretty bullish about the overall prospects for America. And that would be true with, in fact, the other markets as well. But reverting back to your question about the political situation out there, we believe that affordable medicine is certainly going to be, the case, irrespective of whichever party is in power. So be it the Republicans or is it going to be Democrats, I don't think we're going to be impacted at all. There's of course the IRA and other acts, regulations which might actually impact the ethical companies, not so much the generic companies, because we are all about affordable medicine, and that would not impact us so much.
So, sir, the estimates on the street right now, the analysts are working with estimates of, say, $220 to $230 billion of a quarterly run rate for your US business. Are they fair estimates, or are they conservative? Can you actually do better than that? I'm not asking for this quarter, but generally that's the assumption for the next couple of quarters.
I would say that given the pipeline that we have and given the fact that the respiratory products will continue because they're a lot more sticky, I would say the run rate that we saw last quarter would certainly continue in the future as well. So 200, 220, 225 would certainly be the range for the next few quarters.
And around 21% in margins for 25 overall?
Last year, last quarter, for example, we did 23, but we also kind of guided that it could perhaps turn out to be a little lower in the quarters to come because of the fact that last quarter, the overall R&D spends were a tad lower than normal. So given that, we were guided for about 20.5 percentage points. Very confident that we would actually be on track to achieve more than that.
Okay. You'd also indicated that you could look to spin off some adjacencies like OTC, diagnostics, digital, etc., and get in outside investors. Any movement on that?
So let me put it this way. A capital allocation policy has been predicated on what the board really wants. And when I speak about, in fact, the adjacencies, diagnostics, digital, all of this are very important to us. But having said that, these are not going to be the dominant themes. From that perspective, there is actually a pull the upper threshold in terms of investments that have been kind of prescribed by the board also. We will not be exceeding that. So we already spun it off into subsidiary companies and potentially be looking at involving private equity houses or other passive partners to partner in the journey so that they kind of spin on their own axis. So the idea is, of course, to benefit from these businesses without actually losing sight of the fact that our capital allocation policies should not be kind of dislodged. So it's basically that. So we are confident that when they reach critical mass from our overall size perspective, we should be in a position to kind of place it with outsiders.
Okay, just a quick word. I think the USFD inspected and issued 3 observations for your Pithampur Unit 1. What's the nature of the observations and what's the status of the facility now?
We are, as I said, so insofar as this facility is concerned, of course, it did go through a recent, the observations are, from our perspective, quite manageable. And we look forward to getting, this sorted out, and with our responses in the immediate future.
Okay, all right. So we'll leave it on that note. Good having you on the show today. Thank you very much for all the perspective and some sense on how the US business is shaping up. Thanks for joining in. Let's quickly move on and now put the spotlight on the consumer durables sector as the festive season is getting into full bloom. Aquarius, in a recent note, has said that industry dynamics remain extremely comforting. To talk about the key trends, we have with us Nilesh Gupta, MD Vijay Sales, and Anand Agarwal, CFO at V-Mart Retail. Gentlemen, thanks very much for joining in. Mr. Gupta, if I could start with you. So what's the sense you have this time around? What is the anticipation? Like to like festive season last year and compared to this year, what's the kind of growth you are anticipating?
So good morning, everybody. I think this year is going to be much better than last year. Although we had a good season last year also, but looking at the trends which we have seen on the 2nd of October, and yesterday was the first festival day, Navratra, and the way the consumers are coming in, I think we are in for a very good season. That's what.
Do you want to put some numbers to that, Mr. Gupta? How much better could this festive season be versus last year?
So I think we should be looking at a growth of anywhere between 7 to 10%. And mind you, possibly there is more chances of growth, but the issue is everybody maxes out during the season. So even if the consumer demand is more, nobody will be able to do more than 7 to 10% growth. And I think that's the max what can be done in a festive season.
Got that. And can you break that up category-wise? Say electronics, what's the expected growth there?
So basically, I think the driver of the Diwali would be definitely electronics would be more, but appliances also does well. So across the category, we find that we'll get a good growth across the category. But one thing which is going to be very good, which we were very skeptical, because last year, the second summer was very good. In fact, the main summer had just got totally lost out because of the incessant rain during the summer. And we had a good second summer, especially in the west part of the country and the south. And this year again, since last 1 week, we have been seeing rising temperatures. So AC growth is also expected. But across the category, I think we'll be seeing the growth.
Absolutely. Temperatures have flipped and how. Gentlemen, good morning, Mr. Gupta and Mr. Agarwal. Prashant here. Mr. Agarwal, if I can come to you, what are you seeing out there? What should we expect from your business and the categories that you're in for the festive period?
I think we remain quite buoyant and optimistic. I think we're definitely seeing better footfalls as compared to at least the last couple of years. This year has definitely been better. There is definitely better consumer sentiment that we are able to witness. Last quarter definitely had been quite good. And the start of this festive, as Mr. Gupta was also saying, I think has been quite promising. The monsoons this year have been very good. So thereby, at least the rural areas or the semi-urban areas where we tend to operate more are definitely looking more promising. We're quite hopeful to have at least, mid to high single-digit like-to-like sales growth. And that's what we have planned in terms of our inventory buildup and what our operations are going to, look like. But definitely, as of now, it's a bit early, but definitely looks very promising.
But,
in Q2, the update that you provided, Mr. Agarwal, same-store sales growth was 15%. Could you, what can we expect for the October to December period? I mean, is there any indication at all?
So I think we will still want to look at least, mid to high single digit. Quarter two is a small quarter, and also we had a benefit of last year low base. But I think quarter three has always been a very, very good quarter, very big quarter. So improving on that on a high base in double digit will be challenging. So I would right now look at, first to get at mid to high single digit.
Okay. Mr. Agarwal, so that explains why I think sort of full year level you're still talking about high single digits, and you're not talking about double digits just yet, right? So, okay, get it. So you're taking a slightly more conservative approach in terms of the guidance. But give us some more color on the revenue that you would hope to do on the back of this kind of same-store sales growth. And also, which are the markets where you're seeing sort of maximum growth at this point in time? Just some more geographical color as well.
Sure. So we're definitely slightly more overweight on East India and South India. We see that as a very, very big opportunity areas. East, particularly, we have not been very strong, but we have built up our portfolio this year in East. In fact, we have opened almost like 15, 17 stores so far in this year in East India alone. And we're quite bullish on South as well. South, as you know, we operate under the brand name of Unlimited. And we're looking at ramping up our presence in South significantly. And we're seeing good results coming in from both East as well as South. So that's two areas where we are definitely working on. In terms of how the overall sales should look like this year, I think we should definitely clock better than what we did last year in terms of the growth percentage. I think if we are able to look at high single-digit same-store sales growth and around 10 to 12% area addition, I think we should be conservatively be looking at around 15% plus at least for the full year.
Mr. Gupta, one final question then. Quick commerce has now expanded to electronics. We know a lot of Indians ordered iPhone 16 on many of the quick commerce sites like, Blinkit and I think Big Basket. How would you assess the threat of quick commerce for a company like yours and the industry?
So I think when online came in, the same question was asked, online has come in, so what's going to happen to the brick and mortar? So the same thing, my answer at that time also was the same, and today also I'll reply in the same way. The best part is in the country, the market is growing. So there's going to be a room for all the players. So there would be consumers who would want to buy instantly and they may go for quick commerce. There would be consumers who are okay to wait but want a deal and they may buy from wherever he gets a deal. And there would be a consumer who say, no, I want the traditional way, I want to go check out. Let us also understand that our product is not something which is discretionary. It's once in a year or once in 3-4 years purchase. People would want to touch and feel also. So I think there's a market for all, and like what online did for the industry, I think e-commerce will do the same. It will grow the market, expand the market. So I'm quite okay. Or rather, I would say I'm happy that more and more interest is coming in our industry.
Mr. Gupta, I can completely concur with you on that one. There are different types of customers and consumers. I'm clearly in the other category. I have trouble, guys, buying like curtains and stuff online. So forget buying high-value items like, phones worth lakhs of rupees. So absolutely, I think there's scope for all kinds of consumers out there. Thank you very much, gentlemen, for joining in. Really appreciate you being with us on the show today. Take a break right now. Come back on the other side. We'll put the focus on the commodity space with Manisha Gupta.
That SEBI's limiting weekly options contracts to one per exchange will attract maximum amount of discussion and debate in terms of what this does for market volumes, exchange volumes, and what this does to market intermediaries as well. Back to you.
Right, Prashant, very quickly before I let you go, a lot of comments coming in, a lot of questions and queries coming in from the viewers as well on our social media handles asking about the impact and the implications. Just in the near term, from a market perspective, you've probably been speaking with experts. What's the impact likely to be on the markets when we open tomorrow?
Shireen, so through the course of the day, we spoke with lots of market participants. Markets are prepared for this. I mean, we put out the story in the morning that this is to be expected very soon, that this is imminent. There was some expectation in some quarters, and we had clarified yesterday as well that this was not to come up along with the board meeting. And we said that, well, this is going to come soon this morning. So I think this is widely advertised. And the fact that what has been done is largely in line, actually mostly in line with what was proposed in July, I think does not come as a shock or a surprise. And also the important point is this is being done in a phased manner. It's not as if everything is being implemented by the end of the month or from a certain date. I mean, there's November 20th, there is April 1st, there is February 1st, all the way into 2025. I think that also kind of eases the impact a little bit.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube.
Welcome back. It's flat now. Nagraj Shetty of HDFC Securities is now with us on the show. Nagraj, what would be the index call and the 10 a.m. stock trades?
Hi, good morning, Reema. Nifty has been in a volatile session and we have seen some 1,000 points cut from the highs in the last 4 sessions. So if you look at the similar kind of a decline previously, we have seen similar kind of a knee-jerk actions from the higher levels, and eventually Nifty has bounced back from the lower levels. Market is currently finding a bottom reversal at the lower levels, and I believe that 25,000 to 25,100 is going to be the strong support for the market, which is the 23.6% Fibonacci retracement as well as the 50-week EMA, 10-week EMA. So I think I'm expecting market to bounce back, market to show some bottom reversal around 25,000 to 25,000 levels from the lower levels, and we could see some reversal and a bounce back. The quantum of bounce will determine whether we are going to see the new highs or we are going to see the lower top of the sequence. Right now, I'm little cautious, and the market is finding some bottoms at the lower levels. And in terms of stocks, I have mixed stocks one from long side, one from short side. Long side, if you can discuss, the IT has been in a phenomenal up move recently, and currently the Coforge is the one from the IT pack is showing upside breakout of the range movement. If you look at the chart of the Coforge, it was resilient during the volatile broader market, and it was actually outperforming the sector recently. I'm expecting currently trading around 7,200 levels. I'm expecting a decisive upside breakout in Coforge. One can look to buy at 71. Currently trading around 7,200 levels, and target would be around 76.50, and one can place a stop loss at 68.50. And one more stock is the Balkrishna Industries from Auto Ancillary. Balkrishna on chartically has damaged recently after the formation of a consistent lower tops. Recently, it is continuing with the lower top formation and decline. The overall chart pattern is looking negative, currently trading around 2930 levels. I'm expecting more declines in this stock. One can look to sell short in Balkrishna Industries, which is currently quoting around 2930 levels. And 2750 is going to be the next downside target for this stock price, and one can place a stop loss at 3050.
All right, Nagaraj, thank you very much for that. So those are some trades coming through. I just want to say that the market's picked up 150 points from the day's low, 50 minutes after market open. The big move is on the upside from the day's low. The day's low is 25,094, just under 25,100, and we are now at about 25,250. So that's been the story, and lots of stocks are moving, which we will get to in just a bit. But commodities is one area, right? I can see oil marketing companies selling off hard once again. HP is down about 3% on my screen, and a few others as well. But let's get the actual underlying commodities and what's happening there. Manisha is here with that. Manisha.
Well, thank you for that, Prashant. I want to take you through crude itself and various scenarios on how the street is working on whether the crude is going down or beyond 80 from here on. So what we are looking at right now is that we've seen 5% of gains in the crude oil prices in the overnight market. And with this now, we are heading to the best weekly gains since Jan 2023. If you look at on how the scenario really has been for the crude oil prices on a monthly basis, well, last month we saw prices decline by nearly 9%. And for the month of October, the prices have gained up by nearly 9%. Now, there have been various reports on whether or not the crude oil prices can go to 80 and beyond. That can happen if Israel attacks Iran's oil facilities. Well, that is something that has been discussed for quite some time now. Remember, Iran is an OPEC member. It produces 3.2 million barrels per day, which is 3% of the global output. Also, Middle East overall produces 1/3 of the global output. So if this spreads around in the Middle East, then we are looking at a concern. And yes, the crude prices can go up. The second scenario is that there could be a retaliation from Israel on the Karg Island, which is Iran's main export facility. So we've talked about on production and now it's about export. Iran actually exported almost 1.8 million barrels per day in the month of August. So that is something that can be immediately impacted. The third scenario is on whether or not the crude prices can go to 80 and beyond is if Iran disrupts oil flow out of Strait and Hormuz, and this would be most critical and crucial because this is where what would choke almost all the crude oil that comes in from Middle East. So these are the three scenarios that the street is working with. If any of this happens over the weekend going forward, then yes, you are looking at crude oil prices at 80 and beyond. Apart from that, when you look at the Russia-Ukraine conflict, when that happened, we did see the crude oil prices go to $130 a barrel, but then it did not sustain there and we saw the prices come down quite sharply. The pricing closing for 2020 was 85. When you look at the last year, the range has been 73 to 93. Range until now this year has been 70 to 91. So we are far away from the highs of this year at this point in time, even as we're looking at various concerns there. Now, when you look at the global supply-demand mismatch, that is what is weighing onto the prices right now, is the reason you haven't seen 80 cross by right now. So OPEC and allies spare capacity is quite high, much more than what Iran produces. Apart from that, the Libya oil production is coming into the markets. You also have weak Chinese demand. The US production has been on the higher side. So in sense of supplies, we are very comfortable and demand really not picking up. Now, going forward from here, it really is going to be about the US non-farm payroll data that comes in today. And then, of course, you have the US presidential elections coming in the month of November, and they wouldn't want the crude oil prices much higher. So it's going to be a very interesting next 1 month on what really crude does in light of all of that.
Thank you very much for that. With that, it's time for a short break. Don't go. On the other side, Lata will be in conversation with a host of experts to discuss if RBI follows the US and cuts rates on October 9th. Stay tuned.
Global market maestros before crafting your investment strategy. How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajaj at these times on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18, an unending pursuit for excellence. A pioneer, a leader, a visionary, building a lasting legacy of credibility, consistency, and trust. Giving unparalleled access to global thought leaders and powering conversations that are shaping the new world order. Setting the highest standards through exemplary leadership. It is this unrivaled reputation for the most comprehensive coverage, actionable intelligence and in-depth reporting that makes CNBC-TV18 India's #1 business news brand. Foreseeing change, growth and transformation for over a quarter of a century. Trendsetters crafting innovative content formats. And award-winning business journalism. On air, online, on social media. As we embark upon 25 years of excellence, we invite you to be a part of our future. CNBC-TV18, your trusted partner and investment ally.
The upcoming Reserve Bank's monetary policy is much awaited for a bunch of reasons. 3 big central banks in the world have cut rates and cut rates substantially. The Israeli war is about to escalate and the MPC has 3 new members. So let's turn to our own experts. CNBC-TV18 Citizens MPC is here for their deliberations. Chairman Pranab Sen and members Sajid Chinoy of JP Morgan, Soumya Kanti Ghosh of State Bank, Samran Chakrabarti of Citibank and Sonal Verma of Nomura. Gentlemen and Sonal, as always, thank you very much for joining in. Sajid, I'm going to start with you because of the global backdrop. The Fed has cut more than expected and so has the Chinese PBOC. Won't this prevail on the MPC? To what extent?
I think the global environment is actually far more nuanced than is believed. One would get the impression that with the US labor market slowing and the Fed announcing a 50 basis point cut, that the US is hurtling into recession. But that's not actually the reality on the ground. If you look at the Atlanta Fed, in their estimate, third quarter in the US, July to September, is actually tracking 3%, very far from any recession. And if you look at the internals, both consumption and capital expenditure are holding up. So, in fact, the US resilience story has gotten more support in recent weeks. Now, despite that, we think the Fed will continue cutting because they have more confidence about inflation. And, the Fed's estimate of its neutral rate is somewhere close to 3%. They're currently, even after cutting, they're at 5%. There's a lot of space for the Fed to cut. So you could still be in this Goldilocks situation where the US is resilient and the Fed is cutting and monetary conditions, not just in the US, but around the world are easing because once the Fed moves, many other central banks move. And when monetary conditions ease that much, you're actually buying insurance for 2025 growth. Now, this is not to minimize the near-term risk of a recession. We still think there's about a 35% chance the US slips into recession this year. But if they don't slip into a recession, the Fed easing and the monetary easing around the world actually argues for higher growth next year.
Can we be that sanguine about the crude angle now that there seems to be an escalation? Sonal, until last week, one could be a little more sanguine about the global situation. But with the war escalating, do you think the Reserve Bank has to pencil in more uncertainty and therefore should not ease too soon?
Lata, I think, if we look back at the last 2.5 years, we have had nothing but uncertainty to deal with. And particularly the geopolitical tensions is something we've had like periodic episodes of escalation. And clearly we are in one right now, which is putting an upward pressure on prices. So in terms of, how this plays out and the uncertainty is something that we don't know how it's going to play out. That said, I think if you compare where we are today versus where we were back in August, we were actually above $80 per barrel on oil prices. And today, with this geopolitical risk premia being built in, we are basically somewhere around mid-$70 on oil prices. And specifically for India, the oil marketing companies are actually sitting on a large cushion in terms of margins. So in terms of the pass-through to domestic prices actually should not be there. And RBI in its projections has been working with $85 per barrel on Indian basket of oil. So I think we have more than enough cushion. And I think the other angle to look at is also the impact the uncertainty is going to have on investments and growth going forward. So there's also the demand angle to keep in mind. So I think, yes, there is uncertainty, but I think we have enough cushions.
No, I take your point. I'll, time permitting, come to the geopolitical angle again. But Samiran, first let me tackle domestic inflation. After all, the Reserve Bank reiterates it looks at domestic factors. And here, as Sonal points out, $74 is not hell for us. We've seen worse. And what about food? We saw 2 months of food coming down slightly, though not across the board. Will that still be a good reason for RBI to worry?
Looking at it is that the base effect-led decline in inflation is now behind us. Now the base effect will turn adverse. And even if there are no significant new price pressures, we're still going to see 3 inflation prints which are close to 5%, if not more. So that situation could worsen further if we see that this tail end of the monsoon being much stronger than usual, leading to some increase in vegetable prices, and that feeds into things. The second risk to look out for is what we were discussing from oil prices, though maybe not as much of a risk for India because retail prices are unlikely to be hiked anytime soon. And the third is from the China stimulus. If this persists, if China also goes in for a fiscal stimulus on top of the monetary stimulus, then the commodity price increase at a broader level, particularly with respect to metals and oil and gold, that could feed into the inflation forecast as well. So these are some of the upside risks that we have to look at in the short term. However, we are very conscious that whatever exclusion-based core inflation measure one looks at, they're all very benign. So it's not that there is a huge inflationary bias for the overall economy. And RBI needs to make a difficult call between actually waiting to see the inflation prints turn to 4 versus taking a call on their forecast, how forward-looking they're going to be to see that 4% being met on a durable basis. I think that's the critical challenge that one needs to look at.
Point taken. And in that critical challenge, growth appears to be pleading for a bit of softness from policy. Shaumya, would you agree that the August-September numbers on so many things, core sector, IIP, PMI, seem to be indicating that the economy is softened in the second quarter. So will growth be a reason for the Reserve Bank to be dovish?
Yeah, thank you, Lata. I think yes, there is evidence of growth slowing down. If we actually look into the leading indicators, more specifically the consumption-facing sectors in terms of two-wheeler sales, in terms of passenger vehicles, in terms of tractor sales, I think they're all showing signs of a slowdown. And particularly, I think August and September months could see some signs of a slowdown, definitely. And also the fact that if you look into the latest bank credit data, that also saw a significant perceptible slowdown. Even in incremental terms, if I adjust for the merger last year, the total incremental credit growth for like-to-like period till the end of August was actually 2 trillion down from last year. And for the first time in the last 2 years, the gap between the credit and deposit growth is now narrowed down to only 220 basis points. And in fact, on a year-to-date basis, the deposit growth rate is running much higher than the credit growth. So yes, there is evidence of credit growth slowing down. The indicators also showing that there could be some soft patch of data which could come through in the next couple of months. So my sense is that it may not be the time to say that growth is going to slow down because we need to see some more evidences. But one point on the table is clear. Given the current geopolitical conflict and the talks of an war getting elongated or getting prolonged or getting broad-based, I think what should be also on the table on the Reserve Bank to address the growth concerns to be the financial stability concerns. So I think overall, the Reserve Bank faces a delicate situation, but for the time being, I think it could still ride through with perhaps a message that there should need to be some sort of an hand-holding in terms of growth, even though the evidence is not clear yet in terms of an perceptible slowdown in growth numbers.
Dr. Sen, if you can combine all these points and also the fact that, what Sonal pointed out, despite the fact that there have been rate cuts, despite the fact that, the US GDP growth is 3%, despite the fact of a fairly elevated escalation of tensions, crude is only $74. I mean, we have seen 80, 90 as recently as April. So it looks like the global growth is not so strong, demand not so strong. Is that an interpretation the RBI has to take both domestically and globally, that growth is not so strong?
Well, no, I mean, the RBI will have to take into account for sure. But the point is, how important is it? If you really look at what effect the global economy has had on the Indian economy, which is really the focus of RBI's action, it hasn't made much of a difference. And we've been talking about this for a while now. And all the prognosis that have made don't seem to have been borne out by the developments. So I don't think what is happening globally is going to worry RBI that much. The bigger concern, I think, is what is happening domestically. And there, I think there's a whole bag of mixed signals coming. Shombo just pointed out to a series of data points which tends to indicate a certain degree of softening. But there are other data points which seem to suggest that if nothing else, at least private investment seems to be picking up. So I suspect the RBI is going to be focusing much more on that. Right? And that, to my mind, is really the key issue, that there is a huge amount of uncertainty, global uncertainty for sure, but I think there's greater uncertainty on the domestic front. It doesn't seem to, I don't think any one of us can take a judgment call and say it's going up or it's going down. I mean, it's still moving around, which means that one needs to be flexible.
Let me ask you all to take your electronic machines and vote. What will the Reserve Bank and the MPC do to rates? Let me start with you, Sajid.
Hold rates, still pause.
Hold, okay, hold. Shaumyo?
It's
hold. Okay, Sonal?
They should cut 25 basis point.
Here's the first cut. Samiran?
No change.
3:1, sir, in favor of hold. Dr. Chairman?
Hold.
Hold. Okay, so it's 4:1 in favor of holding the policy. Change of stance. Will the MPC change its stance from the current withdrawal of accommodation? Sajid?
Change to neutral.
Oh, okay. Sonal?
Change to neutral.
Obviously, you voted for a cut. Samiran?
Hold on to the stance, but it's going to be a close call.
Okay. Shaumyo?
You'll hold on to the stance.
Okay. 2 holds, 2 change to neutral. Dr. Sen?
Change to neutral.
Change to neutral. I think your members are veering to your point of view. It makes it a very interesting policy. Bazaar viewers, you will get to see the whole show after market hours. For you, it's time for Chartbusters.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhan.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
Let me be clear. Israel will defend itself. We will act.
Israel has no intention to pursue peace or a ceasefire.
Bajaj Finance trades more than 2% lower, is the top Nifty loser after the second quarter business update reflects lowest cross-sell rate to date, and AUM growth too is at a 6-quarter low.
M&M Finance is down 4%, at one point was down almost 7% after its second quarter business update reflects a 1% drop in disbursements and a guidance for higher NPAs.
Oil marketing companies, HPCL, BPCL, IOC, all of them down 2.5% as crude prices surge overnight to more than $77 per barrel. Meanwhile, oil exploration companies like ONGC and Oil India higher in trade.
Avenue Supermarts is also under pressure as its business update indicates standalone revenue growth of 14% in the second quarter, and the company added 6 stores in the quarter gone by.
Ola Electric lower in today's trading session, skids by almost 2.5%, even as the company launches its discount campaign for the upcoming festive season. You're watching us here on Chartbusters. I'm Manglam Malu. Today is Hormaz with me. And Hormaz, it's not out of the woods yet because we opened in the red. Thereafter, we tried to recover, go back into the green. As we speak, the Nifty Bank is inching mildly in the green. But rallies are being sold into, even though some of the dips are shallow.
Indeed, and the screen on top may not show that there has been a substantial recovery from the lows of the day, but the underlying picture still remains very choppy, as was the case yesterday as well. The Nifty continuing to trade in that 25,100 to 25,300 band, so we're finding support at that 25,100 levels, but just as you mentioned, the rallies are getting sold into.
All right, so let's see how that goes about. A lot to reckon with, not just in today's trading session. We're going into a weekend as well. And in a choppy global environment, a weekend is too long a time as well. But let's talk about one company which has done well, which is Bazaar Style Retail. It's been about a month on the bourses. Recently listed company. In the last 2 trading sessions itself has seen a near 20% uptick. And part of that could be explained by their second quarter update as well, where the revenues grew by about 65%. We had same-store sales grew at 41% as well. Pradeep Kumar Agarwal, who's the chairman of the company, joins in to discuss the company's second quarter business update and, more importantly, the way ahead. Thank you, for joining in. The internals on products and revenue mix, if you could give that for the second quarter, I reckon it could be also on a favorable base. That's what we heard from players like V-Mart Retail, etc. And what kind of margins have you reported in, or margin improvement have you reported in the second quarter?
Good morning. We have our revenue grown by 65% in the second quarter. And if you see the overall half-yearly growth, it is 41%. And in first quarter, revenue, that margin was 32.9%. And we are expecting that the revenue margin will be around 33 to 34% in the FY25.
That's the gross margin you're talking about. I'm speaking about the EBITDA margin, because in the first quarter, your EBITDA margins were closer to around 15%. I wanted to know whether they will increase going forward.
It will be better than last year, in between 16 to 17%.
Mr. Agarwal, good morning. Thank you so much for joining in. We are heading towards a festive season. It will be a busy time for your company as well. How has demand trends shaped up ahead of the festive season? And how are things looking on ground as well? Are people now starting to look at gearing up for the festivities as well? How is demand shaping up on the ground?
Yeah, demand is very good. That's why we have taken the growth of 65% in this festive period. And this revenue has grown because of the festive season. This year shifted to 10 days before. And that's why this 65% revenue growth we have taken.
First half of this year, let's talk half and half. First half of this year, your revenue, like you pointed out, has grown at 41%. What is your outlook for full year revenue growth?
Yeah. We are chasing the growth of 25% for the full year.
25% for the full year. But first half, you've grown at 41%. You expect some moderation because of a high base in the second half?
Yeah. If you see the first quarter number, we have grown by 21% in the first quarter. And in second quarter, 65%, half yearly 41%. So if we average out there, then we are expecting that 25% growth will be there. It may be more, but we are expecting 25%.
Mr. Agarwal, how are you tackling competition? Because there you are in an extremely competitive market, and coming up to the festive season, how do you plan on tackling competition going forward? And if you can couple that up with what is your outlook on the omni-channel and the online sales as well?
Yeah, we are. Competitions are there. We are doing very hard work and focusing on our product development, supply chain, and better display in our stores. That is our goal to chase the competitions.
Okay, but with competition coming in, real estate supply also gets limited. And you have this strong store addition pipeline too. You've added closer to 40 stores in the first half of this year. What is your store addition target? And with competition coming in, is rent as a proportion of sales going to increase?
Yeah, we have opened 21 stores in this half quarter, 21 stores. And our target is to open the 40 to 50 stores in every year. And real estate is not the problem. That is one problem is that rent is no doubt increasing from the previous year. But in tier 2, 3 and 4 cities, that is not the problem.
All right, Mr. Agarwal, thank you so much for sparing time and joining us to talk about the road ahead as well. Wish you good luck for the second half of FY25 as well. That was the management of Bazaar Style Retail. The stock seeing some bit of profit booking in today's session, now down almost 5% at 391. Time for a short break. On the other side, we'll be joined by Manas Jaiswal to give us a quick chart check. Stay tuned, back on the other side.
The consequences Iran will face for their actions will be far greater than they could ever have imagined.
The Islamic Republic of Iran has consistently pursued peace and stability for the region and called for an immediate ceasefire and the cessation of civilians' casualties, a position we have maintained for over a year. Yet, experience has proven that Israel only understands the language of force. Israel must understand that each act of aggression it makes is not unpunished and will be met with consequences.
Invest.
Back with us here on Chartbusters. Choppy as choppy can be is the market. The Nifty now back in the green, now 19-20 points higher, nearing 25,275. The Nifty Bank is also seeing some bit of recovery now, nearing that mark of 52,000 as we speak. 0.3% higher is the Nifty Bank. Remember, that is the one that has taken the bigger knock as compared to the Nifty. So the 52,000 level will be the key to watch out for, seeing a bit of a spurt in the final few minutes of this trading session right now. 150 points higher now on the Nifty Bank. What is doing well though since the morning is the IT index. The Nifty IT is the top sectoral gainer. Over 1% higher is the Nifty IT. The earnings season begins next week, starting with IT companies, of course. The 500 points gains now on the Nifty Bank, the Nifty IT, and the PSU banks. They are the ones that are leading the Nifty Bank higher, almost 1% higher now on the PSU Bank index. So some bit of recovery coming in for the markets. Good time to get in Manas Jaiswal for a chart check as well. Manas, good morning. The kind of fall that you would have seen, you would expect some bit of bounce from oversold levels, but would you use those levels to sell out of your existing longs?
Good morning. See, we have seen almost 1,000 points correction in last 5 trading sessions, and today Nifty has taken support near 50-day moving average. However, I am not recommending a buy on Nifty at current levels, but definitely I am expecting a bounce back till 25,500 on Nifty. The trend is negative, but you can see a bounce back. So I'm not going to create short at current levels. I think one should wait for a breakdown, fresh breakdown below 50-day moving average. Then only one can create short position. And even in Bank Nifty, you can see a support near 51,500. So here also, I think one should create short position in Bank Nifty only below 51,500 now.
All right, a short only before 51,500. So seems like it's a bit of a no trade zone right now. Can't go long yet, and not enough conviction to go short as well. But individual stocks, what's your call here, Manas?
So 2 buy recommendations I have right now. So first one is from pharma space. Lal PathLab is looking strong on the charts because stock has given a fresh breakout on the chart. I believe this is a flag pattern breakout. So you can see the target of around 3,600 on Lal PathLab. Take a long position here. The stop loss should be around 34.35. And second is from IT space, that is Coforge. Here also stock has given a flag pattern breakout. So one can create long position in Coforge also. Stop loss should be around 7,100 and target would be around 7,400.
All right, take that point. Thank you, Manas, for joining in. Currently, as we speak, Infosys has moved to the high point of trade from the frontline space. Tata Chemicals from the broader market is actually surging up around 5% from the lows, sitting with a gain of 2%, and has spiked to the high point of trade, and giving it company at the high point is Torrent Power as well. So Tata Chemicals doing well, Torrent Power doing well as well. Will be good to, just before we move on, pull up the intraday crisscross lines because now those lines are narrowing. We have more stocks advancing than the number of stocks declining. And there you have it. For most part of the early morning, we had a lot of stocks declining as against the number of stocks advancing. And now those lines have intertwined, and we have the lines moving divergent from each other with the green line much above the red one itself. We'll keep an eye out on this. We're still in choppy terrain, like Manas said as well. But the market decline yesterday led to investor wealth worth nearly 10 lakh crore wiping away. The Nifty registered its worst day in almost 2 months. And understanding the reasons for the fall, we spoke with Harish Krishnan, who's the co-CIO and head of equity at Aditya Birla Sun Life Mutual Fund. He believes that there is still some money moving to China. And let's hear out his view on the fall and the sectors that he likes right now.
Over the course of the last 2 quarters now, earnings have actually not gone anywhere for the broader markets in aggregate, even as markets have continued to climb up despite a poor election result, despite the capital gains tax and poor earnings print. So I guess it is some amount of normalization is what one is seeing. The second, as you rightly pointed out, is the function of what's happening in China. Year to date now, China outperforms the US, India in a surprising turn of events, right? 2 weeks ago, they were at 52-week lows. Come this week, they are at a massive 52-week high, outperforming almost all other markets. And this was a consensus sell, given various geopolitical measures and going into the US elections. And therefore, I guess some of the flow data that you spoke about, I think a lot of that has also got to do with the fact that there is some amount of serious money that is possibly going now towards China in the wake of a significant short squeeze that we've seen in Chinese market. So I think India is a low beta defensive market in the emerging markets. It typically does well when emerging markets flounder. It's like the FMCG of the emerging markets. So we think that there are 3 dark horse sectors out here from a 2-3 year point of view that we want to further add on to our positions. First is consumer durables. That's a space that we think has done quite well, but we think that there is more margin pickup story out there as a segment as a whole. Second is metals. I think we've come to a zone wherein the metal stocks have delivered quite well. The balance sheets are in very good shape. And I mean, of course, there is the Chinese stimulus angle, but even otherwise, I think that metal stocks are something where ownership levels are very low, and we would want to add on to that. The third is cement. This is a space where near-term earnings can look potentially disastrous, but this is a space where there is massive amount of consolidation happening. Again, a space where ownership levels are low, and that is something that we want to pick up into. On the sectors which were in momentum or which are in momentum and which can continue and where we want to add on and buy on dips, I would say IT would be high up on that list. We also think pharma is an area where we want to add on dips. Third would be capital goods. Fourth would be auto, and real estate selectively we would be looking at buying on dips. So these are the broad sectoral, sectors, kind of a footprint that we would want to buy on dips into this fall in anticipation of creating greater value to our unit holders.
And the money moving towards China is something that Adrian Moat spoke as well yesterday. Now moving to our special segment where we get you a few ideas. So Profit from Money Control Pro, Nitin Agarwal of moneycontrol.com joins us to talk about a stock that he's tracking very closely.
The company that I have chosen for today is Craftsman Automation Limited, which is an auto ancillary company. There are a couple of factors that make us upbeat about the company. First, its aluminium segment, which continues to show a strong momentum. In fact, in the Q1 of FY25, the company, the segment registered a growth of around 16.7% on a YOY basis, driven by increasing content per vehicle and the higher adoption of electric vehicle by OEMs. The management continues to be very optimistic about the segment, given the new emission norm and the wider adoption of electric vehicle. Secondly, the company continues to do a show a strong momentum in the industrial segment post the election as the economic activity picked up. The company registered a YOY growth of around 22.7% in Q1 of FY25. The management is optimistic in this segment as well, primarily driven by the growth that is anticipated in FMCG, pharmaceutical, and automotive segment. And the third and the last segment that the company is powertrain segment, which continues to which has moderated and shown a growth of around 8.9% in Q1 of FY25. The management continues to be very positive in this segment, given the north momentum that is being witnessed by the commercial vehicle and the construction equipment segment. Lastly, in terms of valuation, the company is currently trading around 29.4 times FY26 projected earnings, which we believe is at the fair level, and hence we advise investors to accumulate on any weakness.
All right, now the market shows some formidable recovery. The Nifty back at around 25,300. A good 50-point up move is what we are seeing from yesterday's close, but from today's low, it's a lot bigger on the up move, and it's led by the Nifty Bank. We're doing fairly okay on the Nifty Bank, up 300 points right now at the high point, and it's led by a couple of the public sector banks and a few of the private sector banks as well. Case in point, something like Axis Bank, that's the one that should come up for you. Alongside that, we have Kotak Mahindra Bank too, which is sitting with a gain of almost 0.5%. Fairly okay as far as the recovery from the lows is concerned, but then again, we're still in muddy waters. Take a short break, come back, get you more on the markets and individual stocks on the other side.
Generally, the story with geopolitical events is there are short-term impact on markets. Now, what you've then got to caveat that statement and look at more recent events, such as Russia's invasion of Ukraine, that caused quite a significant energy shock, particularly in the European community, where the price of gas went up dramatically, which hit the price of electricity. And then you had a fundamental impact which needed to be priced.
The big boy seems to have woken up right now. Just pull up HDFC Bank and ICICI Bank. HDFC Bank was muted for most part of this morning's trade, but now has moved to the high point of trade, and as a result of which we've seen a concomitant increase in both the Nifty Bank as well as the Nifty. When we went into break, the Nifty was just about 25,300. A good 30-40 point up move has come by, largely courtesy HDFC Bank as well as ICICI Bank, over and above what we've seen on the Nifty Bank already. So let's talk about HDFC Bank itself. The stocks moved to the high point of trade largely because there are expectations of MSCI-related inflows, which may be likely as the shareholding pattern for the company indicates some headroom available for this weight increase from the FIIs. Vivek joins in with the details of that one, the quantum, the expectation.
Well, that's right. So along with the quarterly update, as far as, the business was concerned, HDFC Bank also went ahead and updated its shareholding pattern. Now, one of the worries on the street was the fact that, in case the foreign holding in the stock was more than the prescribed limit or more than the limit required in order for MSCI to go ahead and increase the weight, in that case, that would have been a worry. But however, the latest shareholding pattern indicates that the foreign room is at 24.97%, indicating that there is enough headroom as far as passive funds, that will be linked to MSCI are concerned, to go ahead and increase the weight in HDFC Bank in the upcoming November review. Now, IIFL Alternative Research estimates that there could be flows of close to $1.8 billion in HDFC Bank from passive flows on account of this particular weight increase. Just to give some perspective, remember, HDFC Bank saw its weight increase in the MSCI indices after, HDFC Bank as well as HDFC Limited merged. The first tranche of the inflows came in the August review, where the flows actually came in September. Along expected lines, almost $1.8 billion of inflows is expected even in the upcoming November review. One of the reasons why HDFC Bank is doing well today.
Vivek, thanks a lot for that. And with that, we call time on this edition of Chartbusters. From Mangalam, me and the team that put this show together, thank you so much for watching.
We'll take credit for this because when we started the show, all those screens were red, and now as we end, we're leaving the markets in slightly better hands than from what we started off. So from Hormaz me, thank you for watching.
Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me, Sonal Bhutra. And I think now the bulls are getting that Friday feeling, right? There's been a phenomenal recovery in the markets in the last 45 minutes or so. The Nifty from the day's low has recovered close to about 250 points. We're now back above 25,300, up 80 points. The Sensex is inching up towards a 350-point rally. IT is leading from the front. So the top sectoral index, which is up today, is IT. The Nifty IT index is up 1.5% with names like Infosys, LTI, Mindtree, Wipro, Tech Mahindra. Across the board, buying emerging ahead of results next week. Next week on Thursday, both Tata Elxsi and TCS report their Q2 numbers. But outside of that, banks, that's where the outperformance is. So after 4 days of losses on the Nifty Bank, today you are seeing the reversal on the Nifty Bank, and the Nifty Bank is up more than 500 points from the day's low, and it's Axis Bank, Kotak Mahindra Bank, and PSU banks too are doing pretty well. In fact, the Nifty PSU banking index is outperforming the benchmark banking index, and names like Bank of Baroda, where the Q2 update, quarterly update, look good both on advances, and there's a bounce back after the sluggishness of the prior quarter. BOB is the one which is pushing PSU banks higher.
So a lot of quarter two updates, of course, which are pushing the markets higher. And this is not something which was largely expected, because we did see some flattish moves on the negative side on the markets today. But look at the recovery, 250 points from the lows of the day. And if you look at some of the sectoral movers, of course, Reema spoke about Nifty IT. We have the metal index, which is doing well again, the CPSE index that's doing well. So the likes of ONGC, you have Oil India, all these stocks in the back of higher crude oil prices, they are doing really well. So Oil India, for instance, is up around 4%. ONGC is one of the top gainers. That one is up around 2%. Mid caps and small caps, both of them doing well today. So the mid caps up 90 points, and the small cap index, that's sitting with gains of around 0.2%. So the recovery has been seen across the board, barring some of the sectors which continue to see some profit booking. But we have to talk about the financial space, because Bajaj Finance and M&M Finance also released their quarter two business updates. Abhishek has the fine print.
To begin with Bajaj Finance, the new loans are up 13.6% YOY, and they have declined by 11.7% sequentially. The customer base is up more than 20% YOY and about 4.5% sequentially. Deposit momentum has been strong, growing at 20.5% YOY and about 5.3% sequentially. However, the AUM growth, now that's one of the weakest in last many quarters. It has come in at 28.8% YOY, which is the weakest that you are seeing in last 6 quarters, and it is up 5.6% quarter on quarter, which is the weakest growth that you are seeing in last 9 quarters. Cross-sell rate that I calculate is the lowest in any Q2 of last few years, X of Q2 FY21, when the COVID had impacted the industry as a whole. So cross-sell rate has declined for them to 6.2% versus 6.5% on a YY basis, and about 7.4% in the previous quarter. With respect to M&M Finance, the disbursements have been very weak. They are down 1% YOY and up about 3.3% quarter on quarter. The assets have grown by 20.3% YOY and about 6% quarter on quarter. This suggests that disbursements to AUM ratio might be on the higher side, and that tenure might have got adjusted, due to which the AUM growth has been seen. Gross NPA has deteriorated, as gross NPA ratio is now at 3.8% versus 3.56% in the previous quarter. Liquidity has inched up to 8,500 crore, which is up about 6.25% on a sequential basis. Back to you.
So those two quarterly updates from the financial space were a bit of a miss, M&M Finance and Bajaj Finance. But HDFC Bank also came out with their quarterly update for the second quarter. Abhishek, how did the numbers look? And also the shareholding pattern has been out for the quarter of September. So does that mean the FIs have more headroom to purchase?
Well, yes, Reema, FI do have more headroom to purchase. Now, to begin with the quarterly update, it can be clearly seen that they are focused on credit deposit ratio, and deposit momentum has been very robust for them. So take a look at deposits. They are up 15% YOY and about 5.1% quarter on quarter. Time deposits over here have grown by 19.3% YOY and about 6.7% on a sequential basis, which is a strong momentum given the fact that there is fight for deposit in the system as as a whole. Now, advances have grown by just 7% YOY and 1.3% quarter-on-quarter. We have seen many news in the quarter gone by that they are, selling down or paring down their loans. So, AUM growth is at 8% YOY and about 2.3% quarter-on-quarter. Credit to deposit ratio, that's been their focus area. Now, that's down to 100.8% versus 104.5% in the previous quarter. Liquidity coverage ratio, a key metric, has improved to 127% versus 123% in the previous quarter. Now, HDFC Bank has released their September holding as well. So, FI headroom indicates that there is second tranche likely to be in the November review of MSCI. So, HDFC Bank September holding does show that foreign ownership limit is now at 55.5% versus 54.8% in the previous quarter, that is as of end of June. So, weight increase of HDFC Bank is at discussion of, index manager over there. Back to you.
Okay, all right. So that is about HDFC Bank. That stock also recovered sharply from the lows of the day, sitting with gains of around 0.2% as we speak. The other stock on our radar is Avenue Supermarts. This is under pressure following Q2 business update, which has failed to impress the street. Mangalam is joining us with the details and the analysis here. Mangalam.
Well, it's a soft quarter for DMart this time around. It's a 14% revenue growth that they've reported. The reason why a 14% number is soft is because, one, last quarter they had about 18% in terms of growth. And if you look at the second quarter itself, over the last 3 years, the 3-year compounded average has been around 16% itself. So this 14% number in terms of growth and an absolute number of almost 14,000 crores is not something that, the street is very happy about, as a result of which the stock is lower. Add to that, over the last year to now, the store addition itself has been over 12.2%. That implies that the same store sales growth is around 1 to 2% as well this quarter, and that may have a bearing on the operational performance of the company in the quarterly results that they report. In this quarter, they've added about 6 stores. The previous quarter was around 6 stores, taking the first half total store additions to 12. Remember, DMart adds the most amount of its stores in the fourth quarter. They've guided for around 40 to 50 store additions every year as well. The key thing to track now in the second quarter numbers, I would say 3. First is the gross margins, what happens with the product mix. Secondly, the pickup in their e-commerce business via QCom in DMart Ready. And the third thing would be, was this slowdown on account of any sort of technical software related change that the company was doing, and is that likely to come back or not, is the big question.
Thank you very much for that. So those were the big updates in terms of prepping you up for how the quarter might shape up for the financial and even the consumer sector. Get into a break. We'll discuss commodities on the other side. Manisha Gupta joins in. Stay tuned.
I did not underestimate Senator Vance as a slick talker. He could. But I also called out there, you can't rewrite history. You can't rewrite history. And trying to mislead us about Donald Trump's record, that's gaslighting. That's gaslighting.
Welcome back. Well, steady at those levels. Nifty is at 25,317. So at least steady above the 25,300 mark. 220 points recovery is what we are seeing from the lows. Nifty IT and the bank Nifty is the one which is leading to the gains that we are seeing. Sensex also has recovered around 733 points. Nifty IT around 750 points. And the bank Nifty, that is the one which is up around 450 points from the lows of the day. Well, it's not just the equity markets which are doing well. Crude has continued to do well. So let's talk about the commodity space. Manisha is joining in and we are focusing on crude oil prices. It's up and away here.
Oh, absolutely. If you had to name something for the commodity of the week, it absolutely is the crude oil prices. Up 5% in the overnight market. It's trading at a one-month highs, and we have seen this as a best weekly gain since Jan 2023 there. Well, the crude oil prices are still holding around that 77.5, and with that, for the month of October, we've seen the prices gain up by nearly 9%. The month of September saw prices decline by 9%. So you clearly can see on the tables have turned around in sense of buying positions being created here. You know, there are various reports, and I've been reading most of them, which suggest that if the situation in the Middle East and between Iran and Israel continues to, escalate from here on, then you are looking at a possibility of prices at 80 and beyond. For that to happen, it would be that Israel attacks Iran oil facilities, or it happens that the oil export area that Iran has, Israel makes some kind of a demolition on that. Remember, 1.8 million barrels per day of export is what Iran has done for the month of August. And then there are possibilities of Iran stopping or disrupting the flow out of Strait of Hormuz. Now, this is a very important point. One-third of Middle East, one-third of the global crude production happens in Middle East, and that does flow through Strait of Hormuz. So if that happens, you could be looking at prices running up quite strongly as well. If you look at the crude oil price range itself, last year was between 93 to 73, and that's the kind of range that we've seen in this year as well, anywhere between 91 to 70. And with prices trading at around 76 or 77 is way off the kind of highs that we have seen in this year. That is because the supplies are much higher than the demand, and actual disruption in sense of oil facilities till now has not happened. Going forward, the markets will also be looking out for the US non-farm payroll data that comes in today, and the street is keeping a keen eye on all developments from the US ahead of the presidential elections there, and the US will not want crude oil prices much higher. So it's going to be quite interesting on what we see in the next 1 month in sense of all of these factors.
Thank you very much for that. Undoubtedly, crude is the commodity of the week. Get into a break. We'll come back and discuss market technicals. Sudeep Shah from SBI Securities joins in.
The moment that really stuck out is I just asked the simplest of all questions that every single American should be able to answer. I asked him if Donald Trump lost the 2020 election. He refused to answer.
two 6-week periods during which the inflation rate has fallen. That can give a lead to cut the repo rate. Choice is between 25 basis points and 50 basis points. If you want to be cautious, we can cut 25 and store something for the next time. Or we can take front-loaded cut of deeper thing. There are two ways of creating competition in the system. One is really letting new private sector banks to come in. The other is privatize some of the nationalized banks or increase the private content in the national. We have now reached a stage in which we should really be able to get more banks in the private sector. So I would really say that let an atmosphere and environment be created where new private entities can enter.
The regulations are out. As we said, they were likely to come out today or tomorrow, and they're finally out.
Welcome back. Now, the recent FI selling has sparked off an India versus China debate. Hormus is now joining in with the latest on, and he's done some number crunching. Hormus.
You know, these last few days, the fall that we have witnessed in the Indian markets, one of the biggest factors has been the relentless selling from the FIIs in the cash markets. Yesterday was one such incident, almost $2 billion worth of selling. There have been many analysts who have come up and said that money is moving out of India into the Chinese markets, and the graphic that comes up on your screen now will be proof of that. Before going into the holiday season, the Chinese markets, the CSI 300 index, between the 18th to the 30th of September, that 9 trading sessions that they had, the index was up 27% from almost at a 52-week low, jumping to a 52-week high during this period. In contrast, over the last 4 sessions, ever since the Nifty made a record high last Thursday, since then the index is already down 4% from those levels, 1,000 points down on the Nifty, and the fall in the broader markets has been much worse. So there has been an outflow of money into the Chinese markets. But is this the start of a bull run in China and not so much in the Indian markets? Well, not many on the street are convinced about this rally in the Chinese markets, and Rajiv Jain of GQG is one of them. And he mentions very clearly that how many times in the last 3 years we have seen this excitement only for it to peter out in the months ahead. And he also mentions that if this party in the Chinese markets goes on without them, they are fine with it, and that's because Rajiv Jain in his funds have been underweight on the Chinese markets. And he said that this is a trade, a good trade at that, but is it investable for a 3, 4, 5 year period? That is questionable. Citi came out with a note and they mentioned that the CSI 300, as I just highlighted, was up almost 30% during this session. Multiple policy announcements that were supportive of this rally in China, but this recent outperformance has made sure that the Chinese markets have caught up with India in terms of performance. But in the Indian markets, the strong macro outlook and the flows from domestic investors will ensure that the markets remain resilient going forward as well. And Gavekal Research also came out with a view. They said that even if this China rally sustains, many foreign investors are reluctant and they remain reluctant to invest there, and the headwinds in China will become tailwinds for the Indian markets going forward. And although they put in a caveat saying that while these foreign investors may find better value in terms of a lot of other emerging markets compared to India, but it is too early to call time on India's bull market.
Okay, so too early to call on time for India's bull market. Thank you so much, Hormus, for joining us with all those important details. In fact, we spoke to a whole host of experts on what they make of this India versus China debate. Here's what they have to say.
What we've seen so far is a commendable delivery on the monetary policy side. We've seen some direct stimulus at getting the equity market animal spirits back alive, and certainly the retail investor has followed through on that. What will differentiate this one is if in the next weeks and months we get some clarity from the Chinese government, from the key policymakers in the Politburo, as to the magnitude and the scale and the deployment of a large fiscal package. Because let's remember, I mean, China's single biggest problem that it faces at the moment is immense oversupply on the real estate side. And you need a sizable fiscal package aimed squarely at local governments.
Actually, I don't think it's a bad thing if China market does well for us, as in mostly for India. It is not bad for India per se. I don't think that beyond some shorter term thing, investors have to sell India to buy China. Because India, I don't think in aggregate, people are overweight. There might be 1% plus minus overweight. So if you were underweight China, that would have come from the rest of the world. India and China, even an emerging market fund combined would be, say, 20 and 25, 26 now. So half the investment of people who are able to move this around is in non-India, non-China.
Even though flows to India funds have definitely waned, they haven't gone negative, and I think India remains in quite a healthy position. It looks to me, at least from this week, that investors were pulling money out of liquidity funds in Europe to fuel this rotation.
All right, those are some expert opinions coming in on that India versus China debate. We'll keep getting you more updates on this one, but it's a good time to get a technical check on the market. Sudeep Shah from SBI Securities is joining in for just that. Sudeep, good morning. Thank you so much for joining in. A sharp recovery from the lows. Will we see higher levels from here on? Sudeep, I think you're on mute.
Yeah, good morning, Sonal. Absolutely. Now, post this 4% fall in the last 3 sessions that we have witnessed in case of Nifty, index has taken support at this crucial zone of 25,000, 25,100 band. And now this rebound is giving us signals that, yes, there could be some additional, say, move in the next couple of days, at least till Monday or Tuesday. And we could rebound back till 25,500, 25,550, given the fact that IT, pharma, metals, all these 3 sectors are showing good traction on the upside. And the real issue is coming with Bank Nifty here. 52 350, 52 500 band could act as a stiff resistance. So for the entire market to be into a rebound mode, we feel 52 500 on Bank Nifty will be the key from here on, and that will determine the entire medium-term trend from the current levels.
Hi, Sudeep. Morning. What about stocks? Any stocks that you have on your radar that you would recommend?
Yeah, a couple of them now. The first one is from the IT pack. We've seen a good recovery in the IT stocks from lower levels. Like last couple of days, there was some profit booking. But yes, for today, there's a good recovery. And Infosys is our top pick at 1935, 1940 currently. We feel that the stock in the last 6 to 7 sessions has consolidated enough and is trading at a decent level compared to what it was a couple of weeks earlier. And the daily, weekly and the monthly charts are suggesting that we could see a stable up move from the current levels. So till the time 1900 is held, we feel that this stock could move up to 2000 levels. So we can buy this with a 1900 stop loss for a 2000 target on the upside. The second stock that I have on my radar is MCX. Now, even this stock is in a long-term uptrend. Last few sessions where the markets have corrected from higher levels, this has relatively outperformed 5,700, 5,680. This zone has acted as a strong base. And today also we are seeing a good buying support from the lower levels. So I feel this outperformance could continue here. And this can be bought with a stop loss of 5,800 on the downside for a target of 6,100, 6,150 in a short to medium term time span.
Okay, all right. Thank you so much for joining in and have a great weekend ahead. Looks like so far it's been a good Friday for the bulls, but we'll slip into a short break. Up next, we'll discuss the market fundamentals with Puneet Sharma from White Space Alpha. Stay tuned for that conversation.
They're largely in line with expectations. So in July, SEBI had proposed 7 things. 6 out of the 7 actually have been implemented with very minor changes. So I'll start with what is going to be top of mind. Number 1, higher lot size value. This is going to be effective from the 20th of November. Basically, for index derivatives, which is Nifty, Bank Nifty, and other index derivatives, at the time of introduction, the SEBI is saying that the contract value should be between 15 and 20 lakhs at the time of introduction. At least 15 and up to 20. That is number 1. This is a simple and clean measure to limit the number of people who are able to trade this, trade index derivatives. Number 2, and I think a lot of interest around this, only 1 weekly option contract per exchange. This is also effective from the 20th of November. Remember, right now, NSE has weekly contracts, weekly option contracts on the Nifty, the Bank Nifty, the Mid-Cap Index, and the Fin Nifty as well. BSE right now offers weekly contracts on the Sensex and the BankX. NSE now will have to choose 1. They'll have to drop 3. Only 1, and that too a benchmark contract. So most likely they'll have to decide whether to keep a Nifty weekly option contract or a Bank Nifty weekly option contract. Similarly, the BSE will have to choose between the Sensex and the BankX. The benchmark is the Sensex, so most likely BSE will offer the Sensex weekly option contract. So I think this is the one which I think is going to dominate headlines and market participants, most impacted exchanges, brokers, everybody most impacted from this one. Number 3, intraday positioning, monitoring of position limits. This is effective from the 1st of April 2025. Currently, position limits are monitored on an end-of-day basis. Now, this is to be done on an intraday basis. Remember, the limit which was set, I think in 2020 during COVID period, was 500 crores based on notional value of trades. So this was monitored, but at the end of the day, now they're saying it has to be done on an intraday basis. Lots of feedback in terms of how this is going to be finally implemented. There is time, as I said, only effective from the 1st of April 25. Number 4, increase in tail risk coverage on the day of options expiry, effective November 20th. Basically, if you are carrying a position or if you take a position on the day of expiry, all existing positions on the day of expiry, old and new, will attract an extra ELM, which is extreme loss margin of sting.
Welcome back. You're still tuned into Trading Hour. Well, good contribution coming in from the IT pack and the Bank Nifty as well. So Nifty continues to trade higher as we speak. So it's a good time to talk about fundamentals of the market. Puneet Sharma from Whitespace Alpha joins us now to discuss the fundamentals and also some of the top sectoral bets. Puneet, good morning. Thank you so much for joining in today. We saw that big fall yesterday. Now we are talking about a recovery. We have this China versus India debate as well. What is your take on the Indian markets right now? Any sectors that you are liking in particular?
Good morning. Thank you for having me here. So in terms of the market currently, what is happening in the market? Obviously, after the large fall yesterday, it's good to see that the market is actually recovering a little bit today. In terms of fundamentals of the market, I think it's still a very strong bet that we have on the India story. In the long term, the India market is expected to deliver between 12 to 15%, and that's what we are banking on. Obviously, there will be small variations in the market on a day-to-day basis, on a week-to-week basis, but that's something that the investors in the equity market should not really be too worried about in the short term. In the long term, as long as they're picking up stocks which are fundamentally secure and participating in industries which are fundamentally on a very robust platform, they should be okay in terms of the returns that they're hoping to make out of that investment.
Okay, so as far as it's the long-term take on markets, it's fine when it comes to Indian markets as well. So which are these long-term bets for you, Puneet? Where are you looking at investing? Or do you think there could be more correction which is needed and that is when you would like to put in your money?
So currently, obviously, the market has been at a very significant bull run. So it is at a high, it is at the PEs, which have probably been closer to the all-time highs of the Nifty 50. So is there a good buying opportunity at the moment right now? I don't think so. There could be a further correction in the market, especially given what's happening in the rest of the world, including what's happening in the Middle East right now. So if there is an escalation in the war, there is escalation in the crude prices as well, it could provide a lot more opportunities for investors to get into the market and invest in the equity. Will there be sectors specific to benefit out of all what's happening in the market and the expected rate cuts, which are on the anvil now? There will be, obviously, banking is something that we are very bullish on. IT is, again, a sector that I think is going to do well in the long term. It's showing some small green shoots right now. I would expect IT sector to do pretty well in the decently medium to long term.
Okay, IT sector is one which you would expect to do well in medium to long term. Is there any place where you're waiting for a correction, Puneet? IT, of course, has run up a little and the consensus is that it could continue to grow from here on or see returns, better returns from here on. Is there any place where you think is good in terms of growth, but valuations are not supportive at these levels?
Right now, I think FMCG is a sector that I would probably categorize into this category where we would want to see a little more correction happening, especially given that the demand scenario right now in the FMCG side is not that great. From whatever that we are hearing from the market, the demand of products in the FMCG sector, especially companies like HUL, ITC, Dabur, Britannia, etc., they're not as strong as they were expected to be. With the rates cut coming in, probably these sectors will become more lucrative. But as of now, I would expect them to face a little bit more heat in the market, have a bit more of a correction before we start entering into these sectors.
Okay. We have this big China versus India debate which is going on. I just wanted to understand, one, if you would look at any of these international markets, and two, if China would be one of them, because we've already seen a 27% rally before there was this long holiday in the Chinese markets. Do you think this is the start of the bull rally that everyone's been talking about?
There have been numerous bull rallies which have happened in the Chinese market in the past 1.5 years or probably about 2 years odd. So ever since they opened after the 2022 COVID pandemic that was ravaging through the country in China, I think there were times when the market suddenly ramped up, but it's not really been a sustained rally in the Chinese market. So I'm not really certain that this is going to be another sustained rally in the Chinese market right now. It's just a reflection of what's happening in terms of the regulatory changes and the support from the government which has come in. The stimulus package is going to run out after a little while. So the economy needs to catch up in order for this kind of a growth in the Chinese market to be consistent. And if there are indications that the economy in China is going to be robust enough for such a growth to happen, then yeah, investments in the Chinese market, especially on the real estate side, are pretty risky at the moment. So we'd be more of a wait and watch. Although in our fund, we are very focused on the India market. So our expectation is that the Nifty 50, that's the bellwether, that's the index that we are focused on, and expect that index to deliver the kind of returns that we want to deliver to our investors.
Okay. You know, one of your strategies is the momentum strategy. It does work in times. It must have worked a lot because the last few years or the last few quarters were very good on the upside. But do you think this is something that would work now as well? Because now it could be very volatile from an index perspective.
Right. We call that strategy our momentum strategy, but we are very neutral to the market overall. So we will have positions in the derivative market on either side of where the market is. Trying to make a small amount of money if there is a movement in the market on either direction. So.
Okay. All right.
But yeah, I mean, it's very dependent upon how the market is and the liquidity available.
All right. Take that point, Puneet. Thank you so much for joining in today with your take and the outlook on the Indian markets and the sectors that you like as well. Time for a short break now. Pankaj Naik from India Ratings and Research will join in next to discuss the recent report on unsecured business loans and how there have been some delinquencies there. Stay tuned.
So this is number 4. Number 5 and number 6 are pretty straightforward. Number 5 is upfront option premium, effective 1st of February 2025. And number 6, removing the expiry day calendar spread benefit, which is also going to be effective from the 1st of February. So I think these are the 6 changes which SEBI's implemented, largely in line with expectations. But I think the lot size increase and the fact that SEBI's limiting weekly options contracts to 1 per exchange will attract maximum amount of discussion and debate in terms of what this does for market volumes, exchange volumes, and what this does to market intermediaries as well. Back to you.
Right, Prashant, very quickly before I let you go, you know, a lot of comments coming in, a lot of questions and queries coming in from the viewers as well on our social media handles asking about the impact and the implications. You know, just in the near term, from a market perspective, you've probably been speaking with experts. What's the impact likely to be on the markets when we open tomorrow?
You know, Shireen, so through the course of the day, we spoke with lots of market participants. Markets are prepared for this. I mean, you know, we put out the story in the morning that this is to be expected very soon, that this is imminent. There was some expectation in some quarters, and we had clarified yesterday as well that this was not to come up along with the board meeting. And we said that, well, this is going to come soon this morning. So I think this is widely advertised. And the fact that what has been done is largely in line, actually mostly in line with what was proposed in July, I think does not come as a shock or a surprise. And also the important point is this is being done in a phased manner. It's not as if everything is being implemented by the end of the month or from a certain date. I mean, you know, there's November 20th, there is April 1st, there is February 1st, all the way into 2025. I think that also kind of eases the impact a little bit.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy?
Welcome back. There's a pretty decent rebound which is underway. It's just that there hasn't been follow-up buying in the last 1 hour. The rebound took place between about 10:30 and 11, and after that, markets have been largely stable around 25,300. But after yesterday's 2% fall, at least there is a green tick, and banks, that's the big segment in the market which is doing pretty well. Now, yesterday's market decline, though, has got people a bit nervous because the investor wealth which got eroded was nearly 10 lakh crore rupees. The Nifty also had registered its worst day in more than 2 months. Now, to understand the reasons behind the fall and what is the opportunity in this chaos and volatility, we spoke with Harish Krishnan, co-CIO and head of equity at Aditya Birla Sun Life Mutual Fund. And he believes there is serious money moving to China. Listen in.
Over the course of the last 2 quarters now, earnings have actually not gone anywhere. For the broader markets in aggregate, even as markets have continued to climb up despite a poor election result, despite the capital gains tax and poor earnings trend. So I guess it is some amount of normalization is what one is seeing. The second, as you rightly pointed out, is the function of what's happening in China. Year to date now, China outperforms the US, India in a surprising turn of events, right? 2 weeks ago, they were at 52-week lows. Come this week, they are at a massive 52-week high, outperforming almost all other markets. And this was a consensus sell, given various geopolitical measures and going into the US elections. And therefore, I guess some of the flow data that you spoke about, I think a lot of that has also got to do with the fact that there is some amount of serious money that is possibly going now towards China in the wake of a significant short squeeze that we've seen in Chinese market. So I think India is a low beta defensive market in the emerging markets. It typically does well when emerging markets flounder. It's like the FMCG of the emerging markets. So we think that there are 3 dark horse sectors out here from a 2-3 year point of view that we want to further add on to our positions. First is consumer durables. That's a space that we think has done quite well, but we think that there is more margin pickup story out there as a segment as a whole. Second is metals. I think we've come to a zone wherein the metal stocks have delivered quite well. The balance sheets are in very good shape. And I mean, of course, there is the Chinese stimulus angle, but even otherwise, I think that metal stocks are something where ownership levels are very low, and we would want to add on to that. The third is cement. This is a space where near-term earnings can look potentially disastrous, but this is a space where there is massive amount of consolidation happening. Again, a space where ownership levels are low, and that is something that we want to pick up into. On the sectors which were in momentum or which are in momentum and which can continue and where we want to add on and buy on dips, I would say IT would be high up on that list. We also think pharma is an area where we want to add on dips. Third would be capital goods. Fourth would be auto, and real estate selectively we would be looking at buying on dips. So these are the broad sectoral, sectors, kind of a footprint that we would want to buy on dips into this fall in anticipation of creating greater value to our unit holders.
All right, that's a market opinion coming in. But with that, we'll slip into a short break. As we do that, here's some good news for our viewers. India's business news leaders now click away, introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store.
Insights into their businesses from top Indian honchos before putting your money on the line. How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajaj at these times on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18, an unending pursuit for excellence. A pioneer, a leader, a visionary, building a lasting legacy of credibility, consistency, and trust. Giving unparalleled access to global thought leaders and powering conversations that are shaping the new world order. Setting the highest standards through exemplary leadership. It is this unrivaled reputation for the most comprehensive coverage, actionable intelligence, and in-depth reporting that make CNBC TV18 India's #1 business news brand. Foreseeing change, growth and transformation for over a quarter of a century. Trendsetters crafting innovative content formats. And award-winning business journalism. On air, online, on social media. As we embark upon 25 years of excellence, we invite you to be a part of our future. CNBC TV18, your trusted partner and investment ally.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC TV18 and CNBC-TV18.com. CNBC TV18's most
Welcome back. You're still tuned into Trading Hour, and in its latest report, India Ratings and Research has noted that unsecured business loans are showing early signs of stress in asset quality. They believe this comes on the back of increasing competitive intensity, pressure on cash flows, and a lot more other reasons. There is a need to recognize the rising delinquencies. To discuss this and more, we are joined by Pankaj Nayak, the director at India Ratings and Research. Mr. Nayak, good morning. Thank you so much for joining in. Well, can you give us a sense of what are the early indicators that are suggesting that there could be pressure and there could be early signs of stress in the unsecured business loans?
Right. So, I mean, we have been tracking this segment for quite some time, and in our outlook for FY25, we did mention that this particular segment will see some kind of a stress because of some over-leveraging on the borrower side and also because of strain on the cash flows at the borrower's end. Some bit of aggressive lending by the NBFCs also is responsible for this kind of stress. So the early signs that we are seeing right now is basically incremental delinquencies have gone up, the write-offs have gone up, and the credit cost that is hitting the P&L has also started impacting the profitability. So I think these are early signs which we are seeing right now as far as the business loan balance sheets are concerned.
So Pankaj, you've laid out the reasons why we are seeing increased stress. But could you quantify the extent of the problem in the market right now?
Sure. So these business loan balance sheets or the P&L are designed in a manner that they have to absorb a certain level of credit cost. But we are seeing credit costs which have crossed that particular band. So the credit cost is in a range of around more than 5%, 6% odd. Now, more than 5 to 6% odd credit cost, which includes your write-offs as well as your provisioning, starts hitting your pre-provision operating profit buffers. And that actually impacts your profitability. And in many cases, the P&L ends in a loss. So that's the kind of impact which we are seeing on the P&L of unsecured business loan players.
And we already saw signs of that in the quarter gone by, in Q1. Many companies we spoke to, referred to the problem that you're talking about, this stress in unsecured lending. Has it become worse in the July, August, September? What is anecdotal evidence telling you about the recent months, the current months?
Right. So what happens is generally Q1 is a very lull quarter. Not a lot of balance sheet growth happens in Q1, because of which the top line doesn't grow, right? So whenever the balance sheet doesn't expand, all these problems start coming to the surface. And that's what we are seeing right now as far as the unsecured business loan is concerned, because a lot of income is getting generated by disbursing these loans by way of processing fee. So when you don't generate that income, obviously your top line is weak and the credit cost starts impinging on your P&L.
Pankaj, you said there is continuing pressure on cash flows in certain end user segments. Which are these segments where we are seeing the most amount of pressure, and is there any particular geography where we are seeing the most amount of pressure?
Well, the segments like food segment, textile segment, these are some of the segments that have come to our observation where we see elevated amount of stress. And if you talk about geography, then there is no one particular geography per se where we are, kind of observing this particular stress. It is geography agnostic, because there are quite a few fintechs which are doing this particular business. They don't have a branch-based model. I mean, they do it digitally. So a geography cannot be highlighted where these problems exist.
And how much higher are the credit costs in Q2 versus Q1?
Sorry, Q2 numbers are still not out, but the Q1 number looks very, very elevated as compared to, say, an FY24 number. So 3 to 4% credit cost has now basically gone into 5 to 6% kind of a trajectory.
And is there any, kind of a geographical, analysis to be made? Are there any particular, markets where we are seeing increased stress?
Well, there is no geographical trend per se, but it is more or less a pan-India phenomenon. And more or less, these entities generally, which are fintech players, they operate digitally. So, I mean, they themselves are geographically agnostic, when they do their lending. Sure. It's purely based on cash flow analysis and the basic data that they can procure digitally.
So because, this, the issue that you're highlighting, there will also be an impact on the growth under assets under management. The AUM growth will also get impacted. So what was the anticipated AUM growth earlier? And because of this stress, the fact that provisioning is now going up, what could be the decline?
Yeah. So these balance sheets were growing at a considerable pace. I mean, it was easily around 30, 40, 50% kind of growth that was visible as far as the unsecured business loan segment is concerned. Now, of course, that growth was happening on a much, much lower base. But if I look at the Q1 numbers, then a Q1 balance sheet size vis-a-vis, say, a March balance sheet size, it's flattish. It didn't grow much. Now, yeah, one may argue that Q1 is any which way is a lull quarter, and that's why there was no expansion. But it is also because of cautiousness practiced by the lenders, funding non-availability probably because of which the loan book did not grow, asset quality pressure which they are themselves seeing, which told them that they have to go slightly slow on that. So AUM growth definitely has taken a beating.
So AUM growth has taken a beating. What about capital buffers? Are they also impacted because of this? And what happens to the return on asset because of this? Is this something that could be a cause of worry going forward?
Yeah. So thankfully, the capital buffers are in a very, very reasonable band. All of them are operating in a leverage band of around 2 to 3 times, which is kind of an okay leverage given the retail nature of the balance sheet. But if I have to look at the AUM growth that has taken a beating, the return on assets under management, and here we have to typically talk about return on assets under management rather than return on assets, because a lot of business is generated through the off-balance sheet route. So the ROAUM, the return on assets under management, has actually become very, very flattish. So a blue sky scenario probably would generate a ROAUM of 2 to 3%. That is less than 1% now. Some of the balance sheets or some of the P&Ls are actually in the red. So on a console basis or on an industry basis, this is in a single-digit ROAUM band.
Okay. Last question before we let you go, Pankaj. You also spoke about some competition coming in for the segment. Where is it coming in from? Is it at an early stage, or we are somewhere in the middle and it's a little difficult for the institutions to get out of it?
Right. So repo rate started going up from May 22, right? It went up by 250 basis points odd. Now to maintain margins, NBFCs who are not doing unsecured also started doing unsecured lending, because that was the only way to protect margins, right? So because of which what happened is there was a lot of lending that happened in FY23, FY24, and these were the fiscals where there was a lot of pent-up demand because the previous fiscals were impacted by COVID. So FY23 and FY24 saw a lot of revival in demand that happened, because of which there was a lot of lending that took place, not just by the pure unsecured business loan players, but also by other traditional NBFCs who were not doing unsecured, but were only in secured products. So because of this, there was a lot of competition and heating up in the market. A borrower was spoiled for choices, because of which the over-leveraging also happened at the borrower's end.
Okay, we leave the conversation here. Pankaj, thank you very much for joining in. By the way, the Nifty is now pushing towards 25,400 and the Sensex has extended its gain to more than 500 points. So things are looking up. Stay with us. Halftime report will be up after this short break.
Award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
Let me be clear. Israel will defend itself. We will act.
Israel has no intention to pursue peace or a ceasefire.
The consequences Iran will face for their actions will be far greater than they could ever have imagined.
The Islamic Republic of Iran has consistently pursued peace and stability for the region and called for an immediate ceasefire and the cessation of civilians' casualties, a position we have maintained for over a year. Yet, experience has proven that Israel only understands the language of force. Israel must understand that each act of aggression it makes it's not unpunished and will be met with consequences.
Stocks bounce after a weak open, even as uncertainty looms over the possible escalation of the Israel-Iran conflict, the strength of a China recovery and the outcome of the US election. IT and financials eke out gains, even as realty and utilities drag.
Business updates on top of lenders. We have HDFC Bank, Bajaj Finance, Bajaj Housing Finance and Bank of Baroda reporting their numbers. Mahindra Finance as well. All of them together put a mixed picture. Even as retailer Avenue Supermarts reports weaker than expected sales growth, the stocks take cue.
Crude prices scale to a 5-month high as fears of Iran supplies being impacted and disruption in movement on oil via the Strait of Hormuz fuel concerns. This even as the demand-supply balance remains comfortable.
Market mavens caution on China. They say that they'd like to see its stimulus translate into economic indicators like property prices. They also point to previous bear market rallies in China that fizzled out, even as they remain bullish on India.
CNBC-TV18 Citizens MPC votes by a majority of 4-1 that RBI will not cut rates in the upcoming policy on 9th of October. But a majority of 3 out of 5 vote that RBI must change its stance to neutral.
A very good afternoon. You're watching Halftime Report on CNBC TV18. I'm Ekta Batra and with me is Manglam Malu. Well, it's turning out to be a session where we are seeing some amount of recovery which has taken place for the market. So that's definitely good going. And predominantly, the recovery has come in from the financials. The Bank Nifty, the last I checked, was up over 500 odd points from the day's low. So there's definitely some amount of recovery and buying which is taking place at lower levels, always heartening after a strong session of selling that we've seen. But the one thing that we need to watch for, and which we've been talking about ad nauseum, is the FII figures. For example, FII sold that big, huge level of around 15,000 odd crores in yesterday's trading session. But just in the past 4 sessions, they've sold over 30,000 odd crores. What is positive is that the DIIs have absorbed it in terms of buying, but nonetheless, we need to track what the FIIs do from here on and whether this kind of selling intensifies. As of now, good going for the markets. We've recovered, even the Nifty above 25,400.
Take that point, Ekta. You know, the Nifty is recovered above 25,400. What's important is the way the mid-cap index has moved as well. If you look at just those crisscross lines, you know, for a brief period in the morning, you had way more stocks advancing, way more stocks declining than the number of stocks which are advancing, to the tune of almost 1,500 stocks lower versus about 500-600 stocks which were higher. And now that has, after some bit of consolidation intertwining, that's now reversed entirely. We have 1,500 stocks which are advancing for about 900 stocks which are declining. So this is a trend that we'll watch out for in the second half of trade in particular. And also the answer to the question, whether this is a bounce of the lows from yesterday from oversold zones, or maybe we've made a formidable bottom. All of that we will get to know in just the next couple of hours, and more importantly, over the news that comes through the weekend as well. But the thing that is really worrisome is the FII selling that has sparked off an India versus China debate, largely because of the outperformance that Chinese markets, despite being shut for the last 2 or 3 trading sessions, has been. You know, over the last 1 month, the Nifty has underperformed the Chinese indices. So are funds going in from India towards China or not? Hormaz joins in with the latest on the flows. Hormaz.
You know, these last few days, the fall that we have witnessed in the Indian markets, one of the biggest factors has been the relentless selling from the FIIs in the cash markets. Yesterday was one such incident, almost $2 billion worth of selling. There have been many analysts who have come up and said that money is moving out of India into the Chinese markets, and the graphic that comes up on your screen now will be proof of that. Before going into the holiday season, the Chinese markets, the CSI 300 index, between the 18th to the 30th of September, that 9 trading sessions that they had, the index was up 27% from almost at a 52-week low, jumping to a 52-week high during this period. In contrast, over the last 4 sessions, ever since the Nifty made a record high last Thursday, since then the index is already down 4% from those levels, 1,000 points down on the Nifty, and the fall in the broader markets has been much worse. So there has been an outflow of money into the Chinese markets. But is this the start of a bull run in China and not so much in the Indian markets? Well, not many on the street are convinced about this rally in the Chinese markets, and Rajiv Jain of GQG is one of them. And he mentions very clearly that how many times in the last 3 years we have seen this excitement only for it to peter out in the months ahead. And he also mentions that if this party in the Chinese markets goes on without them, they are fine with it, and that's because Rajiv Jain in his funds have been underweight on the Chinese markets. And he said that this is a trade, a good trade at that, but is it investable for a 3, 4, 5 year period? That is questionable. Citi came out with a note and they mentioned that the CSI 300, as I just highlighted, was up almost 30% during this session. Multiple policy announcements that were supportive of this rally in China, but this recent outperformance has made sure that the Chinese markets have caught up with India in terms of performance. But in the Indian markets, the strong macro outlook and the flows from domestic investors will ensure that the markets remain resilient going forward as well. And Gavekal Research also came out with a view. They said that even if this China rally sustains, many foreign investors are reluctant, and they remain reluctant to invest there, and the headwinds in China will become tailwinds for the Indian markets going forward. And although they put in a caveat saying that while these foreign investors may find better value in terms of a lot of other emerging markets compared to India, but it is too early to call time on India's bull market.
Okay, all right, Hormuz, thanks very much for that. So that's the update coming in on the FII picture. But we did speak to a whole host of experts on what they make of this India versus China debate. Here's what they had to say.
What we've seen so far is a commendable delivery on the monetary policy side. We've seen some direct stimulus at getting the equity market animal spirits back alive, and certainly the retail investor has followed through on that. What will differentiate this one is if in the next weeks and months we get some clarity from the Chinese government, from the key policymakers in the Politburo, as to the magnitude and the scale and the deployment of a large fiscal package. Because let's remember, I mean, China's single biggest problem that it faces at the moment is immense oversupply on the real estate side. And you need a sizable fiscal package aimed squarely at local governments to be able to digest that. In other words, buy it off developers and turn it into social housing projects.
Actually, I don't think it's a bad thing if China market does well for us, as in mostly for India. It is not bad for India per se. I don't think that beyond some shorter term thing, investors have to sell India to buy China. Because India, I don't think in aggregate, people are overweight. There might be 1% plus minus overweight. So if you were underweight China, that would have come from the rest of the world. India and China, even an emerging market fund combined would be, say, 20 and 25, 26 now. So half the investment of people who are able to move this around is in non-India, non-China.
Even though flows to India funds have definitely waned, they haven't gone negative, and I think India remains in quite a healthy position. It looks to me, at least from this week, that investors were pulling money out of liquidity funds in Europe to fuel this rotation.
Right, interesting opinion coming in from across the board on India versus China, whether China's outperformance could lead to some flows going out of India into China, or is China's outperformance due itself, or is that just a tactical bounce that people are seeing? Whatever that may be, we will know once the Chinese markets open once again. But for now, we've seen some recovery. Nifty closing in towards that 200-point gain mark in today's trading session so far itself. The Nifty Bank moving towards that 500-point gain. All of this versus yesterday's close. From the lows, it's a lot larger in terms of gains. We're at the high point. Take a short break, come back, put focus on a lot of the other stocks which are on our radar. Avenue Supermarts trades under pressure following a weak second quarter business update.
generally the story with geopolitical events is there a short-term impact on markets. Now, what you've then got to caveat that statement and look at more recent events, such as Russia's invasion of Ukraine, that caused quite a significant energy shock, particularly in the European.
Welcome back. The Nifty is now up 200 points. Nifty Bank 500 points. Good recovery is underway. Let's see whether this sustains or not. A couple of stocks, however, underperforming or under pressure. One of them is Avenue Supermarts. That's largely because, you know, the second quarter update has failed to impress the street. What exactly has happened is the company's revenue growth in the second quarter, the standalone revenue growth has come in at around 14%. The number that they've reported is close to 14,050 odd crores. That's below street expectations, largely because of two things. One is that the last 3 years CAGR for the revenue growth has been close to around 16%. In the first quarter as well, the revenue growth was 18%. So maybe the street thought that that would sustain this time around, and that hasn't, as a result of which we've seen some weakness. Secondly, the company's added 6 stores in this quarter. For the first half, it's about 12 stores. And if you look at the last 4 quarters itself, the overall store addition is close to around 12.2%. So the revenue growth of 14% and store addition of 12.2% implies that the same store sales growth is just about 1.5 odd percent, which again is lower than street expectations itself. What we need to understand from here on when the company reports their numbers is how the product mix has performed, and as a result of which gross margins. And secondly, the performance of their Q-commerce business, which is DMart Ready, is something we will track very closely, because Neville Narona in an interview to CNBC-TV18 had highlighted this trend about 5-6 months ago itself. And finally, we'll also watch out for whether there was a one-off technical glitch where the company was looking to update some of its software, etc., to grow or be ready in time for the festive season, and that has impacted sales in the second quarter or not. So those are a couple of factors. We'll be watching that later.
Okay, all right, Manglam, thanks very much for that. So yes, pressured for Avenue Supermarts today, and it was pressured for Dabur in terms of their Q2 update as well. Well, as of now, we need to take a short break, but here's some good news for you viewers. India Business Leaders News Leader is now just a click away, introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates just at your fingertips. Download the CNBC-TV18 app now from the Google Store or the Google Play Store.
Where the price of gas went up dramatically, which hit the price of electricity. And then you had a fundamental impact which needed to be priced in. I think the issue with crude oil is that it's a very fungible asset, an easily moved asset. It's not like gas, which requires pipes, degasification if you're using LNG. So I think you probably might see a temporary spike in the oil price as the fundamental factor here, even if this is to escalate a bit further.
Welcome back. It's a 350-point recovery from the lows for the Nifty, almost 650 points for the Nifty Bank as well. Near 200 points is the gain that we're seeing on the Nifty on an absolute basis at the high point of trade. So perfect time to get you up to speed with all that's happening in the F&O space itself. So look at the frontline indices, all of them doing well, showing signs of recovery. But in that, the mid-cap index is a bit of an underperformer in the sense that it's not gaining as much as the other frontline indices, but it did not fall as much as the other frontline indices as well. What's important is that today's low coincides with the 50-day moving average on both the Nifty as well as the Nifty Bank. Today's low on the Nifty close to 25,094, the 50-day moving average just about 70 points below that. Same is the case for the Nifty Bank. Today's low 51,643. 100 points lower is the 50-day moving average. So the first test of the 50-day moving average is something that the market has seen support towards. But now with the recovery that we've seen, the active option on the Nifty is the 25,000 put. Maybe the street believes that, this would be a mark where we would sustainably see some sort of support coming in. But on the way up, call writers at the 25,300 mark are still fairly active. So 25,300 has about 8 lakh call writers today with a premium of 300 rupees, telling you levels upwards of 25,500 to 25,600 would continue to face some supply. Why do I say that? Apart from the options, we also have the 20-day moving average out there. So the Nifty 20-day moving average is at 25,508, and the same for the Nifty Bank is 52,560. Both of them are about 70 points away for the Nifty and about 200 points away for the Nifty Bank itself. So now that we bounce back from the 50-day moving average, can we cross above that 20-day moving average or not is the big question we'll get an answer to. GNFC is one of the stocks that I'm watching out for among the others, because this one may enter F&O ban given the sort of open interest action that we've seen on that stock, Ekta.
Okay, all right, Manglam. Thanks very much for that. We have Apurva Sheth, who's the head of research at Samco Securities, joining in to discuss the technicals of the market now. Apurva, hi, welcome to the show. Well, it's a session where we are seeing a bounce back. We're building on gains. We're seeing those lows come off for our markets today. In that context, what would your approach be?
Hi, thank you for inviting me on the show. So we are expecting that the level of 25,000, which is a psychological mark and also a previous high, should act as a good support for the markets. So from here on, let's see whether the bounce back sustains. So on the upside, 25,640 and 25,800. These two are levels to look out for as resistances. These were the gaps, the gap levels where the Nifty had formed gaps. And apart from that, for Bank Nifty, I think there's a good rising trend line which is taking the Bank Nifty along right from January 2024. So Bank Nifty is also in a steady uptrend, and this is like a correction. So as of now, the structure is still positive, and we are looking for this as a buy on dips kind of a market, and the targets would remain for Nifty to 26,000 and for Bank Nifty for 54,000 levels. However, from the stocks front, we would like to follow a slightly defensive approach and go with pharma or FMCG names. So on the stocks front, first pick is Eris Life Sciences. So the stock is bouncing back nicely from 50-day exponential moving average. The support is around 1280 levels, and yesterday it witnessed a bulk deal. So there's volume and there's price action also, which is suggesting that the stock could head higher. So the stop loss would be 1250 and the target would be 1500. And another stock is Parag Milk Foods. So it has moved contrary to what the market has done in the last 5 sessions. So all 5 days it has moved higher, and the structure is quite bullish. Over the last 2-3 months, it has formed a good base, and it's forming a double bottom pattern and heading higher. So the target for Parag Milk Foods would be 230 with a stop loss of 200.
All right. Thanks a lot for that. Individual stocks and the indices for your recommendations. Wish you a good weekend, Apurva. Take a short break. Come back on the other side. A very interesting discussion lined up for you. The India's urban consumption boom, all live events, concerts, etc. We have Deepak Chaudhary, who is the founder, EMD at EVA Live, musician Salim Merchant, and Roshan Abbas as well, founder at Commune and Compass. Join in.
I did not underestimate Senator Vance as a slick talker. He could. But I also called out there, you can't rewrite history. You can't rewrite history. And trying to mislead us about Donald Trump's record, that's gaslighting. That's gaslighting.
Welcome back. Well, good news is that the bank Nifty is picked up. It's up around 455 odd points at this point in time, showing a gain of almost around 1%. So good going currently for the bank Nifty. Maybe there's some amount of positive rubber from the likes of Bank of Baroda, which came in with a good update with regards to Q2 when it came to advances. That stock is up around 4 odd %, and that's probably the sentiment is probably rubbed off on the banking stocks today. So as you can see, the index itself is up around 0.8% at this point in time. It's recovered over 500 points from the day's low. But nonetheless, let's shift focus to something which has been making a lot of news in the past couple of weeks, the recent craze over concerts, may it be Diljit Dosanjh, Dua Lipa, and obviously Coldplay's upcoming concert, which has displayed the spending shift and the spending power of urban India. The young are spending more on events, concerts, travel, experiences. But Manglam, gold prices are still going up. That aside,
Gold, Zomato Gold, and all the golden passes at all the concerts. That's exactly what's happening. That's telling you about, the spending shift. And at the same time, also the value fashion retailers are struggling, whereas everyone else is doing extremely well. It speaks about this shift that we're seeing as well towards events, travel, luxury goods, fashion, electronics, all of them. There were people queuing up for the iPhone 16 even as they ordered it on their quick commerce apps as well. And this is exactly what, brokerages believe as well. This morning, there was a CLSA note saying that on urban consumption, there were almost 1 million people waiting in queue for tickets priced between $50 to $400. That's really 6,000 rupees to about, 35,000 rupees for Coldplay. Major concerts, including the likes of Diljit Dosanjh, Dua Lipa, Bryan Adams, sold over 250,000 tickets rapidly. Ticket sale prices, resale prices have actually surged past 5 times the original price as well. And concerts alone, if you just look at the average ticket price selling and the number of tickets which have been sold, generated over 350 to 400 crores in terms of revenue this year so far, which is almost 40% of the listed QSRs or quick service restaurants incremental sales. So that is a shift that we're witnessing in urban consumption. How one plays that and what the future for this looks like is something very crucial to track, largely because we also saw an experience, led surge in World Cup and IPL, a lot of these sporting events as well, which saw a fair amount of surge. So we do have, a bunch of concerts. We spoke about Diljit Dosanjh, Bryan Adams, Dua Lipa. You have recent favorites like Karan Aujla and AP Dhillon performing in multiple cities in Mumbai as well. And then, of course, all of that leading up to the big Coldplay event. And globally as well, we've seen this phenomenon with Swifties, all the Taylor Swift fans going all over, wherever Taylor Swift performs. Coldplay is performing, maybe we'll see something from, Taylor Swift, given the sort of discretionary spends that India has as well. So that is setting that up for you. Let's discuss more on the future of events and how they should be conducted in India and what the structure of this industry looks like going forward. We have, quite a panel for you. We have Deepak Chaudhary, who's the founder and MD at EVA Life. We have Salim Merchant, the musician, and we also have with us Roshan Abbas, who's the founder at Commune and Compass. Roshan, let's start with you. I mean, what, according to you, is the potential size of the events market in India, and what will this structure be? Because on the one hand, you have a lot of people buying or queuing up for passes for some of these headline events, but then there are a lot of events that happen which don't sell as many passes. In fact, they go in losses as well. So what is this structure likely to be and the size?
Thank you. So honestly, I think it's great times for the event business and the concert business. Largely, our businesses are divided into various segments. So corporate events has always been the steady, money earner, which just keeps agencies going. But over the last 10, 15 years, the 2-3 areas that have really, really grown. One, of course, is the social event sector, which is weddings, because as you know, our country is crazy about them. And that is considered to be the largest pie in the entire event business. But the surge post-pandemic actually is a 3x surge of what's happening with ticketed events, essentially. We've already created now both at one level the technology, though of course we still need a lot of work in infrastructure because there are just not enough venues to actually handle the demand which is going on. I presume that this is going to add at least 3,000 crores to this market over the next 2-3 years. Of course, if infrastructure, government bodies, everyone supports this business, and this is purely the concerts business that I'm talking about in India. But if you look at ticketed events, when you said that there are ticketed events that actually end up with halls that are not fulfilled, it's actually, when we carry together legacy events from the past, the audience is changing. Their top 3 or 4 focus areas are comedy, music, sports, Bollywood. These have always been great areas. Comedy being the one which has just got added recently over the last couple of years. People like Zakir Khan, Veer Das, etc., filling stadiums, many stadiums. They're doing 3,000 to 7,000 people in auditoriums themselves. What is still lagging behind a little is the legacy events, which were classical concerts, etc., which used to happen. Theatre also is actually seeing a little bit of a resurgence, but this audience is the one big change is earlier we would buy tickets extremely early, which we will still do for top-end concerts. But our weekend purchase is extremely last minute. So you'll find people, organizers having many heart attacks just before an event because they don't know. But, suddenly you'll find that 70% spend is happening in the last week. This is for smaller events where the discretion is left to the very last minute. And that's when young audiences are voting with their wallet. So that's largely the space.
Okay. All right. Well, that's an interesting statistic coming in. 3x surge in ticketing events post-COVID. That's the word coming in from Roshan. Salim, I wanted to get you into this conversation as well. We have 6 big concerts coming up from December up till Jan 21st, which is basically, ending with Coldplay. According to you, which ones will probably be the most biggest money spinners? And which ones will probably see the maximum amount of revenue potential?
I think the Coldplay one is really, has really made a lot of buzz. 3 concerts to sell out like this, I mean, it's kind of weird. But then I am not surprised because, Coldplay has millions of fans and we are like 1.6 billion people in India. Every 6th guy on the planet is essentially Indian. So you can understand how many, what's the potential of this country's market. It's huge. And I mean, my plight is that, if
I think
we've lost that connection. Maybe we can toss that over to Deepak as well. Deepak, we have the likes of Bryan Adams, Diljit Dosanjh, Dua Lipa, AP Dhillon, Coldplay, all of these concerts coming up. According to you, how much do you think each event can probably make on an average?
Okay, so we've seen these days now. I think we've taken some time to get here.
Right, I think we're not very lucky with the bandwidth so far. I hope these concerts go pretty smoothly, unlike the conversation that we're having right now. We'll go back to Salim in just a bit. But Salim, like you said, actually we do have Salim back with us. Salim, you said that Coldplay has a lot of fans. The ticket sales and all of that are showing you this. But why do you think the organizers are getting flack for this? Many are disgruntled. Over 10 lakh people in the queue. Capacity is just about 1.5 lakh. Is there anything that Book My Show could have done better? Is the queuing system that they have similar to global standards? I mean, has there been a fair ask from, or has there been a fair representation from Book My Show's end here?
Well, absolutely. I think they've done a great job. We used to just have this in our dreams that, I hope we can see a Coldplay in our lives or, like an Ed Sheeran or a Dua Lipa in our lives. And they're making our dreams come true. They're making it possible. And they've done everything, great. I mean, having 3 concerts is not easy, the logistics nightmare, the nightmares that they have to face. But they made it happen. I mean, but like I said, India's 1.6 billion people. We should have possibly had 6 to 8 concerts. Like when Coldplay goes to America, they have so many concerts, in Chicago, in Los Angeles, in New York, in Houston and whatever. And India is 1.6 billion people. We need definitely need more concerts. They've done everything right. You know, there's 4 tickets per person. I mean, just like any international standards, and you really can't stop these resale sites from doing this. But as a fan and as a as a composer, as a musician, as an artist, I would not go and buy these tickets from resale sites, because I've been in a problem once when I went to see a Taylor Swift concert. I bought a ticket. I bought 3 tickets, and they were not the same tickets as I was promised on the resale sites. So legally, I think because Book My Show is the only legal site, I wouldn't go and buy a ticket from a resale site. It's because there's no surety that it's going to be the right ticket.
And but a lot of people still want tickets, and a lot of people haven't gotten tickets. So maybe they're looking to get inside that stadium by hook or crook. What we'll do is we'll take a short break, come back, we'll continue our discussion on this very exciting topic. Stay with us.
The moment that really stuck out is I just asked the simplest of all questions that every single American should be able to answer. I asked him if Donald Trump lost the 2020 election. He refused to answer.
Two 6-week periods during which the inflation rate has fallen, that can give a lead to cut the repo rate. Choice is between 25 basis points and 50 basis points. If you want to be cautious, we can cut 25.
Welcome back. Well, you're still tuned into the discussion with regards to concerts, how big they are in terms of money spinners. So let's continue that conversation with our guest. Deepak, over to you. If you could give us a sense in terms of how much these 6 concerts which are coming up could probably potentially make on an average, and how much can we probably generate in terms of revenue?
Okay, I'm going to go give a little background and where Roshan mentioned that what was happening pre-pandemic. And so it's taken us some time to get here. There are reasons why we've reached here. From giving the habit of transactions have changed, habit of consume. This is a new consumer. Okay, so it's actually that change has added to the overall growth. Now, when we saw Karan Aujla announcing one show and it went sold out, and then they announced a second show and then the third show, averagely more than 13,000 tickets were sold per show. Okay, and then they announced more cities. So 100,000 tickets have at an average of let's say around 5,000 bucks at an average Karan Aujla is sold. So more than 50 crore a number Karan Aujla himself is doing. Diljit Dosanjh has, when they got let's say HDFC Pixel to sponsor, they thought HDFC thought, what are they doing? But they realized they actually registered more than 100,000 cards. And how it happened that the only ticket was bought through an HDFC ecosystem. Now, in that whole thing, more than 100,000 tickets of Diljit Dosanjh have been sold in 10 plus cities, and 3 more cities are getting announced. Now, and at an average again of 8 to 9,000, so more than 100 crore worth tickets have been sold for Diljit itself. Yeah, and if it can keep going. AP Dillon is in the process. Coldplay numbers we all know. More than 150,000 people are getting there in Coldplay in 3 cities, and Ahmedabad is getting announced soon, what I hear. And it'll do 250,000 people, and we know the maths, what's going on. I'm doing Brian Adams India Tour. Brian Adams India Tour is coming with 70 cities in India, and I've sold out most of my cities, and only Hyderabad is little short of sales. Yeah, so that's where the numbers are.
All right. Thank you for the numbers. Just a final word, Roshan. You know, Salim did allude to this reselling and people not buying from reselling platforms, etc. In the wake of all of this, Zomato has come up with a buy now, sell later option. Is that, in a way, you know, nudging people towards scalping or reselling these tickets? Because technically, black marketing of tickets is illegal.
No, absolutely. I think, see, the idea is that today when you go and book a ticket, sometimes for a fixed price on an airline by paying a little bit of an advance, etc., or sometimes you're blocking your space, and there are definitely a certain amount of people who are then not able to make it to a concert. There are changes that happen. It's an impulse buy that you bought. You realize you're in a different city. You're not finding many other things to happen, which is why this is an attempt to try and see that. Because I also know very clearly that there is the limit has been set in terms of pricing. International scalping is anything goes. I mean, just as what Salim was saying, there were tickets for Taylor Swift, I remember towards the end, which were a ticket for £100 was going for £1,500. I mean, 15x the price was a very average kind of thing that was going on. So that a couple of these, what Zomato, etc., are trying. See, we only have 2 ticketing apps largely at the moment. There'll be Zomato, which will be rebranded very soon, and you had Insider, which they've already purchased on one side. Between these 2, the attempt to build a larger market size to see what this audience's appetite is. I don't think it's an attempt towards looking at saying, hey, you know, is this a way of making more revenue? I feel that sometimes we're sort of just booking a place for the future. Just as you said, the queuing system that's used in India, which BookMyShow was using, is the same one used at Taylor Swift. Nobody anticipates, you know, the number of people, 15 million people coming in for 150,000 tickets. But really, you know, honestly, I think the focus needs to shift a little bit more on what is the government doing to support this infrastructure, because there is obviously 18% tax on each of these tickets. That is a huge earning. If 3,000 crores is going to come into the kitty, that's money. There are jobs. There are over 1 million jobs that the event fraternity adds to India. These are jobs that young people love. And
all right, Roshan.
Hate, I suddenly was a little worried about. Sorry.
All right, Roshan, you know, we have to sort of end this conversation at this point in time because there's a little bit of volatility which is seeping in back into the markets. So Deepak, Salim, as well as Roshan, thank you very much for joining in and speaking with us and taking us through that. Well, for the markets, yes, there is some amount of volatility which has come in. So the Nifty has given up gains of around 200 odd points from the top. The Nifty Bank has given up over 500 points in terms of gains. So it's completely flattened out, and you can see that on the screen. Maybe the European markets have something to do with it. So maybe the European market should come up for you. The CAC we last checked was trading in the red, which is the French market. So just about lower by around 0.1%. Let's see how things progress. As of now, it seems as though there is some amount of volatility which has come back. The mid-cap index also given up a lot of the recovery that we saw, down around 5 odd points. Bank Nifty is the key culprit again. There's a rapid sell-off which has taken place in the Bank Nifty just in the past couple of minutes.
Absolutely. You know, that was always the worry. The rally that we saw from the lows today, will that be sustainable or not, was the big question. And maybe at higher levels, there is this supply coming in. We're still on sketchy ground. So what we'll do is take a short break, come back.
Just before that, I just want to point out that the India VIX as well You know, that Manglam is up around 5% at this point as well. Just to put it into perspective, it's up around 15.5% this week. Year to date, it's still down around 4.7%, but week to date, it's up around 15% and it's up around 5% at this point. So just keep your eye out on the India VIX as well.
We will most definitely watch out for that. Take a short break, come back. On the other side, we will talk about the markets once again. The mid-cap index has now slipped back into the red with the advanced decline favoring declines. We'll also keep an eye out on all things commodities because that's one of the reasons why there is so much volatility in the market as well. Manisha Gupta joins in with Peter McGuire.
Store something for the next time, or we can take front-loaded cut of deeper thing. There are two ways of creating competition in the system. One is really letting new private sector banks to come in. The other is privatize some of the nationalized banks or increase the private content in the United States. We have now reached a stage in which we should really be able to get more banks in the private sector. So I would really say that let an atmosphere and environment be created where new private entities can enter.
The regulations are out. As we said, they were likely to come out today or tomorrow, and they're finally out. And I have to say, they're largely in line with expectations. So in July, SEBI had proposed 7 things. 6 out of the 7 actually have been implemented with very minor changes. So I'll start with what is going to be top of mind. Number 1, higher lot size value. This is going to be effective from the 20th of November. Basically, for index derivatives, which is Nifty, Bank Nifty, and other index derivatives, at the time of introduction, the SEBI is saying that the contract value should be between 15 and 20 lakhs at the time of introduction. At least 15 and up to 20. That is number 1. This is a simple and clean measure to limit the number of people who are able to trade this, trade index derivatives. Number 2, and I think a lot of interest around this, only 1 weekly option contract per exchange. This is also effective from the 20th of November. Remember, right now, NSE has weekly option contracts on the Nifty, the Bank Nifty, the Mid-Cap Index, and the Fin Nifty as well. BSE right now offers weekly contracts on the Sensex and the BankX. NSE now will have to choose 1. They'll have to drop 3. Only 1, and that too a benchmark contract. So most likely they'll have to decide whether to keep a Nifty weekly option contract or a Bank Nifty weekly option contract. Similarly, the BSE will have to choose between the Sensex and the BankX. The benchmark is the Sensex, so most likely BSE will offer the Sensex weekly option contract. So I think this is the one which I think is going to dominate headlines and market participants, most impacted exchanges, brokers, everybody most impacted from this one. Number 3, intraday positioning, monitoring of position limits. This is effective from the 1st of April 2025. Currently, position limits are monitored on an end-of-day basis. Now, this is to be done on an intraday basis. Remember, the limit which was set, I think in 2020 during COVID period, was 500 crores based on notional value of trades. So this was monitored, but at the end of the day, now they're saying it has to be done on an intraday basis. Lots of feedback in terms of how this is going to be finally implemented. There is time, as I said, only effective from the 1st of April 25. Number 4, increase in tail risk coverage on the day of options expiry, effective November 20th. Basically, if you are carrying a position or if you take a position on the day of expiry, all existing positions on the day of expiry, old and new, will attract an extra ELM, which is investment.
Welcome back. Joining us on the show now is Peter McQuarrie. He's CEO at Exim Australia. Peter, hi. And it's been crazy since the month of October started with what's happening between Iran and Israel and the way the crude oil prices have reacted. Almost 8 to 9% up in this week itself. Now the street is waiting for some kind of a retaliation perhaps coming in from Israel on Iran. How are you looking at the markets as we get into the weekend? Would you hold long positions? What are you anticipating?
Well, good afternoon, Manisha. I think a couple of things. First off, it surprised everyone in the sense how quickly this has ratcheted up. We're up 8% this week, 5%, big move yesterday. And the overall theme is, how would you be short? So I think you'd have to stack positions at the moment if you're a trader, that is. You've probably been enjoying the last couple of bucks as far as movement. There could be a few more dollars. We've got New York open in a few hours' time, 6 or 7 hours. And I feel as though that will probably capture a few more, maybe another $1.50, $2 higher for WTI. We'll just see what happens, and then what happens naturally over the weekend if there was to be any retaliatory action from Israel.
Peter, if there is a retaliation from Israel on Iran oil facilities, what kind of a premium would we see on markets then?
Well, Manisha, you've got so many different choke points. First off, how severe was it? Citigroup are saying 1.5 million barrels a day. That'd be stripped out of the market immediately if it was a severe one. If it was just minor, you'd be looking to 300 to 450,000 barrels. So there's the first part. So that impacts naturally supply. Then if you got 35% of the globe's crude traveling through the Persian Gulf, they would naturally have some major issues there. So that's going to impact supply, and then that would cripple demand. So, Manisha, you know, if this was to ratchet up heavily, you could throw $20, $30 on it or more, you know, that because it's a war premium, and it just depends on how severe this is.
Well, absolutely. Peter, just let's take a step back. And when we did see Russia-Ukraine conflict begin, we did see crude prices go all the way to 120. But in the same year, the closing came at around in 80s and 90s. I get your point. These are war premiums. And we could see that kind of an impact coming for the prices. But given the fact you also have the U.S. presidential elections just a month away, how would U.S. look at the crude prices moving like that?
Well, Manisha, it'll naturally impact inflation. There's something that, you know, I don't think the American voters naturally want to see. And what Biden has come out, President Biden said he may go to the defense of Israel. And this is going to be very interesting from a geopolitical standpoint, because you've got Iran's allies are going to be Russia and China, and how that impacts US. So that's not a good sign at all. What impact did it have naturally to energy markets, gold, and of course to equity markets and US dollar leading into an election? So this could be a very, very dynamic, you know, next month as this plays out. This is very unusual, and it's hard to speculate on how far this could ratchet up.
Oh, well, yes. So, Peter, would you say that a long-term view on crude at this point in time cannot be taken? Would you also advise investors not to keep positions open as we head into this weekend? I mean, how should you treat this?
Well, I think you've got to be very mindful, Manisha, because, you know, you could see whipsawing, and, you know, if you're stacking big positions, be very mindful of that, because that's from a, you know, risk management perspective. You've got to know what your risk tolerance is. So there's the first part. And whipsawing won't be unusual. Though markets can gap, and they can gap up $6 or $8 if you get a strike or something happens over the weekend, then all of a sudden you get that, you know, Monday morning, and it's just, you know, absolute off to the races. So, yeah, be very careful from stacking positions, be prudent. And there's always next week, because you've seen big moves this week. I'm not going to say you won't see again big moves next week.
Oh, well, yes, as uncertain as it gets. Peter, thank you so much as always joining us and analyzing the kind of moves that we can see perhaps in case of crude oil prices. As Peter says, if something does happen, then $6 to $8 of a jump up is not ruled out. And if Strait of Hormuz comes into picture, then, well, yes, we are looking at much more higher prices in crude from here on. But with that, it's a wrap on Halftime Report. Stay tuned in, because after the break, Business Lunch takes all the action forward.
Of 2%. So this is number 4. Number 5 and number 6 are pretty straightforward. Number 5 is upfront option premium, effective 1st of February 2025. And number 6, removing the expiry day calendar spread benefit, which is also going to be effective from the 1st of February. So I think these are the 6 changes which SEBI has implemented, largely in line with expectations. But I think the lot size increase and the fact that SEBI is limiting weekly options contracts to 1 per exchange will attract maximum amount of discussion and debate in terms of what this does for market volumes, exchange volumes, and what this does to market intermediaries as well. Back to you.
Right, Prashant, very quickly before I let you go, a lot of comments coming in, a lot of questions and queries coming in from the viewers as well on our social media handles asking about the impact and the implications. Just in the near term, from a market perspective, you've probably been speaking with experts. What's the impact likely to be on the markets when we open tomorrow?
Shireen, so through the course of the day, we spoke with lots of market participants. Markets are prepared for this. I mean, we put out the story in the morning that this is to be expected very soon, that this is imminent. There was some expectation in some quarters, and we had clarified yesterday as well that this was not to come up along with the board meeting. And we said that, well, this is going to come soon this morning. So I think this is widely advertised. And the fact that what has been done is largely in line, actually mostly in line with what was proposed in July, I think does not come as a shock or a surprise. And also the important point is this is being done in a phased manner. It's not as if everything is being implemented by the end of the month or from a certain date. I mean, there's November 20th, there is April 1st, there is February 1st, all the way into 2025. I think that also kind of eases the impact a little bit.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajaj at these times on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18, an unending pursuit for excellence. A pioneer.
Market erases morning gains as key indices come sharply off the highs of the day. Uncertainty looms over the possible escalation of the Israel-Iran conflict, the strength of a China recovery and the outcome of the US elections. IT and financials continue to eke out some gains even as realty and utilities are the big drags.
Business updates of top lenders: HDFC Bank, Bajaj Finance, Bajaj Housing Finance, Bank of Baroda and Mahindra Finance paint a mixed picture. Even as retailer Avenue Supermart reports a weaker than expected sales, the stock takes cue.
Crude oil prices scaled to a 5-month high as fears of Iran supplies being impacted and disruption in movement of oil via the Strait of Hormuz fuel concerns, and this even as the demand-supply balance remains comfortable.
Market mavens caution on the China rally say they did like to see stimulus translate into economic indicators like property prices. They point to previous bear market rallies in the China that fizzled out even as they remain bullish on India.
CNBC-TV18 Citizen MPC votes by a majority of 4-1 that the RBI will not cut rates in the upcoming policy on the 9th of October, but a majority of 3 out of the 5 votes that RBI must change its stance to neutral. Good afternoon, you're watching Business Lunch here on CNBC-TV18. Vinny Motiwala is with me this Friday afternoon, and what a reversal we have seen from the highs of the day. It looked like it was a good afternoon for the markets, but the last 10 minutes don't look like that.
Absolutely. I was all prepared to say it's a very good afternoon. I was like, we've seen that recovery. Happy Friday. But seems like that's really not the case. Whether you look at Nifty, Sensex, mid-cap, small-cap, all of them seen a sharp fall. Look at the red above us, right? I think we are almost in those shades of red, but that is, we're twinning with the shade on the screen as well. Not anything exciting coming in. Those tensions in West Asia is something that continues to
That remains a big overhang, right? And the Nifty too now down to the lowest point of the day. It was once briefly slipped below that mark of 25,100 as well. 350 points off the highs of the day. Well on course now for the worst week of 2024 is the Nifty. Until close of yesterday, the Nifty was down 3.5%. Add another 0.5% fall to that. But the picture on the screen, the 0.5% fall is not significant. What's significant is what has come off the highs of the day. Pull up the Nifty Bank as well. And that is the principal culprit that is leading this fall on the index. There's 650 points off the highs of the day is the Nifty Bank. Now 51,700 is where the index is. And the two major constituents of that as well, HDFC Bank and ICICI Bank, two very important levels to track on both of these names. 1643 is the level on HDFC Bank and 1236 is the level on ICICI Bank. If they go below those levels, they would have given up all the gains that they made in that rally starting the 11th of September. The index heavyweights, Reliance Industries as well, of course, leading the fall as well. The index heavyweights, these three have led the fall in yesterday's session as well, and they are doing the same in today's session as well. PSU Banks, IT still in the green, but significantly off the highs of the day.
Yeah, that's some bit of a respite there, at least some bit of a green today that we are seeing coming in only from those PSU banks and IT. But Nifty Realty, that's among a top laggard as well. So, you know, when any of the realty names that you pull up as well, whether a Godrej Properties, that's down and out, 4% decline that we're seeing, DLF, even something like Asoba, Prestige, all of them down. So Nifty Realty also is clearly seeing some bit of a pressure to take trade. A lot of individual names in terms of on the back of news flow also are seeing a fall. Let's pull up Ola Electric in terms of the discounting that they announced, especially for the festive season. That's keeping the stock under pressure, though recovered from the day's lowest point. At one point of down, it was down more than 2%. Now just down almost 1% in trade. EPAC Durables, keep an eye on that. M&M Financials, DMart, all those Q1 updates, surely that is something that is keeping the stocks also a bit under pressure. Obviously, global tensions that continues to impact the market. But what's also something that we should be watching out for, Urmas, is those FII selling numbers. Yesterday's number was quite high in terms, after a very long time, I think I saw such a high number on the screen. And that is sparking off a tension between, you know, China making that recovery, India. Now, where is that going to go, the tug of war? What is it that you're picking up, and, you know, what are we watching out here?
The sell figure yesterday was the highest in 4 years. So that was a big number that came in, almost 15,000 crore. Well over 15,000 crore was the number that came in. And this FII selling, the money moving out of India into the Chinese markets has been this overhang, one of the key triggers for this fall in the market as well, this relentless selling that has come in from the FIIs. And many experts have come on our channel. They've mentioned this as well. Adrian Movat was saying this as well yesterday about money moving out of India into China. 15,243 crore was that sell figure yesterday. And there is the graphic that comes up on your screen. There you see, before heading into that holiday weekend which China is on currently, the benchmark index there was up 27% in 9 trading sessions. Almost 900 points is where it had surged from a 52-week low to a 52-week high in just 9 sessions was the Chinese market. And that shows the kind of push that the FIIs have had. In the same time, when the Nifty had made its peak until close of yesterday, it was down 4%. Add some more to that after today's fall. But of course, a lot of these, and that's the contrast that you're seeing between the Indian and the Chinese markets. Now, what has happened here is, even despite this rally that you're seeing in China, not many are convinced about this. Rajiv Jain of GQG is one of them. He also mentioned that there have been many such instances in the past, but these rallies have not lasted in the Chinese market. So, well, this may be a good trading opportunity. Whether it is a 3, 4, 5-year investment is a question mark. That remains so. Citi came out with a note. They also mentioned that this rally, this outperformance has led to Chinese equities catching up with the Indian markets. But this strong macro growth, the domestic flows that India has, that remains, and that will continue to drive the Indian markets and the growth there as well. And lastly, Gavekal Research came out with a view as well. They said that even if this rally in China sustains, even then many foreign investors remain reluctant to invest over there. The headwinds in China will be tailwinds for the Indian markets, and the big thing that they say is that it is too early to say that the bull market is over in India. And lastly, a very big view that came in from a billionaire investor, Stanley Druckenmiller. He said that he has no interest in China as long as Xi Jinping is running the country. He made these remarks a couple of days ago at a conference. So all in all, the China rally continues, but there are still skeptics of this rally as to whether this will last.
Absolutely. I think one point you made also is the domestic inflows. That's quite interesting because yesterday also the domestic inflows, DI has managed to make up to that number there. So yes, interesting to watch out for. But we spoke to a whole host of experts on this point as well, India versus China. What are their thoughts on that? Listen in.
What we've seen so far is a commendable delivery on the monetary policy side. We've seen some direct stimulus at getting the equity market animal spirits back alive, and certainly the retail investor has followed through on that. What will differentiate this one is if in the next weeks and months we get some clarity from the Chinese government, from the key policymakers in the Politburo as to the magnitude and the scale and the deployment of a large fiscal package. Because let's remember, I mean, China's single biggest problem that it faces at the moment is immense oversupply on the real estate side. And you need a sizable fiscal package aimed squarely at local governments to be able to digest that. In other words, buy it off developers and turn it into social housing projects.
Actually, I don't think it's a bad thing if China market does well for us, as in mostly for India. It is not bad for India per se. I don't think that beyond some shorter term thing, investors have to sell India to buy China. Because India, I don't think in aggregate, people are overweight. There might be 1% plus minus overweight. So if you were underweight China, that would have come from the rest of the world. India and China, even an emerging market fund combined would be, say, 20 and 25, 26 now. So half the investment of people who are able to move this around is in non-India, non-China.
Some expert opinion there on the India versus China debate, but a key sector that triggered this market fall just a few minutes ago was the FMCG index, and you can pull up that. Now it's down to the lowest point of the day, 1.5% lower is the Nifty FMCG, and almost every index constituent, HUL, ITC, Nestle, Britannia, all of them have seen very sharp falls from the highs of the day. HUL down 1.5%, recovering slightly from the lows. ITC almost down 2% from the lows. Nestle is down 2%, and all of these FMCG names are leading the losses on the index, and that has triggered the fall as well. Now moving on, then, the government is committed to reducing the fiscal deficit, and estimated further decline to 4.9% in FY25. That's the word coming in from Finance Minister Nirmala Sitharaman, who was addressing the audience at the Kautilya Economic Conclave. She also added that they have a sustained policy focusing on India's banking sector. Listen in.
Our government continues to uphold its commitment to reducing the fiscal deficit, aided by buoyant revenue generation, restrained revenue expenditure growth, and healthy economic activity. The fiscal deficit is estimated to decline further from 5.6% of GDP in FY24, I'm basing on provisional actuals, to 4.9% in FY25. The decline in commodity prices has facilitated the lowering of the budget allocation for subsidies on fertilizer and fuel. The soundness and resilience of India's banking sector have been underpinned by sustained policy focus on asset quality improvements, enhanced provisioning for bad loans, sustained capital adequacy, and a rise in profitability. NPA ratios are at a multi-year low, and banks have now efficient debt recovery mechanisms, ensuring that the financial system stays healthy and the cycle lasts longer is another of our core policy priorities.
India is closely watching global developments, but the government is not unduly worried even as markets face a spillover impact. That's the word coming in from a government official speaking to CNBC-TV18 Sapna Das. Sapna is joining in with us to give us more details on what she's picking up, what is the chat she had. Sapna?
Well, it's fairly known that, the Indian economy and the markets are like fairly integrated with the rest of the world. So there is bound to be some spillover effect or rather impact of the global developments at the moment. And there are many of them, so to speak, like for instance, the US Fed rate cut followed by the China stimulus, signs of recovery in the Japanese economy, and then you have the heightened escalation of conflict in the Middle East. So all of these pulls and pushes are definitely having some spillover impact as far as the Indian markets and economy is concerned. But the important point here is that the government is not unduly worried by these developments. They seem to be indicating that the Indian economy is fairly resilient, and going forward that resilience needs to be strengthened, or rather needs to be kept strengthening further. Having said that, one area where, of course, the economy is slightly vulnerable are the crude oil prices. But here again, government officials are indicating that, the current volatility in the prices are nowhere near what India has seen in the past, like, breaching $90-95 odd a barrel, even crossing $100 a barrel. So in the past also, the government has taken measures to handle that kind of volatility and, bring some relief to the common consumers, so to speak. So those tools are always there at the government's end to deal with such volatility. But the important point is that that level is nowhere to be seen as of now. Going forward, in terms of building resilience for the economy, and this is something the finance minister has also echoed, is basically one of the big tools in the hands of the government, and that's what they're doing very clearly, is sticking to the fiscal consolidation roadmap. 4.9% is what the government is aiming for this year. According to them, this leaves enough leg room for private capital to come forward and invest. So all in all, at the moment, nothing to be unduly worried about. The spillover impact is kind of natural. But going forward, the resilience in the economy, the kind of buffer that we're talking about, they need to be kept getting built in.
Sapna, thanks a lot for that update. Take a short break here on Business Lunch. Continue with our coverage of the markets and more stock-specific action on the other side. Stay tuned. We'll be right back.
A leader, a visionary, building a lasting legacy of credibility, consistency, and trust. Giving unparalleled access to global thought leaders and powering conversations that are shaping the new world order. Setting the highest standards through exemplary leadership. It is this unrivaled reputation for the most comprehensive coverage, actionable intelligence, and in-depth reporting that makes CNBC-TV18 India's #1 business news brand. Foreseeing change, growth, and transformation for over a quarter of a century. Trendsetters crafting innovative content formats. And award-winning business journalism. On air, online, on social media. As we embark upon 25 years of excellence, we invite you to be a part of our future. CNBC TV18, your trusted partner and investment ally.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. only on CNBC TV18 and CNBC-TV18.com. CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
Let me be clear. Israel will defend itself. We will act. Israel has no intention to pursuing peace or a ceasefire.
Investing.
Welcome back. You're watching Business Lunch on CNBC TV18. Let's move on and talk about Sachin Bansal, who founded Navi Finserv. Their FY24 annual results point to rising pressure in the fintech world, especially in the leading businesses. And that has also drawn the attention of regulator RBI. Abhishek Kothari is joining in with us to give us the key takeaways from the number. Abhishek, good afternoon.
Good afternoon. So let's take a look at Navi's FY24 numbers, which have come out, and they show a strong growth in disbursals by 27% YOY and AUM, that is asset under management, by 26% YOY. But these mask the real problems. Now, interest income on these loans are down 12% YOY, and that has impacted the net interest income as well. Despite the fact that we are in a high interest rate scenario or better yield scenario, these numbers actually optically look very weak. The net interest income is also down sharply. The credit costs have risen sharply as reflected in the provisions, which have increased by 25% YOY on account of the fact that slippages have increased more than 55% in absolute value on a YOY basis. Now, gross NPA has risen by 38% YOY. The net NPA has declined on a YOY basis, suggesting that there might be mighty write-off which has been taken into account for the net NPA to decline while gross NPA is rising. So employee expenses have also increased sharply, have declined sharply by 50%. This isn't usual for a business. Now, net profit number, if you take a look, optically looks good as it has increased more than 2x, but this includes a one-off or a sale of proceeds that they have from the stake sale in their subsidiary. The question that this raises is about the health of other fintechs and the possibility of some accidents down the road. Back to you.
Abhishek, thanks a lot for that. Some stress coming in there from the fintech space. Time for a short break. Up next, we get you all that you need to know ahead of polling that begins in the state of Haryana starting tomorrow. Back on the other side. Stay tuned.
The consequences Iran will face for their actions will be far greater than they could ever have imagined. The Islamic Republic of Iran has consistently pursued peace and stability for the region and called for an immediate ceasefire and the cessation of civilians' casualties, a position we have maintained for over a year. Yet, experience has proven that Israel only understands the language of force. Israel must understand that each act of aggression it makes, it's not unpunished and will be met with consequences.
Investing.
Welcome back. The state of Haryana will go to polls tomorrow, and what is the first state election since the NDA government was sworn in for its third term? Abhimanyu is here to tell us all that you need to know for the polls.
Haryana will be the first state to go to polls after the NDA 3.0 government took over. Now, the BJP and the Congress are pitted against each other in a direct fight in the state, which traditionally has elected people from the Congress party or from the INLD. The BJP, of course, came to power for the first time 10 years back, and the BJP is looking to retain power for the third time consecutively on the back of PM Modi's popularity and on the work which has been done courtesy the government schemes. On the other hand, the Congress is looking to wrest power and is going to possibly look to get back into power after a decade-long drought in the state. The Congress is charged up after winning 5 out of 10 Lok Sabha seats in the recent Lok Sabha election. Also, they are looking to gain from anti-incumbency from the BJP. The BJP, on the other hand, has already replaced several of its previous candidates to battle anti-incumbency, whereas the Congress is looking to garner votes not just on anti-incumbency but also on several other issues like unemployment, the protests against Agniveer scheme, and the issues pertaining to farmers who had earlier resorted to protests a few years back. It remains to be seen how the situation is going to pan out, even as several other parties like the Aam Aadmi Party, the JJP and the INLD are also contesting and may play the role of a kingmaker in case of a hung assembly.
Thank you so much for that, Abhimanyu. But with that, we're absolutely out of time on this edition of Business Lunch. It's a goodbye from Hormaz, myself, as well as the team who put this show together. But markets clearly in the red at the day's lowest point. Don't go anywhere. Midcap Radar up next.
generally the story with geopolitical events is there are short-term impact on markets. Now, what you've then got to caveat that statement and look at more recent events, such as Russia's invasion of Ukraine, that caused quite a significant energy shock, particularly in the European community, where the price of gas went up dramatically, which hit the price of electricity. And then you had a fundamental impact which needed to be priced in. I think the issue with crude oil is that it's a very fungible asset, an easily moved asset. It's not like gas, which requires pipes, degasification if you're using LNG. So I think you probably might see a temporary spike in the oil price as the fundamental factor here, even if this is to escalate a bit further.
Good afternoon. Welcome to Midcap Radar. I'm Sonal Bhutra. With me is Vivek Iyer. A very volatile markets is something that we are dealing with. The Nifty is off around 400 points from the day's high. Almost at the day's low actually right now at the 25,084 mark. So we'll have to see whether we sustain at the 25,000 mark or not. The Bank Nifty down around 600 points from the highs of the day. And there was this sudden fall after that sudden surge that we saw. Something that was not expected, but looks like volatility could continue.
The only thing that's moving up is the volatility index. No, that's the only thing that's moving up this Friday. Very, very sharp and a volatile trading session. You did see a 1,000-point recovery now after the gap down opening. But again, the Bank Nifty is once again back down closer to the day's lowest point. But quite a lot lined up on the show. Let's start off with the top headlines. Volatile day for the markets even as uncertainty looms over the possible escalation of the Israel-Iran conflict, the strength of the China recovery and the outcome of the US election. IT and PSU banks eke out gains even as realty and FMCG drag.
BFSI stocks in focus on the back of Q2 updates. Bank of Baroda surges after deposits in Q2 grew 9.1% while advances surged 11.6% on a YOY basis. M&M Financial slumps over 5% as disbursements slip versus last year.
Avenue Supermarts under pressure as its business update indicates standalone revenue growth of 14% in the second quarter. The company also added 6 more stores in the quarter gone by.
Sundaram Clayton surges after the company launches a QIP to raise 400 crore rupees. Sources tell CNBC-TV18 that the indicative issue price is 2,205 rupees a share. Proceeds to be used for debt repayment and general corporate purposes.
SH Kelkar surges in trade as the company reports healthy demand across segments in its Q2 business update. Sees double-digit revenue growth in European segment despite subdued demand.
Okay, so it's a big fall, something that we have spoken about in depth. Now, Nifty has broken the earlier low as well, which was around 25,072. Right now, the Nifty is at 25,066. So this is the low point of the day that the Nifty is at right now.
Nifty IT continues to be in the green, but it has come off from the highs. We have just 3 sectoral indices in the green right now. But this fall has come in for a number of reasons. We have seen the Bank Nifty fall from the highs. The Nifty IT has come off from the highs. The PSU Banking Index that has been doing well for a large part of the day, it's still in the green, up around 0.9%, but that too has come off from the highs of the day. A lot of stock-specific moves, of course, Hormaz will talk about it in just a bit. But as Vivek was saying, it's the volatility index that's surging. Apart from that, it's definitely a very, very volatile session.
Very volatile trading session. Some more sectors that are seeing quite a bit of selling pressure. Of course, the auto pack, has cooled off quite significantly from the top. Even tire maker companies, they too have seen quite a bit of selling pressure. But a whole host of stocks is what Hormaz has on his list. Hormaz, over to you.
Well, if there are reversals as dramatic and as sharp as these, you would rather not have them to begin with. If you are a bull, you not want to watch the screen on this Friday afternoon. But the broader markets too witnessing some selling pressure in line with the benchmark indices. Not as much, but still in the red is the mid-cap index. So we'll start off with the losers then in the broader markets. Real estate is one sector that is bearing the brunt of this sell-off. Godrej Properties is among the top losers there. At the lowest point of the day, 5% lower. At the lowest point is also Chambal Fertilizers, 5.5% down in today's session. And Sterling and Wilson also not having a very good day at the office. Some other stocks that are impacted because of the business updates, and a whole host of them came in last evening. M&M Financial at one point was down 7%, still 5.5% down. Bank of Baroda is the only one that is being an outlier today. PSU Bank still doing well. And Avenue Supermarts after this update is down 4%, with brokerages having a cautious stance on the stock. Some selling pressure continues to persist in select PSU names. We spoke about a lot of these yesterday. The railway linked names as well. RVNL down below the mark of 500 now. HPCL down 2.5%, and GAIL has seen a very sharp slide, down 4% in today's session. And lastly, there are some stocks that are bucking the trend in a market like this, still holding on to gains. Oil Explorers, of course, Oil India at the highest point of the day now, 5.5% higher, as is BSC, heading towards the record high that it made in yesterday's session, as is 361 WAM, and Tejas Networks is having a good day from a lower circuit. The stock is now up 3.5%. Back to you guys.
Okay, so some of the movers, some outliers as well. Oil India up 6%. Crude is very close to that $79 per barrel mark as well. So thank you so much, Hormaz, for joining in as always and telling us some of these movers, interesting ones in the broader markets. It's a good time to get a technical check on the markets as well. Let's welcome Rachna Vaidya of rachnavedya.in for a technical check. Rachna, good afternoon. Thank you so much for joining in. Well, what are the markets contemplating now? Do you think there could be a further pressure from here on, and it could be not that great a Friday for the bulls?
Good afternoon. Thanks for having me here. And yes, I do agree with you that there could be more on the downside in the market. And unless and until we start to rally from a reliable level, from a reliable location, the same thing is going to happen. What happened today is that the rallies may fail only because they have not come from the kind of level that we would like to see the rallies coming from. Say, for example, on Nifty, if we check out the support which is reliable, that would be around 25,000 and 24,800. And not before that. So there is much more downside, according to me, on the indices from here on, and only after that a reliable level will come from where the rallies could come, which could see sustenance and follow through.
Okay, Rachna, any individual picks for the day?
Yeah, as far as the individual picks are concerned, I would like to give a pick on Bajaj Finance, where you could see further downside. Right now it is at 1911 on futures, and if this breaks down from 1900, then you could go short on this with a stop loss of around 1925, and the target could be 1850. So this is one, and the other could be Unilever, in the Unilever, wherein you can again go short on a breakdown of on a failure of a rally of 2870. There is a probability that we could again see a rally in the market in the coming days. And if the stock goes to 2870, that is where you could go again short with a stop loss of 2910. And then your downside target could be 2750. So the only difference is that in the previous days, you could be selling anywhere and you were making money. Now you'll have to be a little cautious and sell on rallies and breakdowns so that your risk reward ratio is better. And then you make money on the downside.
Okay. So you have 2 sell calls, any buy calls, and also have you had a chance to look at the HDFC Bank chart? A lot of news flow coming in today, but it has sold off quite significantly from the day's high. So anything on the buy side and your view on HDFC Bank?
See, with the kind of FII selling pressure that we have been seeing, aided again by accompanied again by the global cues, I don't think the large caps, especially names like HDFC banks, which have been favorites with FIIs, could be seeing any relief rally or any support over here. So the support that may emerge could only be at around 1640. Right now we are at 1676. So there is much more on the downside, according to me, in HDFC Bank also from here on, especially because of the sellings from FIIs. And as far as the long call is concerned, one long call that one could be looking at could be in ONGC. ONGC could be a beneficiary as far as the oil on boil is also concerned, and that is why during this pullback, right now when the price is around 295, if one tries to go long in any of the stocks, then this could be one of the stocks that could be in the radar. And if you keep a stop loss of say 290 over here, then you could be looking at a target of 300 and 305.
All right, Rachna, thank you so much for joining in today. So those are some technical picks and a technical check on the markets as well. We'll slip into a short break. We'll get you more on the markets and focus on SH Kelkar in our mid-cap spotlight segment. Stay tuned for that.
Investing.
Welcome back to Mid-Cap Radar. Well, the pharma index today is the one that's holding out a bit, but one stock, from the healthcare index that's taking quite a bit of a beating today is Granules India. Granules India is down almost 5%. Just keep in mind, this is after the company in the last 2 weeks has actually seen some regulatory action come in. And an important thing to note as far as Granules India is concerned, the fact is that the stock has entered the F&O ban today, so no fresh F&O positions can be taken over here. Stock, as you can see, down over 5%. But one stock that's doing very well today is SHKL. The company is in focus on the back of its Q2 business update. This is our segment, Mid-Cap Spotlight. Sonal, you've been tracking this particular name.
Oh, yes. So, and there have been a lot of initiating coverages earlier on the stock, so it has been in focus. And now there's a Q2 update which has come by, and the company sounds very bullish. They talk about how the business sentiment has remained positive and healthy demand has been seen across most of the segments. Even their recovery is seen in the order backlog, which was a problem earlier. The European market, where demand continues to be an issue, has seen a healthy recovery. So Europe is a big market for them, and recovery there is something that the street likes because they have achieved a double-digit revenue growth there. Their first half has seen growth of 17.4% in terms of revenues, which is 1,000 crore rupees. So remember, their Q1 revenues were at 454 crore rupees, so they have done more than 500 crore rupees. These are provisional numbers, of course, but this is the revenue number for them this time. There is a shift in product mix this time around, so this led to moderation in gross margins on a sequential basis, but on a YOY basis, there has been an improvement. While the numbers look good, they do talk about certain issues. They are talking about strategic raw materials being unavailable, which is a problem, and this will result in price increases in the coming quarters despite supply conditions remaining stable. So we'll be watching out for the margin pressures going forward, or we'll watch out whether they're passing on these price hikes to the customers and whether that's taken positively by the customers or not. Net debt has risen, so that's a problem. 596 crores in September quarter, and remember it was around 550 crores in Q1. While it's a 40 crore or a 50 crore increase, the company has been talking about a debt reduction every quarter, but this hasn't come by this time around. So we'll be watching out for their debt reduction targets as well. They say debt increased due to inventory replacement, so we'll watch out for what the inventory numbers look like in the coming quarters. On the promoter holding, they said that yes, promoters sold around 3.32% holding in September for personal requirements, but they do not see more of this happening. Maybe one of the things that the street is liking. So while the numbers look good in Q2, of course, there are certain monitorables in terms of raw material supply and the debt reduction plans as well of the company that we'll be watching out for.
Thank you so much for bringing light to that. We'll keep an eye out on both price increases as well as the debt movement. But moving on, Angel One is in focus after the brokerage in its September update reported gross client addition growth of 5% sequentially. Vamakshi is here with more details.
Well, absolutely, Vivek. It's a decent update coming in from Angel One this time around, much better than what they had posted in the month of August. Let me quickly take you through the details. The gross client addition stood at 9.5 lakh. This is an uptick of almost 5.6% month on month. Now, this is better because the client acquisition has picked up pace after seeing a very sharp drop in the month of August. The growth rate, however, is still lower as compared to the average growth rate that we saw in the months of from May to July 2024. Resultantly, when we look at the client base, it is seeing a decent uptick of 3.2% month on month, more or less in line with what we had seen in the month of August. The average daily orders, however, are down nearly 2.8% month on month. The average daily turnover, on the other hand, has seen a jump of almost 6.9%, and with this, it has risen for the second consecutive month. As far as market share is concerned, equity market share has seen a slight bit of a recovery, 10 basis points higher on a month-on-month basis to 19.4%. F&O market share, however, has remained flat for the fourth consecutive month at 20.7%. The commodity market share, which was improving for the company for the third consecutive month, is now seeing a fall of almost 150 basis points to 61.8%. So overall, I would say it's a decent update coming in from Angel One.
Okay, decent update coming in from Angel One, but of course, the kind of market that we are in, there is some decline that we are seeing on the stock. But Vamakshi, you're also focusing on asset management companies. The mutual fund industry has witnessed another strong quarter. Tell us more. What does the note say?
Well, absolutely. There's a note coming in from Kotak Institutional Equities. They're focusing on AMCs as well as RTAs. On AMCs, they say that the MF industry saw another strong quarter. The average AUM was up nearly 12% sequentially, while equity AUM was up much higher, 15% sequentially. And this in turn translates to a 5 to 10% earnings upgrade for the AMCs. Now, out of the AMCs, they highlight that HDFC AMC and Nippon AMC are likely to post the strongest earnings growth in the second quarter. ABSL, that is Aditya Birla Sun Life AMC, and UTI AMC still have to catch up on fund performance before we start to see larger flow shares for them. As far as yields are concerned, revenue yields have been under pressure due to the AUM growth, and in fact they're expecting a 3 to 5% annualized yield compression for AMCs from FY25 to 27. Now let's also look at what their ratings are on certain AMCs. ABSL AMC, they've got an ad rating. They've gone ahead and increased their target price out here. For HDFC AMC, Nippon AMC and UTI AMC, they have a reduced rating. They've upped the target price for HDFC AMC and UTI AMC, but they've left it largely unchanged for Nippon. For HDFC and Nippon, they say that both of these companies are fully pricing in the fund performance-led re-rating as well as strong earnings growth. The convincing investment case for ABSL and UTI AMC, they believe, needs evidence of a turnaround in their fund performance, and however, they're seeing some early signs in the 3-month and 6-month basis. On RTAs, they've highlighted that they like RTAs for their stable, predictable MF operations and fast-growing non-MF business. However, they believe that the valuations for these counters are quite expensive. Given those factors, for CAMS, they have a reduced rating, target price of 4,200, while for KFIN, they've downgraded their rating to a sell. Target price, however, has been increased from 770 earlier to 900 per share.
Thank you so much for that, Vamakshi. KFIN Technologies is under pressure today. As we now slip into a short break, here's some good news for your viewers. India's business leader is now a click away, introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or the Google Play Store.
And I did not underestimate Senator Vance as a slick talker. He could. But I also called out there, you can't rewrite history. You can't rewrite history. And trying to mislead us about Donald Trump's record, that's gaslighting. That's gaslighting. the moment that really stuck out is I just asked the simplest of all questions that every single American should be able to answer. I asked him if Donald Trump lost the 2020 election. He refused to answer.
Well, it's Friday, so while we are tracking markets very closely, we have to talk about something fun as well. And there's been that recent craze over Diljit Dosanjh, Dua Lipa and Coldplay's upcoming concerts, and they have displayed the spending shift in urban India. The young are spending more on events, concerts, travel and experiences. Mangalam is joining us with more details. Mangalam.
Well, you know, it is all about that, right? The young are spending more on events, and as a result of which the older millennials who also have some money are spending a fair amount on experiences. So if you look at, you know, the swathe of things that people spend on, there's events, there's travel, there's luxury goods, there's fashion. We've heard about how people queued up for the iPhone 16 or bought them off a lot of these quick commerce apps as well. So that's where a large part of the upper echelons of society are spending. Younger and, you know, the fast forward people as well. We saw that with nearly 1 million people waiting in queue for tickets for Coldplay, which were priced between what 6,000 rupees to 35,000 odd rupees as well. And that's not all. Apart from Colgate, there was, you know, Diljit Dosanjh, Dua Lipa, Bryan Adams and all of them selling nearly 250,000 tickets, and a large part of those tickets which found their way back onto these reselling platforms saw buyers at prices which were 5 times the original listed price as well. That's telling you about the demand for this. If you club all of that together, you know, CLSA has done some maths. These concerts account for nearly 350 to 400 crores of revenue itself, and that is nearly 30 to 40% of incremental sales of quick service restaurants itself. We saw that, you know, even when the World Cup happened in India early last year. So those are a bunch of things that we will continue to keep watching an eye out on. And earlier this afternoon, we also had Roshan Abbas talking about, you know, this industry being a 3,000 crore industry over the next couple of years. So now you have Dua Lipa, Bryan Adams, Diljit Dosanjh, AP Dillon, Karan Aujla and Coldplay, all of them in the next few months. Let's see where one manages to get tickets for.
That's right. You know, that's where all the fight lies, whether or not you do get the tickets. But thank you so much for that interesting take, Mangalam. But with that, it's all the time we have on this edition of Midcap Radar Mutual Fund Corner. When we return.
Two 6-week periods during which the inflation rate has fallen, that can give a lead to cut the repo rate. Choice is between 25 basis points and 50 basis points. If you want to be cautious, we can cut 25 and store something for the next time. Or we can take front-loaded cut of deeper thing. There are two ways of creating competition in the system. One is really letting new private sector banks to come in. The other is privatize some of the nationalized banks or increase the private content in the United States. We have now reached a stage in which we should really be able to get more banks in the private
sector. So I would really say that let an atmosphere and environment be created where new private entities can enter.
The regulations are out. As we said, they were likely to come out today or tomorrow, and they're finally out. And I have to say, they're largely in line with expectations. So in July, SEBI had proposed 7 things. 6 out of the 7 actually have been implemented with very minor changes. So I'll start with what is going to be top of mind. Number 1, higher lot size value. This is going to be effective from the 20th of November. Basically, for index derivatives, which is Nifty, Bank Nifty, and other index derivatives, at the time of introduction, the SEBI is saying that the contract value should be between 15 and 20 lakhs at the time of introduction. At least 15 and up to 20. That is number 1. This is a simple and clean measure to limit the number of people who are able to trade this, trade index derivatives. Number 2, and I think a lot of interest around this, only 1 weekly option contract per exchange. This is also effective from the 20th of November. Remember, right now, NSE has weekly option contracts on the Nifty, the Bank Nifty, the mid-cap index, and the Fin Nifty as well. BSE right now offers weekly contracts on the Sensex and the BankX. NSE now will have to choose 1. They'll have to drop 3. Only 1, and that too a benchmark contract. So most likely they'll have to decide whether to keep a Nifty weekly option contract or a Bank Nifty weekly.
Hello and welcome to MF Corner. It's a special edition today. I'm Sonal Bhutra in the Mumbai studio. Today we discuss something that we've been discussing for a while, and it's very topical. We'll put focus on the recent boom in the Chinese markets, the stellar rally that we've seen. But how can investors sitting in India can play it via the mutual fund route? Something that a lot of you have been writing in and talking about as well. So we'll get in our guest to answer that for you. Later on the show, if we do get time from this interesting topic, we will discuss the recent SEBI norms, including the approval to introduce a new asset class to bridge the gap between mutual funds and PMS. But all this and a lot more with our 2 special guests on the show today, Radhika Gupta of Edelweiss AMC and Feroz Aziz of Anand Rathi Wealth. Radhika and Feroz, thank you so much for joining in today. And this is a topic which everyone's been talking about, so it's good to get in your opinion as well. But lady, let me start with you. Radhika, what is the view now? Is it the time fund managers, AMCs, they will start looking at Chinese markets for investments? Or do we need more in terms of a constructive view or in terms of actions before a view can be made on these markets?
So good to be here. Happy Friday. And look, we have had perhaps the oldest China product in the market for Indian investors, Edelweiss Greater China Fund. We've had it since 2017 and it used to exist before. So I have seen this Chinese story from a India investment point of view over the last 6-7 years go through various ups and downs. And I keep joking with my team that 2 weeks ago, there was very little action in the fund except, selective value investors. So selective value investors knew that there was an interesting play. Cut to the week that's just come by, there's been a frenzy of activity in the China fund from our own investors and, lots of questions, lots of flows. So I think that the situation has just turned in the last 2 weeks. Now, I think our summary of the situation is this, and our advice to all investors is this, that, what is happening in China? The valuation story is supportive. It has been supportive for a year. There was a slowdown in the economy and a slowdown in consumption post-COVID. There were certain actions that governments took that made people uncomfortable. Now there is a sense that the government wants to do a lot to stimulate consumption, to revive the real estate sector, and to give a little bit of boost to equity markets. And this hope of a turnaround, combined with the fact that valuations are doing well, bodes well. We still tell people, however, that don't try to do a short-term tactical trade on China because, you've had these rallies before. You had this rally 3-4 months ago and then it fizzled out. If you're trying to be a long-term investor in China, it's a great story. It's finally the 2nd largest market and it's available at very attractive valuation. So we really are trying to orient our investors towards long-term here because we've seen this cookie.
Oh yes, and there's so much excitement suddenly because it's not been doing so well for such a long time. Let me get in Feroz in the conversation as well. Feroz, first, what is the idea on Chinese markets and how do we compare it with India now? Because there's suddenly the China versus India debate as well.
Yes, Sonal, good afternoon and good afternoon, Radhika. Firstly, point is that China and India have at least from an Indian standpoint competing with each other.
Yeah.
From a global standpoint, India and China have not been able to compete. For somebody who's outside India, who does not have the India bias, they don't see India and China as the same. We do because we stay in India. But I think Chinese have reminded us about what they did in 2008 with this new stimulus. They had done almost about $570 billion of stimulus way back in 2008, which put them in a trajectory of a great growth for almost a decade and more, almost 15 years. And they didn't go through a recession, which the world went through. So I think it's a reminder of that. So like Adhika said, if you're taking a structural call on China, then using one of these funds to get into a Chinese market with a fund manager's eye on it is a great strategy. Point two, India and China. I think India, FIIs, if you look at the numbers of FIIs, you'll be disappointed of how FIIs have pulled out from India. Yeah. If you look at the full calendar year, you have almost about $22 billion, which is 1,65,000 crores exited till the September end. And they have been light on India ever since January. On the election day, FII index futures, election counting day, was at short 88%. Just last week, it crossed 80% on the long side. So point I'm trying to make is FIIs have not been so bullish India. They've been very bullish India small cap. This is one great trend which people are missing. Indian stocks which FIIs are buying are the small cap ones. So to answer your pointed question, I'm not too worried whether FIIs will pull out of India to invest in China. They've been pulling out either way.
Okay, and yesterday we saw 12,000 crore rupees, and you know that has been the single biggest number that we've seen in last 4 years. So you're right, that has been happening for a while. But Radhika, let me get you in the conversation. Now that you're saying it's not a tactical play, investors can look at China from a long-term perspective, valuations are supportive. What are some of the investment opportunities available in the Chinese markets currently, some themes that they can play on?
So if I look at the way we structure our fund, and there are multiple China products out there in the market, but we run, I think, the equivalent of a flexi cap fund for China. There's been a little bit of sector rotation in how we think about the fund. So a couple of the core themes that exist today, one is technology. So a number of companies in China are large beneficiaries of what is going on in AI. So moving from traditional old tech to some of these companies is interesting. The second theme that we're looking at is insurance. Insurance as a sector is poised for a turnaround. Third theme that we're looking at is this whole thesis around carbon neutrality. Solar is a big emerging theme in China. Over the last few years, China has also emerged as a leader in the whole EV race. So that becomes part of your carbon neutrality theme. And I think fourth, related to this stimulus, there is an expectation of a revival in the real estate sector. And real estate, when there is a revival in real estate, it also accounts for a material part of the wealth of a Chinese person. So indirect plays on real estate, similar to how we look at in India, particularly home improvement, home building, all of these are in some sense consumption-oriented plays. But a play on the revival of consumption, given all the kind of stimulus activity that is happening or is expected in China, these are some of the themes that we're positive on. Themes that we're less positive on or underweight on in this particular fund are financials and banking in particular.
Okay, financials and banking. That's Radhika's view. That's the Edelweiss AMC view. What about you, Feroz? What are some of the themes that an investor can play on when it comes to Chinese markets?
See, I think you have to play a very broader market. When you're going outside the country, I would stick to indices. Of course, the Edelweiss fund, like the Greater China Fund, has been an offshore fund. It's a feeder fund. It has been in existence for more than 5-6 years. The first great part is you're discussing something, Sonal, I should compliment you, which has the worst rear view mirror. right? Generally, when past performance is great is when these get discussed, right? Now, if you look at the Greater China Fund, for the last 3 years, it's given a compounded minus 13. So that itself implies that these are the times, the troughs to back that argument that there is value. So coming back to what themes, I would say you have ETF as one of your alternative, and you have these feeder funds also as an alternative, and you have LRS, which is the liberalized remittance scheme, as your alternative. These are your 3 alternatives. In my opinion, you can definitely look at the Hang Seng index fund, which is there. You can definitely look at the oldest Edelweiss feeder fund, because Radhika would be better poised to say how long has the feeder fund, the primary fund, been into existence and a track record. I think I would leave it to the fund manager, but I would prefer a feeder fund rather than only a domestic asset management company looking at China with fewer analysts. But if somebody is more deep-rooted there, that's much better, and that's what the feeder fund would do.
Okay. I'll come back to you if there are any specific names, themes like, EVs or something else that Radhika spoke about as well. Radhika, since we have you with us and you have a feeder fund here, that's the Edelweiss Greater China Equity Offshore Fund, you spoke about the themes that you would be bullish on or not be very overweight on as well. Can you give us more sense about the strategy of this feeder fund? Where does it invest? Which markets does it have exposure to? Is the composition now? There's a lot of activity that you're seeing in the feeder fund as well.
Absolutely. And, just to sort of emphasize Firoz's point, by the way, this feeder fund has been around, the original fund has been around since 2001. And I would repeat a point that Firoz mentioned. We don't manage the fund directly. We invest in the original JP Morgan fund. I think in this case, it's extremely important because China is a very, very nuanced market. It's not something we attempt to do as India fund managers. And our JP Morgan team, between their presence in Shanghai and Hong Kong, has 45 people on the ground looking at China. So that is extremely important. In terms of the composition of the fund is it's a Greater China fund. So it's a combination of 3 markets: China, Hong Kong, and Taiwan. It's about 56 to 60% China at this point in time, about 10% Hong Kong, and the balance is select companies in the Taiwan area, so companies like TSMC, etc. So it's about a 50 to 60 stock fund. So very much a flexi cap fund that has the mandate to look across sectors.
Okay, so this is one of the ways, of course, how an investor can get exposure if a mutual fund investor wants an exposure to Chinese markets. So 2-part question for you now, Firoz. The 3 ways for mutual funds to take exposure to these Chinese funds, if you can repeat that for us. And second is some of the themes that you also think could work in the Chinese markets.
Yes, sure. First, let me address that bit, because a mutual fund manager. So the 3 ways are, one is not a mutual fund way, which is the liberalized remittance scheme, where you and I, as Indian residents, have the right to send almost about $250,000 outside every financial year per person in a family. So that largely the ultra HNI families end up using it. That's point one. But from a mutual fund standpoint, there are some feeder funds, like Radhika said, and she emphasized that that fund has been in existence for 23 years. But the wrapper fund is there for 6 years. So it's not just 6 years track record, but you have 23 years. Now suddenly changes the entire thing, and 45 people on ground. So one are these fund of funds, the others are index funds, which are there. These are the 2, in which, if I have to give you some names of the funds, there are 2 which are which stand out on China, which is the Axis Greater China Equity Fund and Edelweiss Greater China Equity Offshore Fund. These 2 are fund of funds, especially because of the tax change in this budget. These have become attractive. Otherwise, if I was going to pay marginal tax rate on an investment going global, so I'm taking the risk and funding the government if I'm going to just take the marginal tax rate. So that's a big advantage. If you come to the Hang Seng, there's one Hang Seng Nippon India ETF Hang Seng Bs, which are low cost and also invest in the Hang Seng Complete Index. There's also one, which is Mirai Asset Hang Seng Tech ETF. But I would definitely not recommend you to pick up only the tech stocks from Hang Seng, because you're anyways doubling up the risk if you do that. And in the LRS, of course, new energy and infrastructure and industrials is what I think I would be bullish on if you're such a large guy that you want to remit the money offshore and buy something domestically domiciled there. These are the 2 themes.
Okay, so these are the ways a mutual fund investor can go ahead. Radhika, coming on this is something that, of course, you must be getting a lot of questions about. I asked that to Firoz as well. Is it fair to have an India versus China debate first up? Does it make sense to do that? What is the idea on Indian markets right now, considering the fall that we've been seeing?
So I think yes and no to India-China debate, and it depends on the lens that you look at. As a domestic investor, your primary allocation will always be India. I think 60-70% of your allocation will be India. That's what we would recommend. That's what, most folks in the wealth industry, most advisors would recommend. And most people who are evolved investors, and I would say again, evolved investors who are not making their first investment, would probably have 15 to 25% exposure to some kind of international products. And if you're looking for international products, then you will have US and you will have China, because these are the two largest economies. Now, from a domestic investor's point of view, some of the challenge the domestic investors have is, oh, I've invested in a China fund, it's underperformed in India fund. And then there'll be a period where you've invested in a China fund and it's outperformed in India fund. And I keep telling people, that is diversification, and that is the meaning of diversification. If you're an Indian investor, the reason to invest in absolute, the Indian market is fantastic over 10 years. But the reason to invest in a market like US or a market like China is they perform at different times than India, and that is what diversification is. So you should look to have exposure to US and China, in my view, but you should realize that, again, these are long-term investments. These markets will have their volatility and they'll perform and India doesn't. I think from a foreign investors' point of view, they are similar in the sense that if you're looking to allocate capital to emerging markets, there are only two markets where you can park large amounts of capital, and they are India and China. However, when I meet global investors, I think the thesis for both is very different. People see India as a great 10-year growth story with a lot of stability, strong flows, demographics, etc. People see China very differently. It's almost 15 years ahead of India in the cycle. They see it as a little bit of instability, but finally the world's second largest economy, but much cheaper valuation. So I think from a global investor's point of view, there is a little bit of a trade-off, and that's what you've seen this week. Some people are saying, I'm cutting a little bit of weight to India, adding a little bit of weight to China. I net agree with Feroz that from a flow point of view, it should not matter, because India has hardly seen FII flows.
That's been the other trend that we have been talking about, this big outflow from FIIs and how DIs have been pumping in money. It's all been about the big SIP flow, right? It's a very interesting discussion, but we have to slip into a quick break, Radhika and Feroz. On the other side, we'll continue our discussion and add on the other aspects of what's happening in the mutual fund industry as well. It'll be the new SEBI announcements from its board meet and a lot more. Stay tuned.
Similarly, the BSE will have to choose between the Sensex and the Bankex. The benchmark is the Sensex, so most likely BSE will offer the Sensex weekly option contract. So I think this is the one which I think is going to dominate headlines and market participants, most impacted exchanges, brokers, everybody most impacted from this one. Number 3, intraday positioning, monitoring of position limits. This is effective from the 1st of April 2025. Currently, position limits are monitored on an end-of-day basis. Now, this is to be done on an intraday basis. Remember, the limit which was set, I think in 2020 during COVID period, was 500 crores based on notional value of trades. So this was monitored, but at the end of the day, now they're saying it has to be done on an intraday basis. Lots of feedback in terms of how this is going to be finally implemented. There is time, as I said, only effective from the 1st of April 25. Number 4, increase in tail risk coverage on the day of options expiry, effective November 20th. Basically, if you are carrying a position or if you take a position on the day of expiry, all existing positions on the day of expiry, old and new, will attract an extra ELM, which is extreme loss margin of 2%. So this is number 4. Number 5 and number 6 are pretty straightforward. Number 5 is upfront option premium, effective 1st of February 2025. And number 6, removing the expiry day calendar spread benefit, which is also going to be effective from the 1st of February. So I think these are the 6 changes which SEBI has implemented, largely in line with expectations. But I think the lot size increase and the fact that SEBI is limiting weekly options contracts to 1 per exchange will attract maximum amount of discussion and debate in terms of what this does for market volumes, exchange volumes, and what this does to market intermediaries as well. Back to you.
Right, Prashant, very quickly before I let you go, a lot of comments coming in, a lot of questions and queries coming in from the viewers as well on our social media handles asking about the impact and the implications. Just in the near term, from a market perspective, you've probably been speaking with experts. What's the impact likely to be on the markets when we open tomorrow?
Shireen, so through the course of the day, we spoke with lots of market participants. Markets are prepared for this. I mean, we put out the story in the morning that this is to be expected very soon, that this is imminent. There was some expectation in some quarters, and we had clarified yesterday as well that this was not to come up along with the board meeting. And we said that, well, this is going to come soon this morning. So I think this is widely advertised. And the fact that what has been done is largely in line, actually mostly in line with what was proposed in July, I think does not come as a shock or a surprise. And also the important point is this is being done in a phased manner. It's not as if everything is being implemented by the end of the month or from a certain date. I mean, there's November 20th, there is April 1st, there is February 1st, all the way into 2025. I think that also kind of eases the impact a little bit.
Make informed decisions with comprehensive analysis on the go.
Strengthen your...
Welcome back. You're still tuned into MF Corner. We still have with us Feroz Aziz of Anand Rathi Wealth and Radhika Gupta of Edelweiss AMC. Now we are talking about something different because SEBI's new announcements, they spoke about creating a new product to bridge the gap between PMS and mutual funds. There was MF Lite framework. They also relaxed the eligibility criteria for registered investment advisors. But let's talk about the new product, the investment product. This will be under existing mutual fund framework to bridge mutual fund and PMS gap. Feroz, let me start with you. This was discussed in July as well. There's still nothing concrete finalized here. Tell us, what is it different now versus what was in July? How would it work? And what are some of the key considerations that you think the regulator should also keep in mind?
Yes, so I think, Sonal, it's a very, very progressive step. Why? Because today you have some platforms available. So if this platform was a Me Too platform, then it was a useless one. So if you look at mutual funds and PMS, these are two prominent platforms, and people use also AIF for long-only positions today. These are the three platforms. Now this becomes the fourth platform called the investment strategy or strategy ka platform, whatever they actually finally name it. In mutual funds, derivative usage is only limited to selling calls if you have the same asset. If I have a Reliance share, for example, I can sell calls of Reliance share. That's called a covered call strategy is possible. You can buy puts and buy calls. This is what is available on mutual fund currently available. Then PMSs can use derivatives only for hedging purposes is what it is mentioned. Now people might take a little more aggressive stance as a manager, but this is what is mentioned. Now, so this is very relevant because the existing platforms don't permit usage of derivatives very well. And AIF is 1 crore plus. So I'm very excited about this, point one. Point two, if the leverage ratios are reasonable, because futures in India can get you, Nifty futures can get you 5 times leverage, options can give you 500 times leverage. So if the leverage ratios are as worse off as 1.5 times your capital, if somebody put 10 crores and can take a exposure of 15 lakhs, 10 lakhs, you can take an exposure of 15 lakhs, then it will not be exciting. It will not have any meaningful shift from the derivative market to this strategy, even at a mass affluent level. That's point two. Point three, I personally think that a lot of asset management companies have shared strategies with the regulator. I'm very happy that it's bottom up rather than top down. So first, people are looking at ideas, but the regulator is looking at ideas and then forming a framework, which I think is unique and first of its kind. I'm very happy that it's bottom up rather than top down.
So let's get in an AMC view as well. Radhika, what is your take on this new product profile that has come by and something that stands out for you here?
So I've been very excited about it, I think for the reasons Feroz mentioned. But, you know, the fact is that the mutual fund platform now is a very operationally transparent, convenient platform. And the strategies are boxed into categories because they're meant for the retail consumer. Now to be able to leverage the same platform for slightly more nuanced strategies, for again a slightly more nuanced consumers, is very good for the asset management company. I think it provides us tremendous operating leverage in terms of using the talent of our teams for some new ideas, and it provides consumers more options. I do think, however, the devil is in the details. So when the working paper came out, and there's been, some very good consultation with industry, there were examples of strategies that were out there, potential ideas that were out there, and I think there are at least 2-3 interesting categories of ideas. For instance, the whole space of long short funds can be played in this category because you are allowed to take some amount of hedging that is not just direct hedging. You can do more work in the credit space because the funds don't have to be daily open-ended. So you can have restricted redemptions and you can hold more illiquid fixed income. I don't know what you can do in the unlisted space. You can do some more concentrated equity portfolio, higher risk ones. The current board meeting had a very short note on new asset class. So again, I think it's very important to understand what is in the circular. There was interestingly one thing I did note though in the board meeting is they've said that no leverage will be allowed in this platform and hedging will be limited to 25% of the position. So you can't run, a very aggressive long short fund. You can probably run a fund that is 75 long, 25 short. So I think it will be limited in what we can offer, but we're very excited to see the details. Let's see the details.
Okay, so waiting for details for sure, but that's of course the first take and a lot more fine tuning will have to be done. It was such an interesting discussion. I'm definitely not done, but unfortunately we are completely out of time on this edition of MF Corner. Radhika and Feroz, always a pleasure to speak to the two of you, and this time for something so topical. So thank you so much for joining in, and stay tuned for CNBC-TV18 for more news and updates.
Real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajaj at these times on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18, an unending pursuit for excellence. A pioneer, a leader, a visionary, building a lasting legacy of credibility, consistency, and trust. Giving unparalleled access to global thought leaders and powering conversations that are shaping the new world order. Setting the highest standards through exemplary leadership. It is this unrivaled reputation for the most comprehensive coverage, actionable intelligence, and in-depth reporting that makes CNBC-TV18 India's #1 business news brand. Foreseeing change, growth, and transformation for over a quarter of a century. Trendsetters crafting innovative content formats. And award-winning business journalism. On air, online, on social media. As we embark upon 25 years of excellence, we invite you to be a part of our future. CNBC-TV18, your trusted partner and investment ally.
What does it take to build India's largest startup platform? it takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs.
Taiwanese index trading with gains of around 0.2%, as is the Hang Seng.
The 40-day exponential moving average, which is 25,222.
Chinese policymakers have made it very clear that they are paying attention to their equity market.
Focus of HDFC Bank is on deposit mobilization, and if you take a look, that has been pretty strong for them.
25,211, it's a flattish start, 0.15 lower.
So I think the market continues to be strong. What we need, obviously, is for property prices to begin to turn up.
It's not that there is a huge inflationary bias for the overall economy.
There's been a phenomenal recovery in the markets in the last 45 minutes or so.
Many analysts have come up and said that money is moving out of India into the Chinese markets.
The Nifty is off around 400 points from the day's high.
Sharpest strategies, top market trends, unmatched perspectives, the trading day's most comprehensive roundup. Stay ahead with NSE Closing Bell. Broadcasting live from the CNBC-TV18 Motilal Oswal Studios in Mumbai.
Well, it's not a good-looking screen at all. It's down. I mean, actually, it was around 250 points nearly now, and on the cusp of breaking 25,000. I mean, just absolute bloodbath once again, like yesterday. This is Closing Bell. We are coming to you from the CNBC-TV18 Motilal Oswal Studios. I'm Prashant. With me, my colleagues Reema and Surabhi. Guys, hi. Afternoon.
Hi, afternoon, guys. And what a stark contrast, right? We look at our screen, and actually we should do that. Let's try and pull up the rates if we can. And look at Hong Kong once again. 3% of a rally. So Hong Kong paused for all of 1 day. And then it's that same move playing out. So I guess not something that we're quite used to.
I think the flows once again, perhaps maybe large. Maybe, I don't know if it'll be as large as yesterday. But there you go. That's what Surabhi's talking about. Down, that's Hang Seng in Taiwan, but Hang Seng in India, right? I mean, that's the a comparison to really kind of make. So yeah, I mean, and it's been volatile at that. Yesterday, of course, was down and then more down and more down through the course of the day. Today, there were bounces. That bounce right in the middle of the day was substantial, meaningful. We were up 150, and then it basically dropped like a stone. You went down 50 points, and then it accelerated to being now down 200 plus points. So I don't think there's very much point looking at individual names because it's everything down kind of a day. I'm on my screen, 950 stocks are higher and about 1800 stocks are lower. So it's 2:1 clean, market breadth looking pretty weak as well. Sectorally, maybe just a quick look. Wix, by the way, India Wix is up 8%. That's something to note. And of course, sectorally, real estate is down 2%, the sector. Autos are down 1.4. FMCG is down 1.4. Infrastructure is down 1.2. What is up, I saw, was PSU banks. PSU banks and IT. Actually, those are the only two sectors which are up in the green. PSU bank about 0.7 and IT, which is up 0.5%. Reema.
So now we've breached the 50-day moving average of 25,021 on the Nifty. Earlier in the week, we had breached the 20-day moving average. And now even the 50-day moving average is gone. And we're down for the 5th day in a row. And this week, the Nifty's lost about 4.7%. The mid-cap index is down 3.8%. But, if you look at the FI favorites, historically, it's been IT, it's been some of these large-cap banks. The Nifty IT index is up close to about 0.5%, and the banking index is down 0.4%. So it's under pressure, but it's relatively outperforming the frontline indices. But it's just the way the markets gave up at about 12:30 or so. There was a sudden turn in sentiment, and Europe also, by the way, is still holding up in the green right now.
Yeah.
So not just Hang Seng, but if you pull up a CAC, that's up close to about 0.5%. I think even the DAX had a green tick. It's only FTSE, which is down about 0.25%. But it's not that you're seeing the kind of selling pressure in Europe that you are in India.
Oh, yes, absolutely. And, however much we want to wish it away, this whole take, and I remember this was, I think, Editors Roundtable over a week ago. And that's the question that we were asking to our guests even back then. that will this just become an excuse for foreigners who are already in India to book maybe some profit and start shifting the money around? And maybe we've seen a lot of that play out this week as well. By the way, that's important news as well from a global standpoint. Finally, this was along expected lines and it's come through. 45% tariffs on EVs that are being manufactured in China. It's a sort of big war out there. US anyway has, I think, imposed tariffs of up to 100% on China-made EVs. And Europe is following suit. So, yeah, the global EV war continues to play out, considering the cost advantage that Chinese electric vehicles, of course, have. Anyway, let's come back to the story here at home, and that continues to be the big fall that we're tracking. So what are the bets for the last hour? We have Ashish Kayal joining in with some thoughts and ideas. Ashish, let's talk about the index first. Now, like Rima pointed out, the 50 DMA obviously is under question. We don't know if we'll even hold 25,000 by the end of trade today. What are the key levels for Nifty, Bank Nifty, and then we'll get to stock trades?
Sure. See, if you look at the overall selling pressure has continued to intensify. Today, there was some kind of an attempt we can see on the upside where the index managed to go towards that 25,400 levels, but it failed and broke below the day's low. So that suggests that the overall mood or momentum is on the downside. Use any pullback from here back towards 25,100 and 25,150 as a selling opportunity. And on the downside, the support is around 24,970. That's below that 25,000 psychological mark where we have a high put right up as well. So in case Nifty breaches that and moves below 24,970 levels, there can be further selling pressure intensified that we can expect. So in a nutshell, the overall trend for Nifty is sell on rise. Pullback can be used as a selling opportunity for the target of 24,980, and if that breaches, then maybe 24,700 on the card is what we can expect.
Okay. What about stocks? What would you recommend, Ashish?
On the stock side, we can look at Exide Industries. We can see that the stock has been managing to buck the trend. And despite of the sell-off we are seeing in the broader market, especially the mid-cap, this stock has managed to outperform. So one can create long position in Exide Industries over short term for the target of around 535, and stop loss of 485 can be maintained. And if 535 is taken out, further higher levels can be expected in Exide Industries. The next stock is going to be on PFC. We can see that PFC has broken below the low, and we can clearly see that it is not able to sustain at the higher level. So it's on the sell side. So PFC, one can create short positions here. Maintaining a stop loss on the upside near 475, which is above the day's high, and then expecting a target of somewhere around 440 levels on the downside.
Okay, got it. Ashish, thanks very much. We'll touch base again with some more trading thoughts and ideas. By the way, another important cue to keep in mind is oil. And that's obviously another overhang for our market. Brent has inched up to 78. So the 5% surge happened last night when it was around 77.5 thereabouts. But now it's officially crossed the next threshold, which is 78. So oil prices with another 1% on top of yesterday's 5% surge. That's something to kind of keep in mind as well. Well, with that, let's move on and spend some more time talking about this whole India versus China debate in terms of FPI inflows and outflows. Hormuz has been looking at a lot of data surrounding the kind of selling that we've seen over the last couple of sessions. Hormuz, fill us in.
You know, the highest FII selling in a single trading session in the last 4 years. And this has been one of the major overhangs that the market has seen as a result of the fall that we are witnessing in the markets currently. And if you can see this comparison that comes up on your screen now, the CSI 300, the benchmark Chinese index, before it went for the holiday, the 9 trading sessions that it had starting the 18th of September, it rallied 27%. From a 52-week low, it jumped to a 52-week high, 900 points in 9 sessions before heading into the holiday weekend. Now, in comparison, ever since the Nifty made its record high last Thursday, it's down 4%. Of course, the fall is extended today as well. But that is the comparison that you're seeing, the China outperformance that you have witnessed, and that is the big reason why the FII flows are moving to China. A lot of experts also coming on our channel and speaking about the tactical money moving in. But still, there are a lot of people who are not convinced about this rally in China. Rajiv Jain is one of them of GQG, and he mentioned that there are multiple instances in the last 3 years where they have had this kind of moves, but then these moves have not lasted in the Chinese markets. He said this is a good trading opportunity, yes, but whether it is a 3, 4, 5 5-year investment opportunity? Well, that's a question mark. Citi also came out with a note. They mentioned that this rally has drawn the Chinese benchmarks on par with the Indian benchmarks in terms of returns because of the multiple policy announcements that were made in the Chinese markets. But the macro stability in India, the growth opportunity, and of course the domestic flows, these are the ones that will continue to drive the Indian markets higher going forward. There was also some more research that came in, more opinion that came in from Gavinkel Research, and they also said that even if this Chinese rally sustains, a lot of foreign investors are still reluctant to invest there. The headwinds for China will become tailwinds for the Indian markets going forward, and it is too early to call time on this bull market in India. And lastly, a very important opinion coming in from billionaire investor Stanley Druckenmiller. He mentioned this at a conference a couple of days ago, and he mentioned that he has no interest in China as a market as long as Xi Jinping is running the country. So there's still there. Yes, there is money moving out of the Indian markets into China, but not many on the street are convinced about it.
Okay, thank you very much for that. Prakash Diwan is with us. Prakash, we may not know what the FIs are doing, whether they're pulling money out of India and putting it in China. But what about Indian investors, people that you speak to, HNIs, retail investors? What are they up to in the last few days? Are they pulling money out?
Good afternoon, Rima. No, so I don't think there's any panic. The money that's being pulled out entirely seems like have belonged to the FIs. It's and of course, most of the investors in India don't have an option to go beyond India, beyond certain limited domain that they could participate the LRS money with. But my sense is the market needed a trigger to sell off. Why the selling has been a bit precipitous, Rima, is because FIs chose to do this in a very short span of time, just a couple of days. And you've seen this huge sell-off with very clearly the domestic side of the institutional market not buying everything which the FIs wanted to sell. For obvious reasons, because valuations are at a stretch. And I'm sure all of us know that if we get things at lower levels, the risk-reward turns very favorable. So it's a very healthy correction where the market seems precipitous. In fact, till some time back when I was talking to investors, they were worried about the global war and the geopolitical tensions in various pockets. But that seems to have got digested, though the tensions have intensified in the last 1 week. This seems to be a flow issue. So what brought money back to India and in a gush led to our indices crossing newer highs is also responsible for some of the highs being taken off. But from a investor perspective, HNIs, family offices, I think I've chosen the smart way to invest into businesses that have a slightly longer-term orientation and salience, and possibly at the IPO, pre-IPO level, which means your price erosion chances are much less. So it's a lot of smart money that's investing in very smart ways now. I don't see any panic in the market at all.
Okay, well, that's a thought for sure. But as of now, we're still dealing with a pretty substantial decline that continues as we go on. Actually, talking about some of the movers and shakers today, and at least some of the stocks that have been in news, look at Mahindra and Mahindra Financial. That stock is down about 6.5% because one of the key issues was a slight deterioration in asset quality that M&M Financial reported. Prakash, hi, afternoon. Come in on the updates, and many have come through. I've just picked out M&M Financial because it's seeing an outsized stock reaction. Any thoughts on this one or any other update that stood out for you in the BFSI space?
Good afternoon, Surbhi. So I think the BFSI space will probably follow with a little bit of a lag in terms of how the banks do. And from all data points that we get from the banking side, at least, things are looking much better. Whether it's HDFC, whether it was PNB the other day. My personal sense is that NBFCs, especially the ones that have a quality portfolio and have never been challenged by quality of assets going forward, and by virtue of that, you count the Bajaj Finances, the Sundram, the Cholas of the world. They are the ones to be with because, in volatile times, these are the ones that may go down. You may have drawdowns in your portfolio, but then they're faster to bounce back as well. So whatever you buy now will have to be very high quality for the simple reason that you will not see a lot of the not so great quality stocks probably struggle to do well. And that's going to be a very difficult situation if you have more of that in your portfolio. So from the NBFCs, I would believe, of course, M&M is, L&T Finance and M&M is something which I really don't, I've never recommended investing into these two. But I would look at Bajaj Finance for the simple reason that it's making a comeback, which is slightly long-term for me, but distinctly there. So from these valuations, you really don't have much of a risk except for the FI selling, which has already been absorbed, I think, in the last couple of days.
Okay, fair enough. Since we're on the subject, let's actually look at the granular numbers. Exactly what have these companies said in the second quarter, which the market is taking note of, both Bajaj Finance as well as M&M Finance. We have Abhishek joining in with all the details. Abhishek?
Well, to begin with, Bajaj Finance, the new loans are up 13.5% YOY, but they have declined more than 11% quarter-on-quarter, which is seasonal in nature. Every Q2, you do see a decline. Now, customer base is up 20.3% YOY and about 4.5% sequentially. The deposit momentum is strong at 20.5% YOY and about 5.5% sequentially. But the AUM growth now, that's dipped to 28.8% YOY, which is the weakest growth that you are seeing in last 6 quarters, and sequentially it's at 5.6% quarter-on-quarter growth, which is the weakest in last 9 quarters. Now, cross-sell rate, that's disappointed massively. It's the lowest in Q2 of a fiscal in last few years, X of Q2 FY21 when we had the COVID impact. So cross-sell rate is down to 6.2% versus 6.5% in the same quarter last year and about 7.4% in the previous quarter. With respect to M&M Finance, disbursements and asset quality have disappointed. So disbursements are down 1% YOY, but they are up 3.3% sequentially. The assets are up 20.3% YOY and about 6% sequentially. This may indicate that, despite lower disbursements, AUM growth has happened. That means the tenure of the, disbursements done in Q2 have increased. So if you take a look, gross NPA ratio is up at 3.8% versus 3.56% in the previous quarter. Liquidity in the balance sheet is about 8,500 crore, which is up more than 6% on a sequential basis. Back to you.
Okay, thank you. But also tell us a little bit about HDFC Bank. First, the Q2 business update. And also there seems to be more FI headroom now that, the bank has released their shareholding pattern.
Well, to begin with HDFC Bank, the business update that has come in, clearly the focus is on credit deposit ratio, and deposit mobilization has been pretty strong for them on a sequential basis. Take a look at the overall deposit growth of 15% YOY, but more than 5% sequentially. In that, the term deposit is up 19.3% YOY and about 6.7% quarter-on-quarter. Advances growth is muted at 7% YOY and about 1.3% sequentially. We have been hearing the news of sell down of portfolios of HDFC Bank, and that's led to weak loan growth. The overall AUM growth is at 8% YOY and about 2.3% sequentially. The heartening point in the number is the credit deposit ratio. That's declined to 100.8% versus 104.5% in the previous quarter. Even the liquidity coverage ratio has improved sequentially to 127% versus 123% that it was there in the last quarter. With reference to their shareholding pattern that's being released for September, FI headroom now indicates the second tranche may be coming in November MSCI review. So if you take a look, the HDFC September foreign ownership limit is now at 55.5% versus 54.8% that was there at the end of the June month. So weight increase of HDFC Bank is at the discretion of index manager of MSCI. Back to you.
Okay. Thank you.
Okay, all right, Abhishek, thanks very much for that. I was just thinking it's the kind of market we're in, right? Because on any other normal day, say any day in September, because October things change, HDFC Bank coming out with, those kind of numbers, deposits picking up, the credit deposit ratio coming down, plus the fact that you'll have the second tranche of the sort of FPI money coming in, could have been a very different day for the stock. But right now it's just down about 1%.
And the fact that these are selling, these are large, banks is where FIIs are more than anything else, right? So I think that shows that there is selling, which absolutely seems to be coming in. Prakash, any thoughts on on DMart specifically? And Mangalam will join in a little later and we'll put those numbers in perspective as well. But, trades at about, I think, 75 times FY26 earnings now. The peak was 170, 180 times 1 year forward. That was back in 2021. So valuations have moderated quite a bit, but your thoughts?
So, Prashant, what seems to have moderated is also the PEG multiple. When you talk about the peak PE multiples of 21, It was in anticipation of, all the catch up that they were likely to, grow along with, and they did. So, but if you look at today, given the fact that, the last minute, the last mile delivery and this hyper delivery, models that have come up, they definitely do impact demand in a very indirect way. Let me tell you the second order impact. What does Zepto or a Blinkit end up taking away as market share? In value terms may not be much, but it takes away the entire, potential of a customer to go into a DMart to stock up on, the entire range of monthly groceries or needs. And because they know that they have the comfort of ordering last minute. Now, what happens is that you don't make those frequent visits to DMart. I know families that have a very regular, twice a month, once a month kind of a visit, which is planned. And that probably is something which will start getting a bit questioned. And if that were to happen, your PEG multiples will not look as healthy. So I'm sure we'll hear Manglam out in terms of the specific, metrics around it. But my sense is DMart will also have to get rationalized to some sort of thing. And remember, at some point, it's going to be part of the FNO, which means any bad news could also impact it much. So you really don't want a stock which is kind of getting into a territory where it gets vulnerable because of fundamentals and because of technical factors. So it's more ownership, intensity that's diminishing. I've seen a lot of institutions booking out of DMart for the last 3 months, and that will probably continue for some more.
What about Angel One? Angel One continues to see selling. It's down 31% from its recent high. At what point does Angel One become a buy, according to you?
Rima, this is something which had grown. This is the equivalent of PSU order books driving stock prices. Angel One has grown on the basis of all the promise that it has, and rightfully so, for different verticals that it sits on, the technology platform that they've kind of evolved themselves into. I mean, it's a formidable money-making machine, but whether you want to discount it to that an extent or not is the question. Whereas demat accounts have grown to 17 crores, so when we spoke about Angel One and when the market started taking notice of it, sitting up and taking notice, it was probably about 12 crores. So market has grown. The organic growth of the market is fairly promising. But is Angel One got enough differentiators to build market share? Is a big question. And remember, the era of zero brokerage and all that is probably gone, is behind us. No brokerage will be able to afford that. So how much stickiness can they ensure in this changing environment is what people would want to see, and then probably give it a look. So I don't think the business model has transformed dramatically, Rima, but at some point you would want to kind of put in a little bit of a skepticism into the numbers, especially the valuations, and kind of take a more realistic look. And today, of course, the mood of the market is such you can actually put a dosage of skepticism into everything, and then still kind of find it very rational. So I think it's just that season of a reality check, but it could lose some more ground on the P multiple expansion that it has seen.
Yeah, absolutely, Prakash. Take that point, reality check. And the market really remained true to its nature, because I think a lot of people would have debated around valuations, US elections, all of that, but perhaps nobody thought the correction, whatever little we have, would have come because China suddenly starts rallying. So once again, as the old textbooks say, that the only sort of fear is the unknown that you actually don't know. That's the only real unknown, right? So thank you very much for the perspective. Let's see how this settles and how we're placed by next week. But for now, the Nifty is dealing with a struggle around 25,000. We've dipped below that mark. And there's no let up in the selling, about 250 points lower on that index. Well, the India-China debate continues to be on. And today we discuss this with Alexander Redman of CLSA. He's the global equity strategist of CLSA. And we asked him about what he thinks about the rotation of money into China and perhaps away from India. Take a look.
What we've seen so far is a commendable delivery on the monetary policy side. We've seen some direct stimulus at getting the equity market animal spirits back alive, and certainly the retail investor has followed through on that. What will differentiate this one is if in the next weeks and months we get some clarity from the Chinese government, from the key policymakers in the Politburo, as to the magnitude and the scale and the deployment of a large fiscal package. Because let's remember, I mean, China's single biggest problem that it faces at the moment is immense oversupply on the real estate side. And you need a sizable fiscal package aimed squarely at local governments to be able to digest that. In other words, buy it off developers and turn it into social housing projects. India's been on a roll for several years now. You know, we've been a structural overweight. We've enjoyed that rally, but I've always been testing that because there is a certain amount of complacency around, or at least has been around the Indian equity market story, and a certain amount of consensus. And there are three things which I've been looking at to break that complacency. So you've seen regulatory changes which have dampened the ability of retail investors to participate in equity derivatives. You've seen the geopolitics in the Middle East become more of a flashpoint, and that's aggravated the oil price as we all sit now waiting for Israel's response to Iran's missile strike. And you've seen significant pickup in primary traffic. So, the volume of IPOs and secondary issuance has picked up as well. So all three of those, I think, in combination, are certainly testing the Indian market.
From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros, and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhat.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
There are three issues going on simultaneously. One is China, some model on which they are doing this futures arbitrage and all these millennium kind of guys. And the third is that separately, I think it is going on in parallel that if you have more than 25,000 crores in India, you need 100% disclosure of your end investors. And many of these platform guys will have more than $3 billion and they have to basically reduce their weight in India. So who knows what is the exact reason? But I think the best answer for that would be to call some broker and ask him that is it hedge funds who are selling? So I think the market continues to be strong because my big picture thesis is that India itself was doing okay. If the rest of the world is also doing okay, then there is no reason for us to feel too negative. The only issue could be this geopolitics. But as of now, even the oil prices are not that high, which show that there is an imminent attack happening, although President Biden said some few things which confused the oil guys for some reason. But coming back to us, so we, first of all, have been more or less fully invested, so we don't have much. But the general big picture thumb rule would be any stock that you own which is down 5, 7, 8% without any reason, you buy 0.5% more of that.
Investing.
Welcome back. Well, markets are down 260 points. 25,000 is gone. 24,992 is where now the index is trading at. It's a 1% cut. So it's turning out to be, I was seeing the 150 odd point bounce in the mid-afternoon. I was thinking, well, this is a good Friday. A good way to end after the bloodbath we saw yesterday, but no luck. For the week, Friday to Friday, if we end with this 240 point cut, Nifty is going to be down 4.5% for the week with a holiday thrown in between. I don't remember a 4.5% week on the downside in a long time now. So, yeah, you basically have given back last 3 weeks worth of gains with what we've seen over the last 4 sessions now. Ajay Vora is with us, Head of Equities at Novama Asset Management. Ajay, good to have you here. Thanks for your time. I'm sure you're someone who follows flows and the color pretty closely in terms of what's going on out there. So tell us what's going on. Pretty much everyone we've spoken to, we've asked the flows question, and generally, if I can paraphrase without being too offside, it's that maybe in the very near term, a lot of the money which is leaving perhaps is being used to fund exposure to China, but it's like a week, fortnight thing. So with that preface to my question, tell us what you're picking up.
Sure. So good afternoon, Prashant, and thanks for having me on the show. So I think the bottom line, Prashant, is that markets are lacking any positive triggers. If you look at it, before the Fed cut the rates on 18 January, our markets were somewhere close to 25,000 odd, and everyone was trapped into that rate cut, on both the sides. So if you look at the positioning, HNIs were heavily short on index, and FIs were also not fully deployed as such, I would say. And that move led to FI increasing their longs, and eventually HNIs had to cut the short. So broadly, we got around 5 to 6% kind of a move post the rate cut, and now over last maybe 3 to 4 days, that has just got negated, right? So we are back to 25,000 odd levels. The point is that we are lacking fundamental positive triggers right now. And on top of it, you have two major, I would say, variable events which has come to the surface. One is on the geopolitical side, and secondly, the whole China angle. So, whenever the markets lack triggers, something of this sort comes to surface, it will result in a lot of uncertainty. The way I look at it, this is a really healthy period for the markets, I think, because if you look at it, since April till now, our markets are up close to 15% odd. And we are seeing, a decent earnings cut last quarter as well as this quarter. So my point is that, if the overall earnings growth, which was expected to be, say, 15-16% earlier, I think we'll end the year somewhere close to 10% odd. And versus that, we have a market which is already up 15% for the year. So I think it's important to consolidate here with some sort of, correction, more correction over next maybe couple of months. But I think that will be really healthy. Just to gauge, where exactly now the next trigger will come in terms of the sector allocation, and basis that, we'll see performance going forward. But I think this is a healthy correction. The China angle is definitely playing out, and that can continue. But that doesn't take away the earnings growth trajectory for India. So that's how we look at things.
So you're saying the earnings growth for FY25 is just going to be 10% versus estimates of 15-16% at the beginning of the year?
Yeah, so actually, if you look at it, Rima, last year we have ended at somewhere close to 980 odd. We started the year with somewhere close to 1130, 1140. That number is already down to, I think, 1090 or 1100. So broadly, we are looking at 10-11% now versus 14-15% earlier.
And how much will that hurt? Now, we've already seen about a 5% correction from the top. Now, in the last, 1 or 2 years, we haven't seen even a 5% correction, or at best, it's been a 5% correction before a bounce back takes place. So if in the Q2 earnings, we continue to see some downgrades, do you expect downside in the market?
So I think it's important for us to change our habits also regularly. We should not get used to not seeing a 5% correction also in the market. So my sense is that, the whole sector rotation will continue. We saw, auto and pharma being the best of the sectors last year. And the earnings is still pretty strong, but the valuations doesn't leave enough room for upside. On the other hand, I think that, if the rate cut cycle continues in US and that too on the aggressive side, I think the IT as a sector will continue to see some sort of, order book building up, which will result in higher visibility of growth. So I think that, IT and on the other hand, metals, these two sectors are really well positioned from here on. Domestically, if you look at it, I would say banking is still a bit on the struggling side because, on the unsecured loans, we are going a little slow. On the NIM improvement also, we are going a little slow. So I think that the banking, which is a very large sector, will have this overhang going forward. As I said, auto, pharma, they are more or less getting done, and therefore we need to look for different sectors which can take leadership. So markets can stay in a range, but as money managers, it is important for us to identify the next big opportunity.
Ajay, hi. Afternoon. You're the second guest today who's pointed out a sense of complacency. In the morning, you were in conversation with Alexander Redman of CLSA. That's exactly the point that he was making, that the Indian market perhaps is getting a little complacent. It reminds me of a dialogue from an OTT serial which played a couple of years back, and that dialogue went in Hindi कि अपन को लगता है कि हम ही भगवान है, right? So I guess it tends to happen. That's what bull markets do to you.
Like small, not hum, apun. What is it?
अपन को लगता है मैं ही भगवान है. If I could, I'm taking the liberty because it's a Friday, right? Eventually we'll go back and have a good weekend. So exactly, I think everybody's guessed which particular series this was. But yeah, I think that's what bull markets do to you, right? Because the whole valuation chatter was being cast aside because prices were moving higher, because liquidity was so heady. So therefore, your point is well taken, though the bulls may not actually like it right now. Okay, let's talk about Q2. You gave us the earnings projection for the full year, but the here and now, because we're running into the season and the litmus test is upon us. The board exams are here. Where do you see the biggest, perhaps, pain points? What should we be prepared for, where probably there would be a disappointment, and maybe earnings projections will have to be revised downwards, and maybe stock prices will need to move down as well in Q2?
So I think that, still on the growth side, IT will see, the numbers to be muted. But the point is that, that whole narrative is behind us, and people are more looking towards the incremental growth or the expectations of further order book buildup going forward. So I think that more than numbers, the focus will be on how the TCV actually shapes up over next 2 to 3 quarters. On auto, also actually, if you see that, this is the start of the festive season, and we will see some sort of inventory buildup, and therefore the numbers have been good. Raw material prices were a bit lower, and therefore the margins will also continue to remain good on that particular front. But I think that overall, if you look at it, a major disappointment last quarter, which was from OMCs, oil marketing companies, that will not continue in the current quarter because of the healthy marketing margins which they made in this quarter. So my sense is that overall, you will not get a major disappointment anywhere. But the point is that, the 13, 14, 15% expectation is slightly getting pruned quarter after quarter. And once, market digests that this year it's not going to be double digit and it can be maybe 9-10%, we can see some sort of further pullback on the markets. So I think no major negative surprise as such is what we are building.
All right, fair enough. Ajay, we'll leave it there. Thank you very much for joining us, and good perspective as always. Have a good weekend, and we'll come back next week maybe with better tidings, better news and better markets as well. But for now, we're down a little over 1%, actually 1.1, 1.2% at this point in time. Before we take that break, maybe I can just put out, this is an interesting bit on geopolitics, markets, oil, Iran, Israel, etc. And this is coming through from Christopher Wood, who writes the greed and fear note at Jefferies. And I just want to read some of this out because I found it interesting. Maybe you will as well. He says Israeli Prime Minister Netanyahu has continued to take advantage of an ineffective power vacuum in Washington, which is fast changing the balance of power in the Middle East. Second, he says Iran has finally been provoked into a response which seems to have been the aim of Netanyahu all along, lays the groundwork for further escalation. Number three, he says it's no surprise that Netanyahu's popularity is soaring in Israel, which is likely to give him further confidence to continue on his current path. Number four, he says the risk for markets, and he comes to markets now, he says, is that Israel attacks Iran in a more direct fashion and that the Iranian leadership finally decides to respond in a more telling way by, for example, closing the Strait of Hormuz or attacking US military facilities in the Gulf. So that's the escalation, and that's the one which markets, according to him, will react to, and they're not prepared for as of yet. As he goes on to add, he says that, as for sort of weighs in with the US elections as well, he says, as for Trump's view on what's happening in the Middle East, Trump has always been solidly pro-Israel. Still, Trump does not like wars and he's intrinsically unpredictable. This is a further reason for the Israeli PM Netanyahu to use the current power vacuum in Washington to advance his agenda as much as possible. And then, he sort of winds down with a bit on China as well. He says valuations in China have moved up. MSCI China is now trading at 11.5 times 12-month forward earnings, which means that it's no longer as cheap as it was when this rally began, and hence markets there are vulnerable if the recent easing measures do not succeed in triggering a re-acceleration in nominal GDP growth. And he says the recent easing package in China and the market's dramatic reaction is further reminder that the policy in China is essentially now made by one man, that is President Xi. So I just thought, interesting bit coming through early this morning from Christopher Wood on, of course, some of the hot button issues that we're looking at. We'll take a break. We'll also just leave you with the soundbite coming in from a large foreign investor, head of multi-asset at Wantable Asset Management, Dan Scott, talking about his top choices as far as portfolio allocation is concerned. Listen in.
Well, gold, we've been overweight for a few years now. So, we're holding on to that one because we still think that the structural long-term drivers are in place, that central banks outside the G7, not just China and Russia, but also India, South Africa, etc., continuing to stockpile gold. It's a long-term de-dollarization story. And de-dollarization is another part of the conviction that we have longer term. Another way, of course, that we play it is the long-held overweight that we have in emerging market debt. The compensation I'm being given through the high yields in EM debt are, definitely rewarding, much more rewarding, I would say, than the compensation I'm giving and the risk I take in high yield, for example. So in the fixed income market, EM debt overweight is another one of our convictions that we're holding on to. The CSI is one of the better performing markets now year to date. So it's gone from being the market that everyone hates, no one wants to own, to all of a sudden, everyone trying to jump on this bandwagon. But I would say at this point, it's still a trade because the stimulus measures were impressive, no doubt. Also with targeted measures for the property market, which is the most important part of the problem set that China has that needs to be fixed. But property prices haven't, gone up yet. And in fact, the stimulus measures really are there to provide some sort of a floor to property prices. But I would say if you want to see the Chinese consumer come back, you need property prices to go up, not just to be stabilized. And that in combination with all the problems you already know about, demographics, 20% youth unemployment, etc., governance issues as an equity investor, would mean that right now it's a trade I'm happy I'm going to miss out on.
what we've seen so far is a commendable delivery on the monetary policy side. We've seen some direct stimulus at getting the equity market animal spirits back alive, and certainly the retail investor has followed through on that. What will differentiate this one is if in the next weeks and months we get some clarity from the Chinese government, from the key policymakers in the Politburo, as to the magnitude and the scale and the deployment.
Welcome back. It's bounced back above 25,000, but still down, more than 200 points on the Nifty. Zomato is holding up in the green today, so that's up 2.5%. Paytm is down, under pressure, 4.5% low on Paytm today. But for the week, it's still going to close with gains of about 3.5%. And in banks, it's Bank of Baroda, Yes Bank, PNB, SBI, where there is still some green on the screen. But let's go across now to Nimesh for D Street Chatter. Nimesh.
Hi, Rimaira. Today was a classic day of two halves. The first half was quite good. We saw a good recovery as well. And even in the first half, the indication was the FI selling is not that large. But all that changed in the second half once Europe opened, because I understand there was a very large basket selling at a leading FI desk. And that's the reason why you're seeing big pressure again in the large cap names today. Again, the biggest pain is in the rate sensitive. So the real estate stocks are under pressure. So is auto names, so is the bank names as well. So that's one pocket which is seeing a big aggressive selling. And OMCs are still under pressure because the crude has again rallied back to 78. So those pockets is where a large selling seems to be. Metal seems to be in a sweet spot. So even in a weak market, there is buying interest in metal names. So there is delivery-based buying happening there. But within financials, again, we saw a bit of recovery in the intraday, but that got sold into. And again, I understand there is aggressive selling in the private bank names by larger FIs today as well. On the Nifty, we've broken some crucial support levels. So the next level on the downside to watch is around 24,600 to 24,700 level. So that's something to track. But I guess all change in the second half on the back of an aggressive basket selling at leading FI desk.
Okay, we'll watch the flows figure very closely. What about stocks, Nimesh?
Well, even in a weak market, there are some stocks which are buzzing in trade. The first stock is Healthcare Global. In a weak market, that's up 5%. The volumes are on the higher side. Looks like the street is anticipating a large corporate development very soon. Remember, for a very long time now, there has been an anticipation that the P holder or the P promoter is looking to sell its stake. So that's something which can come very soon. So that's a trigger as far as Healthcare Global is concerned. The second name is BF Utilities. Even that stock is buzzing in trade for the last 2 days. The stock is up 10%. The volumes are on the higher side. I understand a leading influential HNI investor is an aggressive buyer in BF Utilities of late, and hence a big up move there in a weak market. Third, DLF and Macrotech. While the real estate basket is under pressure, DLF and Macrotech stands out on back of very aggressive selling pressure from leading FIs in today's market. And the last is Indus Tower. The stock is in the red, but for the second day running, there is buying interest from larger FIs. So expect high delivery volumes, but those are largely on the buy side.
Healthcare Global, BF Utilities, DLF, Macrotech, and Indus Tower as well. Nimesh, Healthcare Global, I mean, is that the deal where the PE was getting out, right?
That's right.
That is still it's still in the works, because it's been, I think it's been at least a few quarters now, right?
Oh yeah, exactly. In almost 3 quarters now that the buzz was there that CVC wants to exit. Looks like it's in the final stage now. I understand a couple of private equity investors are in the final stages. So looks, again, for Healthcare Global, Prashant, while we all know that CVC is a likely seller, what is going to be more interesting is whether the Indian promoter also sells out. CVC owns 60%, Indian promoter owns 10%. If the entire 70% is sold, then there is a potential open offer and a potential delisting offer as well. So we don't need to speculate on the delisting part. But I guess that's something to track. If both Indian as well as the PE investors sell out, then we need to see how things pan out, because 70 plus open offer would virtually mean that there could be a delisting as well.
No, that's interesting that this is, in a way, just picking, one was hearing that maybe it's not really going anywhere and some of the bidders have backed off, but interesting that it's as you're saying, well, you're picking up that this is happening and maybe in the final stages. We'll see. I remember asking the CEO of the promoter of HCG, whether they prefer to have a hospital company or another investor instead of CVC. They said, well, we'd prefer a financial investor and not a hospital company there for that CVC stake. Thanks very much, Nimesh, for that. So that is, I mean, a few stocks there to keep on the radar. Ashish Kyal is with us with what to buy or sell today for a reverse trade when we come back on Monday. Ashish, what do you have?
See, if you look at, it's going to be buy and sell both because the markets are not looking good. 25,000 is flirted around. We are managing to move far that above it again, but it looks a little tricky. Having said that, I think the one stock which is outperforming in this kind of market also is Whirlpool. You can clearly see touching that 52-week high. Even today's session, there is absolutely no impact of the broader sell-off that we are seeing in the mid-cap and the large-cap names. And so one can create long positions in Whirlpool. Maintaining a stop loss of 2290 and expecting a target of around 2,520. And the other stock is going to be on sell side. It's a reversal trade on Piramal Enterprises. We can clearly see the stock has broken below the support level. There is absolutely a carnage over past 2 days in the stock also. So one can create short positions here, more room left on the downside, expecting a target of 970 and stop loss can be maintained at 1,065 levels.
Okay, thank you very much for that. Let's revisit some of the big movers of the day. On the way down, it's Avenue Supermarts following their Q2 business update, where growth appears to have slowed down. Mangalam joins in for details. Mangalam.
Well, 14% growth is what the company has reported in the second quarter, which is lower than, the 3-year average as well. And at the same time, the last quarter, which is the first quarter, they showed revenue growth of about 18%. So it's lower than that as well. And if you add to the fact that over the last 1 year, the store addition has been around 12.2%, that leaves you with same-store sales growth of just about 1% or 1.5%, which is much lower than what we've seen in the past couple of quarters as well, which is why the street is a little disappointed. The only 3 possible reasons that one is gathering in terms of reasons for this slowdown in growth. The first one, of course, is that there were heavy rains and some flooding in parts of Maharashtra as well as Gujarat, which are bigger catchment areas for these companies. So as a result of which, footfalls were lower. The second major reason is that, there could be a back-end technical change that the company has been doing, as a result of which there were a few days of lost sales as well. And the third reason, of course, which everyone's intuitively talking about, is the impact of Q-commerce. The extent of either of the 3 is not entirely visible. So we'll keep an eye out on gross margins and the performance of their own Q-commerce business when the company reports its numbers next week as well. Until then, we'll keep an eye out on DMart, which is seeing a lot of volume activity today as well in, on the downside.
Okay, thank you very much for that. We will get into a break. We'll come back with more.
Of a large fiscal package, because let's remember, I mean, China's single biggest problem that it faces at the moment is immense oversupply on the real estate side, and you need a sizable fiscal package aimed squarely at local governments to be able to digest that. In other words, buy it off developers and turn it into social housing projects.
Actually, I don't think it's a bad thing if China market does well for us, as in mostly for India. It is not bad for India per se. I don't think that beyond some shorter term thing, investors have to sell India to buy China. Because India, I don't think in aggregate, people are overweight. There might be 1% plus minus overweight. So if you were underweight China, that would have come from the rest of the world. India and China, even an emerging market fund combined would be, say, 20 and 25, 26 now. So half the investment of people who are able to move this around is in non-India, non-China.
I did not underestimate Senator Vance as a slick talker. He could. But I also called out there, you can't rewrite history. You can't rewrite history. And trying to mislead us about Donald Trump's record, that's gaslighting. That's gaslighting. The moment that really stuck.
All right, Gurmeet Chadda is now with us. Welcome back. Markets down 200 points or so, and we're having the worst week we've had since the beginning of this year. Gurmeet, good afternoon, and good to speak with you. Tough markets. What does one do, Gurmeet? You got to. I mean, to enjoy the good, you got to go through the bad as well sometimes, right?
Oh, absolutely, Prashant. And, I think all three came together. China's stimulus came, Iran-Israel escalation came, and you saw the SEBI tightening of rules. I think you've got to differentiate now. I think this particular FI sell-off is more tactical. It's not structural. It's largely led by the China stimulus. And just to give a perspective, China, 30% GDP is real estate. 70% savings of Chinese go to real estate. So any stimulus which affects the reality market will attract attention considering the large underperformance, almost 10-year, 15-year underperformance. So I don't think so this is structural, which means, and I've always said, whenever India falls for non-India reasons, it's an opportunity. Where we need to now focus upon is that some of the updates have been soft, like the auto updates, the services PMI also was a tad soft. The capex is slowed down. The government capex, if you see, we will undershoot. Defense budget, they've underspent 20% so far. Road, they are underspent 35%. So I think that needs to go up for things to pick up. So you got to be now selective in terms of what you want to buy. But I don't think so. I think bull market corrections are also sharp, and so is this one.
Anything you've done for your clients, Gurmeet, last couple of days?
Yeah, so we've been adding large caps like Reliance, Tata Motors of the world, few banking stocks. We've added some PSU banks because they are below book value. Bank of Baroda had a very good quarter update. Retail deposits grew 20%. You have to track deposit growth now because RBI is very keen on credit deposit ratio at about 85-90%. So deposit growth becomes, especially the granular one, becomes good. We've added Federal Bank there. We're adding some quality NBFCs and banks will also have a lot of treasury gains. The 10-year bond yields are down almost 30 basis points from, let's say, June till now. We've added some names in defense with this current fall. We are adding to build some more names in the recycling space, which is in plastics, in water, in lead, etc. And we are now scouting for a little bit more opportunities in data center and the telecom value chain.
Okay, all right. Gurmeet, I think we'll have to start winding up over there, getting to the close of what's been a really trying week for the market. Thank you so much for joining in. As we start the final countdown, the cut is about 208 points on the Nifty, and for what it's worth, at least the index has managed a bit of a pullback. I've been saving grace that the close is going to be above the 25,000 level. Now, that's the Nifty. The mid-cap index has actually fallen in step with the Nifty today. Again, a cut of about 0.9%. Bank Nifty is relatively better off. Let's talk about where the damage was most apparent on the index. On the large cap screen, M&M, Bajaj Finance, Nestle, BPCL, Ultratech Cement. These are some of the weakest performers, and you can see it's just cutting across sector lines. There are really no trends today, just top-down selling. A lot of consumer names actually have come under pressure. Asian Paints, Britannia, I mentioned Nestle earlier, Lever, Cipla, no hiding in consumer or in pharma for that matter. On the flip side, a little bit of buying on IT, Infosys, Wipro, Tech Mahindra, and TCS. These are the names that stood out. And the reason why we're managing a close above 25,000 is probably because names like SBI, TCS, they were putting up a bit of a fight. And of course, Infosys was the best performing stock, 1.5% on the upside. But, well, what do you say? For the week, we're talking about the Indian market losing, I think, just about 4% on the Nifty. Let's check the final levels. So, yeah, it is a 4.4% drop, and I think Hormaz was earlier telling us this will be obviously the worst week for the year, and probably over the last 1 or 2 years we've not seen a 4.5% kind of drop at the index level for quite some time.
Cuts across the board, right? I mean, as far as large caps, etc., are concerned. So I'll just tell you in terms of the Nifty pack, Mahindra & Mahindra was a top loser with a 4.5% knock coming through. Bajaj Finance was down 3%. Nestle lost about 2.33%. Asian Paints was down 2.25%. BPCL was down 2.5%, and Hero MotoCorp was down about 2.25% or so as well. So that's the sort of top losers on the Nifty. Gainers, Infosys, 1%. Actually, there were only 3 names with gains in excess of 1%. There was Infi, there was ONGC, and there was HDFC Life. That's it. So it was, I mean, a tough one, all said and all told. Broader markets, lots of action, lots of movers, but suffice to say 1,800 stocks lower and about 1,000 stocks which basically were higher by today's session. The number one loser, actually the listed losers, big volume-led losers is interesting. It's Adani Energy Solutions down 5%, Reliance Power down 5%, Reliance Infra down 8%. So these are the top 3 volume-led losers. And then of course, Mahindra & Mahindra Finance was down nearly 7%, that pre-quarterly business update. KRN Heat Exchangers, 6% cut, Amber down 5%, K Fintech, EPAC Durables, Edelweiss back to 120-ish from the nearly 150 it had to hit recently, and so on and so forth. So, I mean, a fair bit happening, and, tough one, absolutely. Let's see if we see more developments out of the Middle East, because I think that's what markets are waiting for, that big Israeli retaliation, which will happen, but we don't know when and what kind of damage and further escalation it may or may not cause. So we'll, of course, track all of that. Programming will continue here. It's a wrap on this edition of Closing Bell, but Editor's Roundtable is coming right up. Stay with us.
The simplest of all questions that every single American should be able to answer. I asked him if Donald Trump lost the 2020 election. He refused to answer.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajaj at these times on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18, an unending pursuit for excellence. A pioneer, a leader, a visionary, building a lasting legacy of credibility, consistency, and trust. Giving unparalleled access to global thought leaders and powering conversations that are shaping the new world order. Setting the highest standards through exemplary leadership. It is this unrivaled reputation for the most comprehensive coverage, actionable intelligence, and in-depth reporting that makes CNBC-TV18 India's #1 business news brand. Foreseeing change, growth, and transformation for over a quarter of a century. Trendsetters crafting innovative content formats. And award-winning business journalism. On air, online, on social media. As we embark upon 25 years of excellence, we invite you to be a part of our future. CNBC-TV18, your trusted partner and investment ally.
What does it take to build India?
Weak global cues and tensions in West Asia keeps Dalal Street deep in the red. Markets record their biggest weekly fall since June of 2022. Investor wealth of 18 lakh crore rupees wiped out this week. On this week's edition of Editors Roundtable, we decode the market action. We put the spotlight on the massive FI selling, and we tell you what to expect from IT in the second quarter. I'm Reema Tendulkar, and with me are Prashant and Nimesh. Hi guys, so much can happen in 1 week, right?
And that too in a truncated week, right? I mean, we just had 3 days and look what happened to the markets and what the kind of FI flow which has been. Like, it's crazy.
4, right?
4 days.
4. Yeah, I mean, sorry, 4.
But, absolutely agree, because sometimes when markets are doing very well, we wonder, well, what can go wrong, right?
Yeah.
I mean, there's nothing on the horizon which can go wrong. But as it is always the case that the risk comes from somewhere which you can't foresee at that point.
Yeah.
Who would have thought that China suddenly doing well is going to cause, is one of the reasons.
Yeah.
And of course, as Nimesh said, 2, 3, when it rains, it pours. There is China, and it happened in a real size way when we were shut. I mean, the day before, there was Middle East tensions that Tuesday evening, the flare-up which happened together. Oil prices are up $7 since. So I think it's all kind of coming together, and earnings as well. So that Dabur numbers, I mean, actually, you take a look at the financials, Dabur, DMart.
SEBI F&O, not to forget that.
That also was Tuesday evening.
Tuesday evening.
Yeah, exactly. 1 week and, things can change. And the difference between last few weeks and this week is, until last week, I've been saying, for a while now that the feedback is people are not making money. This is a week when people have really lost money. Yeah. And this is just a beginning. And we've not seen a sharp fall in the mid and small cap. That's where the large amount of money is. It's not about Dharana. The fact is, this week was all about large caps, right? And in fact, the feedback was, now it's a time for large caps to do well. I did a piece as well. Yeah. So, and you've seen a sell-off like what? Yesterday, the Reliance net selling was almost 4,500 crores. That's the amount of selling.
Actually, from the recent respective peaks, I mean, actually not the respective stock peaks, but from the Nifty made a high, which is, I think, 26th of September.
27th September.
27th of September. Friday. Reliance is down, I think, about 8%, 8-9%. Axis, HDFC, and ICICI are down between 5 and 6.5%. And of course, L&T and a few others are. So, I mean, now is the time for large caps. Exactly. And boom, I mean, you've got.
And the fact is that none of these, large, losers have reported the quarterly update. So it's like not that there is a fundamental reason for them to fall. It's only pure FI selling which has dragged the stocks down 8 to 10% in just 1 week.
I just want to say one more thing, and this is interesting because I've not heard it anywhere else. An investor messaged me, he said this, to his mind, he said it looks like when China reopened after COVID. So if you remember, chemical companies here were going through this mad bull market. And then China reopened, suddenly Chinese factories were up and supplies came back on. And that was a top for the Chinese, for the Indian chemical companies. And then started their de-rating process. So, I mean, China in a different way, sort of acting as a bit of a gravitational pull for what's happening here.
In fact, it's great to introduce then Aman Chauhan, fund manager at Abacus Asset Manager. He's with us on the show. Aman, thank you very much for joining in. So what did you make of the kind of carnage, the bloodbath on Dalal Street? And do you think this is the beginning of a deeper, widespread correction in the market? Aman, you're on mute.
Yeah, hi, sorry. Not really. I think the fast money has moved out of India and maybe some of that has gone to China, but it's not, I don't think it's an India versus China kind of a trade. In the near term, maybe there could be some tactical money which could move to China, but India is getting it inflows on its own merits. The growth rate here is improving and people are not increasing the allocation in China. There could be a trade there because obviously valuations there are much more attractive than what in India is. But we are at least not looking at this as an India versus China kind of a story.
Right. In terms of doing anything at all, Aman, have you done anything over the last 5-6 days? Have you been adding or watching?
Adding, gradually adding, not aggressively, but gradually adding. So we had cash in our portfolios waiting for days like this where we get a better entry point, and we have used that gradually to increase our exposure, but nothing substantial as such, but definitely not selling just because of this.
Okay. Any feedback you've got? I mean, do you also, because I mean you've been in the markets a long time, Aman. Money is fungible, right? I mean, we can speculate at best, intelligently speculate whether this money which is leaving India is going to China. But do you reckon some of that is happening at the margin?
Yes, definitely it is happening. So hedge fund money, fast money, long short money, that money is definitely moved out of India and moved to China. So people have booked profits in India, they're sitting on good profits in India. And once you see momentum coming in China, it could be for some other country also where they see a momentum. Right now it is China. So that fast money, hot money has definitely moved and gone into China.
In fact, let's talk about then this money which is moving perhaps away from India into China. Nimish, you've done some numbers and some analysis.
Well, Rima, we are used to records, right? And this week was a record as far as the FI selling is concerned. Let me just go to the wall and explain why I'm saying this. If you look at this week, as I said, it's a kind of a record. It's been the highest single-day selling by FIs in the India market. Yesterday, we saw a figure of 15,300 crores. That's the highest single-day selling in the last 4 years as far as the India market is concerned. This is the number that I'm talking about. 15,243 crores to be precise on a single day that the FIs have sold in the India market. But if you break down that, that selling was largely into 4 or 5 large cap names. The split will come up. Reliance saw delivery-based selling of close to 4,450 crores. HDFC Bank close to 3,700 crores. ICICI Bank close to 1,700 crores. Axis Bank nearly 1,700 crores. And Tata Motors almost 1,500 crores. This is a single day delivery-based selling in the 5 large names, what we saw in yesterday's trade from an FI perspective. But if you look at the overall FI selling, it's, as I said, yesterday was the highest in terms of numbers. These are the top 5 in terms of large selling. June 4th, the election, the outcome, when we saw 12,500 crores of selling in a single day from FIs, 10,500 crores on Jan 17th. Again, August 5, 24, we saw nearly 10,000 crores of selling in a single day. So is on Jan 18, nearly 10,000 crores. And September 30, we saw close to 10,000 crores. So these are the 5 large selling days as far as the FI selling in a single day is concerned. But again, as I said, this is kind of a record for us as well. But if you look at this week, in the last 3 trading sessions itself, the FIs have sold nearly 26,879 crores. That's the kind of number you've seen only in the last 3 days, and that's also because China has been done phenomenally well in the last 1 week. To this week, it's shut, and that's the reason why. However, this year, the FIs are still net buyers, but that's largely because of the block deals. That is close to 70,000 crores. So that's the FI number for the whole year. But as I said, this week is what we need to take into account. Now, CLSA put out a note just 1 week back, and this is what their view was. They believe the selling can intensify largely because 90% of the money in the emerging in India comes to the non-India dedicated funds, which is the EM funds, and that's where the large supply is going to be. So there is a risk of selling India to fund Chinese market, at least in the short term. That's the CLSA view. And on back of that, they've identified few stocks. In fact, they say that they've seen a similar correlation when India got sold into, when the Chinese market rallied in November 2022. They've identified few large cap names which are vulnerable to sell off if this money moves from India to China. Within the PSU basket, Oil India, IOCL, these are the few names to track. Even BHL is what they are identified, which can see selling pressure. Godrej Properties, Bajaj Auto, Ambuja Cements, Macrotech Developers, and Voltas. These are the few names which are vulnerable to FI sell-off, largely because there is a FI holding and the stocks have done well. But clearly, this was a week when 20,000 crores in a single, in just 3 trading sessions. So that's the kind of sell-off we've seen from FIs in just 1 week.
Absolutely. And, let's put some of this to Aman as well. Aman, you heard Nimesh explain what has happened, and the last point, which is what is the most vulnerable part of the market. You want to weigh in, Aman, valuation-wise or ownership-wise, positioning-wise?
So typically what happens is when you want to create liquidity, you tend to sell something which is more liquid. It may or may not be fundamentally right to sell, but you need liquidity on that day. And for that reason, we have seen more of large cap selling than mid caps. And within large caps, obviously the financial markets, the banking stocks have been the most vulnerable. As he mentioned, HDFC Bank, ICICI Bank has seen the maximum selling along with Reliance. So these are one of the most liquid names in the market. And that is where I believe bulk of the selling is limited. Also, what happens is not every money that India gets is direct money. It comes via emerging market funds, and also lots of passive money comes in, which is your index funds. Within this, there is easy flow coming out. So we can decide whether to exit India and get into China or some other market, right? So the ETFs, I believe bulk of the selling has also happened because of the ETF flows going out of India. And that's, I believe, bulk of the selling pressure would have come in. And hence should not be taken as a fundamental view that something has gone wrong with India, something needs to be worried about. It's more of a, you can say, liquidity tactical move, which we have seen.
Aman, how concerned are you about earnings disappointments? Because so far the Q2 business updates, whether it's from Dabur, Avenue Supermart, M&M Financial, they've all been a bit tepid. Is this a big worry for you?
It's not, but it's definitely thinking point, and we are very closely monitoring this. Most of the companies that we speak to are talking about a second half recovery. So they are seeing that the second quarter also has not seen a decent recovery, but post monsoon, then a good monsoon, everybody is expecting the festive season in the 3Q and 4Q to come in and pull the demand or pull the growth rates up. That is a key monitorable, because if that doesn't happen, then the premium at which India trades is at risk. So far, not too worried, because the expectation is more for a 3Q recovery than a 2Q number right now. But monitoring the 3Q is very critical.
Aman, you briefly spoke about deploying some money in this fall in the last few days. While the fall has been largely in the large caps and you all are more into the mid and small cap, what has been generally your buying interest? Are you buying still into the mid and small cap, or you are gravitating towards the large cap names now?
No, for us, it's never a large cap versus mid cap trade. We find value within large cap and within mid cap at any given day or any given point of time. So the deployment has been mixed. It has been both large cap as well as mid caps. Stocks which were on our radar, waiting for a better entry point, is where we have deployed cash.
All right, Aman, stay with us. What we're going to do is take a quick commercial break here. We'll come back, but I just want to leave you with some of the important voices, especially on the global side that we got. Putting into context what we've seen flow-wise between the selling here in India and, of course, the rise we've seen in China and the interpretation thereof. Listen and take that break. We're back.
I think, look, there's a lot to like in India, as you guys are extremely aware. So the combination of demographic plus productivity gains, digital inclusion, infrastructure, and so forth. I think the big picture in India continues to look very, very favorable. I do think if China is going to follow through on its stimulus promises, which we may see as soon as next week, it's quite likely that some of the money that global investors have put to work outside of China, be that in other emerging markets or other parts of Asia, probably gets pulled back into China.
Even though flows to India funds have definitely waned, they haven't gone negative, and I think India remains in quite a healthy position. It looks to me, at least from this week, that investors were pulling money out of liquidity funds in Europe to fuel this rotation.
What we've seen so far is a commendable delivery on the monetary policy side. We've seen some direct stimulus at getting the equity market animal spirits back alive, and certainly the retail investor has followed through on that. What will differentiate this one is if in the next weeks and months we get some clarity from the Chinese government, from the key policymakers in the Politburo, as to the magnitude and the scale and the deployment of a large fiscal package. Because let's remember, I mean, China's single biggest problem that it faces at the moment is immense oversupply on the real estate side. And you need a sizable fiscal package aimed squarely at local governments to be able to digest that. In other words, buy it off developers and turn it into social housing projects.
Our platform. It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself as India's longest running show on startups and entrepreneurship. Celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBC-TV18.com.
Welcome back. You're with us here on Editors Roundtable. Tough week. Worst we've had all of 2024 so far, with a 4% cut Friday to Friday, and that too with the holiday thrown in. So one can only hope the next one perhaps is a little better. But we are, of course, discussing what was top of mind, and what will be top of mind will be earnings season, and IT will be off the block first. TCS reports on Thursday. Rima, are we expecting any recovery, or is it going to be a little subdued?
Well, no recovery. So Q2 growth rates should be similar to what we had in Q1, or maybe slightly better, because US banking and financial sector continues to recover. Margins will be largely stable. Management commentary to remain unchanged from Q1, which means they will still indicate the discretionary spending has not come back. It continues to remain cost optimization and large cost takeouts. But you have to keep the context of where IT is in mind. Now, in the June quarter, the Nifty IT index rallied 16%. From 1st of June to now, the Nifty IT index is up 30%, and at the same time, the Nifty is up close to about 15-16%. So massive outperformance, and valuations too are rich compared to what they've been in the last 5 years. But that said, even the market itself is trading at valuations higher. Most of the sectors are. So, now I think what analysts are saying is that, the narrative is that growth is going to recover. We've seen a valuation re-rating. Investor positioning, which was deeply underweight, perhaps has now become neutral, but now numbers need to follow, or at least the commentary, the guidance needs to show that there is a recovery underway. So now the key to track will be Infosys guidance for the full year. Now it currently stands at 3 to 4%. The question is, will they go ahead and up the guidance? Many on the street believe there is a case, given the kind of deal wins, the ramp up. So Kotak is talking about a guidance increase of 100 basis points, 4 to 5%. Citi is talking about an increase in guidance. CLSA maintains that Infi will hold on to its guidance, but they say if they don't, it would be a negative trigger for the market. Secondly, quickly. The street expects that in FY26 there will be margin expansion, but so far that margin expansion hasn't played out. So commentary regarding whether this thesis of margin expansion holds for next year is going to be watched, and whether revenue is going to accelerate. I'm going to quickly leave you with some brokerage opinions. So CLSA says they remain cautious on the Indian IT sector. The lack of large deal ramp up and rich valuations keeps them cautious. Nomura is constructive in the sector because they're talking about revenue accelerating, revenue earnings bottoming out. Kotak says there will be an improvement, but well short of the normal. And HSBC is saying that we are heading towards a prolonged period of consolidation and range-bound returns for the sector. This is similar to 2014 and 2018 when the IT index offered mid-single-digit kind of returns. So we are in a painfully slow recovery in progress. So Aman, where do you stand on IT? I think in the last conversation you said that you're neutral on IT. Earnings may have bottomed out after 2 years of downgrades, but are we looking at earnings upgrades from here on?
Not in the current quarter, though we stay neutral. We haven't added much to the IT exposure that we have. Our current IT exposure would be in, say, single digit, mid to high single digit, and we're staying there. And I think it's too early for companies as well as investors to look at margin recovery in 26, because none of the companies is going to talk or guide about next year in the current earnings season. So it's mainly 3Q and 4Q is when people will, or the company will start talking about the next year, where I feel that there can be a margin recovery for a simple reason that the attrition has come off, and hence the cost pressure from the wage cycle is lower than what it used to be, say, 2 years back or 3 years back. For that reason, I believe there can be margin uptick, but that's going to be a small uptick. It's not going to be like 25 to 50 to 75 bips kind of a margin improvement, nothing substantial, but that's going to be a positive signal which the market is looking for, but mainly in the 3Q and 4Q, not in the current earnings season.
Aman, sticking to IT, I know you all have Oracle in your fund. Maybe you can't talk about individual names, but within the IT, your preference would be more towards mid-cap IT names, and there you expect the growth to be much higher?
Definitely. Mid-cap growth is higher, but not much higher. If large cap is going at 4-5%, mid-cap is going at 6-8%. And in most of the cases in mid-cap also, the valuation is reflecting that. So today we have a Persistent or a Coforge or the Infosys. It trades at multiple which are higher than what Infosys multiple is, and it is a reflection of the growth rate of these companies. So we need to balance it out. At one point of time, you might also feel that while the large cap, the growth rate is not that great, but the valuation is factoring in that. Currently it is not, but at a later date that could be the scenario. So it's not always that always we prefer a mid cap, but at the current juncture, yes, mid cap makes more sense than large cap just because the growth rates are much better there, right?
You know, we have the RBI monetary policy also ahead of us, Aman, and that I think becomes interesting because we've got a big signal from the Fed with a large deep cut. Do you think for equity markets, maybe they'll watch this one a little more closely than usual, and would it matter?
It will matter on the fringe, but not much, because anyway the rate cut expectation in India is not very high, because we never saw that cycle which US saw where the rate from 0 went to 4+. So from that perspective, yeah, we are looking for marginal rate cuts in India to come in, and that's not going, maybe 1-2 days of sentimental impact on the market, but nothing major as far as the equity markets are concerned.
Okay, thank you very much, Aman, for joining in. Next week is going to be crucial with the RBI policy and the start of the earnings season. It's been a tough week, everyone. Rest, rejuvenate, and prep for the coming week. Keep it with CNBC TV18. We're going to wrap on Editor's Roundtable. Thank you for watching.
CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros, and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour, live on YouTube at CNBC-TV18, weeknights at 7 p.m.
There are three issues going on simultaneously. One is China, some model on which they are doing this futures arbitrage and all these millennium kind of guys. And the third is that separately, I think it is going on in parallel that if you have more than 25,000 crores in India, you need 100% disclosure of your end investors. And many of these platform guys will have more than $3 billion and they have to basically reduce their weight in India. So who knows what is the exact reason? But I think the best answer for that would be to call some broker and ask him that is it hedge funds who are selling? So I think the market continues to be strong because my big picture thesis is that India itself was doing okay. If the rest of the world is also doing okay, then there is no reason for us to feel too negative. The only issue could be this geopolitics, but as of now, even the oil prices are not that high, which show that there is an imminent attack happening, although President Biden said some few things which confused the oil guys for some reason. But coming back to us, so we, first of all, have been more or less fully invested, so we don't have much. But the general big picture thumb rule would be any stock that you own which is down 5, 7, 8% without any reason, you buy 0.5% more of that.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The Sensex and the Nifty news nearly 5% this week. That's the biggest fall in over 2 years. All sectoral indices closed in the red. Nearly 18 lakh crore rupees of investor wealth wiped out in the last 5 days. Foreign investors continue to relentlessly sell Indian shares. They sell 15,000 crore rupees worth of stock yesterday on a net basis. That's the highest in 4 years. Market watchers say a slew of stimulus measures are resulting in tactical money flowing into China. However, many believe it's too early to call time on India's bull market. Powerful blasts rock Beirut as Israel targets the Hezbollah headquarters and its new leader in a fresh escalation. More than 1,900 people have been killed in Lebanon so far. Crude oil prices edge higher with Brent nearing the $80 mark. The RBI Monetary Policy Committee with 3 new members will meet next week to decide on key policy rates. The CNBC-TV18 Citizen Monetary Policy Committee expects a status quo, but a majority expect a change in stance to facilitate rate cuts in the near future. The government is committed to reducing the fiscal deficit to 4.9% this financial year, says Finance Minister Nirmala Sitharaman promises to nearly double the per capita income within 5 years. All 90 assembly seats in Haryana go to the polls tomorrow. The BJP aims for a hat-trick while the Congress looks to end the decade-long power drought. Aam Aadmi Party, Dushyant Chautala and Abhay Chautala are hoping to play kingmakers. Results will be announced on the 8th of October. U.S. port workers agree to end their strike after companies sweetened the offer on wages. President Biden hails the agreement, saying collective bargaining works. Well, let's start with the market action for the day. And there was simply no respite for the bulls on Dalal Street today. And the sell-off that we saw yesterday continued, with the Sensex and the Nifty losing nearly 1% today and 5% this week. The marks the biggest weekly decline in over 2 years. That's the Sensex down 800 points, 235-point cut on the Nifty. The mid-cap index losing 550, and the Nifty Bank down by about 383 points. Now, all sectoral indices closing in the red today, barring the Nifty Metal Index. The Nifty managing to cling on to the 25,000 mark, though. And Prashant is here to wrap up the market action for us. It's been a tough week, Prashant.
A large down day once again. If you thought that yesterday was bad, well, today was not worse, but it didn't give you any relief whatsoever. The market ended down about 200 points lower on the Nifty, which means for the week, I mean, the market, by the way, is down a little over 4%. I think it's the worst week we've had since the beginning of the year. The Nifty Bank had it much better. It was down just about 0.5, 0.6 odd percent. Of course, that lost a lot more in terms of trade yesterday. Mid-cap index for the week was down 3%. For the day, we were down about 0.8 odd percent or so. I'll start with the large cap. Actually, sectorally speaking, there were only two areas which ended higher: PSU banks and the IT services space. And IT stocks, of course, will be first off the block in terms of reporting earnings. I'll start with what was down in terms of Nifty names. Mahindra and Mahindra was down 3.5%. Nestle was down 3%. Bajaj Finance was down 3%. MotoCorp was down 2.5%. BPCL, Asian Paints, Britannia, Ultratech Cements. These are all 2% plus cuts that we had in terms of trade. On the upside, as I said, tech was higher. Infosys, HDFC Life and ONGC were the three 1% plus gainers that we had by the end of it. Lots of losers, 2:1 clean declines to advances ratio, more down than up. What was down biggest with volumes? Adani Energy, that is Adani Energy Solutions, number one volume-led loser. Reliance Power was down 5%. Godrej Properties, Mahindra and Mahindra Finance, business update stock smashed 7%. Reliance Infra had a one-way rally, 8% lower. You had KRN Energy Heat Exchangers, which is the recent listing, down 6%. Chambal Fertilizer, Amber Enterprises, K Fintech Solutions, PC Jewelers, and a few others as well. On the upside, you had names like Oil India. I mean, big move in oil prices last 2 days. VIP Industries was a gainer, 8%, big move. And there were names like Home First, which ended up about 5.5% as well. Tough week, the toughest we've had since the beginning of the year, as I said, and markets still waiting on the edge for what comes out of Middle East. Will we see developments over the weekend? I think that's the big question. Back to you.
Well, a tough week indeed, Prashant. Many thanks for joining us. And as Prashant was pointing out, foreign institutional investors are hot on China, at least for the moment. Market watchers say that a slew of stimulus measures announced by China's central bank last month are resulting in a tactical money flow into the country. However, many believe that it is too early to call time on India's bull market. Hormuz is standing by now. Hormuz FII is taking to China again, but India very much in the game.
These last few days, the fall that we have witnessed in the Indian markets, one of the biggest factors has been the relentless selling from the FIIs in the cash markets. Yesterday was one such incident, almost $2 billion worth of selling. There have been many analysts who have come up and said that money is moving out of India into the Chinese markets, and the graphic that comes up on your screen now will be proof of that. Before going into the holiday season, the Chinese markets, the CSI 300 index, between the 18th to the 30th of September, that 9 trading sessions that they had, the index was up 27% from almost at a 52-week low, jumping to a 52-week high during this period. In contrast, over the last 4 sessions, ever since the Nifty made a record high last Thursday, since then the index is already down 4% from those levels, 1,000 points down on the Nifty, and the fall in the broader markets has been much worse. So there has been an outflow of money into the Chinese markets. But is this the start of a bull run in China and not so much in the Indian markets? Well, not many on the street are convinced about this rally in the Chinese markets, and Rajiv Jain of GQG is one of them. And he mentions very clearly that how many times in the last 3 years we have seen this excitement only for it to peter out in the months ahead. And he also mentions that if this party in the Chinese markets goes on without them, they are fine with it, and that's because Rajiv Jain in his funds have been underweight on the Chinese markets. And he said that this is a trade, a good trade at that, but is it investable for a 3, 4, 5-year period? That is questionable. Citi came out with a note and they mentioned that the CSI 300, as I just highlighted, was up almost 30% during this session. Multiple policy announcements that were supportive of this rally in China, but this recent outperformance has made sure that the Chinese markets have caught up with India in terms of performance. And but in the Indian markets, the strong macro outlook and the flows from domestic investors will ensure that the markets remain resilient going forward as well. And Gavekal Research also came out with a view. They said that even if this China rally sustains, many foreign investors are reluctant and they remain reluctant to invest there, and the headwinds in China will become tailwinds for the Indian markets going forward. And although they put in a caveat saying that while these foreign investors may find better value in terms of a lot of other emerging markets compared to India, but it is too early to call time on India's bull market.
It's a bad thing if China market does well for us, as in mostly for India. It is not bad for India per se. I don't think that beyond some shorter term thing, investors have to sell India to buy China, because India, I don't think in aggregate people are overweight. There might be 1% plus minus overweight. So if you were underweight China, that would have come from the rest of the world. India and China, even an emerging market fund combined, would be say 20 and 25, 26 now. So half the investment of people who are able to move this around is in non-India, non-China.
Well, the jury's still out on the bounce back in the Chinese markets, and of course, not too much by way of pessimism about India at this point in time. Global story. Powerful blasts continue to rock Lebanon's capital, Beirut, as Israel targeted the Hezbollah headquarters and its potential new leader. And these strikes come amidst Iran's foreign minister's visit to Beirut. The Lebanese health ministry said around 37 people were killed, 151 wounded in the past 24 hours. Israel claims 2 rockets were launched from the Lebanon towards Haifa, an important port city in Israel. Both these rockets were intercepted. Hezbollah said its fighters bombed a military base in northern Israel. However, no deaths were reported. The Israeli armies also ordered residents of 20 towns in southern Lebanon to evacuate immediately, hinting at a potential escalation of ground operations. But evacuations are proving to be difficult after Israel bombed the key route. Meanwhile, Iran's supreme leader Ayatollah Khamenei delivered his first sermon in 5 years. He claims Israel will not last long and that Iran's attack on Tel Aviv was minimum punishment for Israel's crimes. Staying with West Asia, at least 18 people killed as Israel struck a refugee camp in the West Bank. Israeli military claims to have killed a local Hamas leader during the strike. The UN Agency for Refugees confirmed that at least 21 Palestinians have been killed in 3 school shelters in Gaza over the last 2 days. Over 41,000 Palestinians have been killed and over 96,000 have been injured since the war began nearly a year ago. The 7th of October will mark 1 year of the Hamas attack on Israel and the war in Gaza. From one war-torn region to another, at least 3 people, including 6-year-old girl, were killed after Russian drones hit a truck delivering gas cylinders to homes in Ukraine. A Russian glide bomb struck a 5-story apartment block in northeastern Kharkiv, injuring 12 people. Meanwhile, Russia's defense ministry said it intercepted 113 Ukrainian drones over 4 Russian regions on the border with Ukraine. Crude oil prices continue to inch higher amidst the tensions in West Asia. Brent crude has gone up from $70 at the start of October to more than $77 in just 4 days. However, brokerages expect the gains to remain limited as there continues to be weak demand that will perhaps weigh on prices in the near term. Striking dock workers in the U.S. have agreed to return to work after employers offered a 62% increase in wages over 6 years. This as per Reuters report. The tentative deal raises average wages to about $63 an hour from $39 an hour over the life of the contract. Now, the RBI Monetary Policy Committee, with 3 new members, will meet next week to decide on key policy rates. The CNBC-TV18 Citizens Monetary Policy Committee expects a status quo on rates, but a majority expect a change in stance to neutral, which should facilitate rate cuts in the near future. Take a look.
What will the Reserve Bank and the MPC do to rates? Let me start with you, Sajid.
Hold rates till pause.
Hold. Okay, hold. Shaumya?
It's
hold. Okay, Sonal?
They should cut 25 basis point.
Here's the first cut. Samiran?
no change.
3:1, sir, in favor of hold. Dr. Chairman?
Hold.
Hold. Okay, so it's 4:1 in favor of holding the policy. Change of stance. Will the MPC change its stance from the current withdrawal of accommodation? Sajid?
Change to neutral.
Oh, okay. Sonal?
Change to neutral.
Obviously, you voted for a cut. Samiran?
Hold on to the stance, but it's going to be a close call.
Okay. Shaumyo?
You'll hold on to the stance.
Okay. 2 holds, 2 change to neutral. Dr. Sen?
Change to neutral.
Change to neutral. I think your members are veering to your point of view. Now, the final question, when do you see the first rate cut? Sajid?
We're looking at December.
Okay. Sonal, I think yours is October, right?
Yes.
October. You already said that. Samiran, your first rate cut?
February or April.
Okay. Shaumyo?
February.
Dr. Sen?
Yeah, I would go with February or April.
Okay. So there you are, the majority expecting the first rate cut only next calendar, but there are at least 2 people dissenting and 1 expecting a cut right away. Makes it a very interesting policy.
Well, we will find out here when the MPC meets and delivers its verdict, and you can catch the action live on CNBC-TV18. Now, the Cabinet has approved a proposal to streamline all centrally sponsored schemes under the Ministry of Agriculture and Farmers into 2 comprehensive umbrella schemes. A budget of 1 lakh crore rupees has been allocated to both initiatives, which aim to improve farmer income. The government has also approved the phase 2 of the Chennai Metro with a project cost of 63,000 crore rupees. The government has also decided to add 5 Indian languages to the classical languages category. These include Polba and Maharashtra's language Marathi, along with Pali, Prakrit, Assamese and Bengali. Finance Minister Nirmala Sitharaman has said that the government is committed to reducing the fiscal deficit and has estimated to bring it down to 4.9% in FY25. Speaking at the Kautilya Economic Conclave, the Finance Minister promised to nearly double the per capita income within 5 years. She also said the government has a sustained policy focusing on India's banking sector.
Our government continues to uphold its commitment to reducing the fiscal deficit. Aided by buoyant revenue generation, restrained revenue expenditure growth and healthy economic activity, the fiscal deficit is estimated to decline further from 5.6% of GDP in FY24, I'm basing on provisional actuals, to 4.9% in FY25. The decline in commodity prices has facilitated the lowering of the budget allocation for subsidies on fertilizer and fuel. India seeks to double its per capita income in a matter of few years for its 1.4 billion population, which makes up about 18% of the global total. In a fragmented and fractured world, where several persistent conflicts may worsen, posing a threat to global peace, that is the bedrock for prosperity. To reach a per capita income of $2,730 as per IMF projections, it will take only 5 years to add another $2,000.
Well, that's the Finance Minister. Now, shares of HDFC Bank rose in early trade after the private lender released its shareholding pattern for the September quarter. The bank has indicated that its FII headroom remains safely above 20%. According to Nuvama Research, the bank is expected to attract $1.8 billion next month as MSCI is likely to increase its weightage in its index. SpiceJet has said that it has deposited all pension fund dues for 10 months. This comes after the airline cleared all pending salaries and GST dues after raising 3,000 crore rupees last month. SpiceJet says it's on track with its financial and operational plan outlined in its QIP strategy. IPO-bound Swiggy has received shareholder approval to increase the size of its primary issue. As per a money control report, the food aggregator platform will raise the size from 3,750 crore rupees to 5,000 crore rupees. The report says that Swiggy has created a provision for a larger IPO size in case the company requires additional funds. However, the offer for sale component will remain unchanged at over 6,000 crore rupees. In a bid to expand its India footprint, iPhone maker Apple is planning to add 4 more retail stores in Bengaluru, Pune, Delhi, NCR and Mumbai. According to reports, the stores are expected to open next year. The retail expansion comes on the back of strong sales in its Delhi and Mumbai flagship stores. Apple has also confirmed that it has started making the entire iPhone 16 lineup in India. We'll head into a break, but when we return, DMart reports weaker than expected sales growth in Q1 is quick commerce hurting brick and mortar players. That and more when we return.
What we've seen so far is a commendable delivery on the monetary policy side. We've seen some direct stimulus at getting the equity market animal spirits back alive, and certainly the retail investor has followed through on that. What will differentiate this one is if in the next weeks and months we get some clarity from the Chinese government, from the key policymakers in the Politburo, as to the magnitude and the scale and the deployment of a large fiscal package. Because let's remember, I mean, China's single biggest problem that it faces at the moment is immense oversupply on the real estate side. And you need a sizable fiscal package aimed squarely at local governments to be able to digest that. In other words, buy it off developers and turn it into social housing projects.
Actually, I don't think it's a bad thing if China market does well for us, as in mostly for India. It is not bad for India per se. I don't think that beyond some shorter term thing, investors have to sell India to buy China, because India, I don't think in aggregate people are overweight. There might be 1% plus minus overweight. So if you were underweight China, that would have come from the rest of the world. India and China, even an emerging market fund combined would be, say, 20 and 25, 26 now. So half the investment of people who are able to move this around is in non-India, non-China.
And I did not underestimate Senator Vance as a slick talker. He could. But I also called out there, you can't rewrite history. You can't rewrite history. And trying to mislead us about Donald Trump's record, that's gaslighting. That's gaslighting.
Haryana is all set to go to the polls tomorrow. More than 1,000 candidates are in the race for 90 assembly seats. Results will be declared on the 8th of October. The polls will see a direct contest between the BJP and the Congress, while other parties could play kingmaker in case of a hung assembly. The BJP, which replaced Manohar Lal Khattar with Nayab Saini as the chief minister in March this year, is eyeing a hat-trick. The Congress is looking to end its decade-long power drought in the state. The party won 5 out of the 10 Haryana seats in the Lok Sabha elections. Dushyant Chautala's JJP, which walked out of its alliance with the BJP in March this year, has formed an alliance with Chandrasekhar Azad, Bravan's Azad Samaj Party. Abhay Chautala, who heads the INLD, has tied up with the Bahujan Samaj Party. The Aam Aadmi is contesting solo. The Supreme Court has ordered an independent investigation to the alleged adulteration of laddus at the Tirupati temple. The independent special investigative team, headed by the CBI director, will replace the SIT formed by the Andhra Pradesh government. The apex court maintained that an independent investigation was needed to assuage the hurt sentiments of crores of devotees. Ashmit standing by now with more details. So Ashmit, essentially the Supreme Court not leaving it to the state SIT.
Indeed, and that's after the apex court had raised question marks over how independent this SIT will be, the one appointed by the Andhra Pradesh government, in light of the comments that have been made by Chandrababu Naidu. The Supreme Court was not impressed with that, saying that there is no evidence to suggest that the contamination being spoken of, that the contamination being alleged of the prasadam, of the ghee in question, was in fact animal fat. There is no evidence to that end. There is also no evidence to pointing towards the fact whether that contaminated ghee had been used for the prasadam. And in the absence of that, the apex court expressed frustration as to why constitutional position holders like the Chief Minister would make remarks asserting that there was indeed contamination and that is something that should not have been done. The apex court also said that it will not allow the use of the Supreme Court, of the judiciary, as a platform for politics, and with that to assuage the sentiments, quote unquote, assuage the sentiments of crores and crores of devotees. The Supreme Court said that the best course forward is to not go ahead with the SIT appointed by the Andhra Pradesh government, rather substitute it with one that has been appointed now by the apex court. It's a 5-member committee. There will be 2 members from the CBI, 2 members from the Andhra Pradesh administration, and importantly 1 member from the FSSAI as well. The apex court has very clearly pointed out that this 5-member SIT will work under the supervision of the CBI director. They will file their reports and their findings to the apex court. So the apex court trusting the hands of this court-appointed SIT rather than the Andhra Pradesh government-appointed SIT.
All right, Ashmit, appreciate you joining us. Now, supermarkets, kirana stores are feeling the heat as more people get hooked to quick commerce apps, especially for grocery needs. Take the case of D-Mart, one of India's biggest supermarkets. Its revenue growth per store has been declining over the last few quarters. Experts, however, say that kirana stores would be the worst hit by quick commerce. Shilpa is standing by now to take us through the details. Shilpa, quick commerce moving up the queue when it comes to Indian shoppers' grocery needs. What does this mean for modern trade?
Well, you know, first we spoke about the impact on e-commerce, then we spoke about kiranas, and now modern trade is also feeling the heat. And the best way to sort of demonstrate is to look at D-Mart's recent numbers in its Q2 update. Now, the sales per store grew just 1% year on year, right? And then even if you look at the revenue growth per store, it came in at about 2.2%, which is much slower than the past 2 quarters where it was about 5.5%. Now, the D-Mart CEO had also said, you know, in certain reports earlier that 1 to 2% is the possible impact that they could see from quick commerce in Mumbai, and they don't have any quick commerce plans, but instead they'll focus on opening stores where these apps have a high demand. Now, this sort of demonstrates that modern trade also is seeing the pinch, because when it comes to quick commerce apps, which was earlier just for your, you know, last minute top-up purchases, there is a shift in the consumer demand where consumers are now going there for their monthly needs also. Now, a recent Nielsen IQ report said that 20% of offline shoppers are now buying all their grocery needs online, where their entire grocery needs, right, like the main things that you normally go once a week or once a month to the supermarket, those are now being shopped online by nearly 31% of the shoppers, and 39% of them are using it for top-up purchases only. So there is a large number that is now shopping on quick commerce that would have otherwise gone to a store to buy, and 60% of shoppers are buying their monthly essential staples online. And 32% are still, however, visiting modern trade, because modern trade supermarkets still have a value proposition of having better store experience, etc. But the harder hit, however, is going to be Kirana stores, and that is where we are going to see more consumer demand, shift in demand coming from. Modern trade, yes, is getting impacted, but the impact is not going to be that large. Back to you.
All right, Shilpa, appreciate you joining us. With that, it is time for us to wrap up this edition of Business 360. More news and updates will continue right here on CNBC TV18. Stay tuned. We're back in a minute with more.
The moment that really stuck out is I just asked the simplest of all questions that every single American should be able to answer. I asked him if Donald Trump lost the 2020 election. He refused to answer.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajaj at these times on CNBC TV18 and CNBC-TV18.com. CNBC TV18, an unending pursuit for excellence. A pioneer, a leader, a visionary, building a lasting legacy of credibility, consistency, and trust, giving unparalleled acting.
Let's welcome in Samir Arora. He's joining us. He's a market master today, founder and fund manager at Helios Capital. Samir, it's good to see you. Thank you very much for being on the program. So I have two questions, and you are someone who's invested and watched not just India, but regional markets very closely as well, China as well. So let me start with that. Is this time different? That old question. It rarely is, but let me frame it that way for China. And second, I mean, is this a real thing? And second, flows. We saw some very large selling figures in India over the last 2 days, foreign selling. Is that on account of China as well? Go on.
So second part, not so clear, but first part is it can go on, I think. By the way, in our fund, we used to own Alibaba and C-Trip, and we bought more Alibaba even yesterday because I think it can go on for some time. And actually, I don't think it's a bad thing if China market does well for us, as in mostly for India funds. But before that, so the China thing, first of all, the government has to take a call now whether they are going to make sure that they are able to revive confidence, revive this thing, or they make it as a given. They have the money, they have a lot of advancement in technology. They have to basically revive sentiment of the consumer. There was maybe some pressure even for people who are rich to not openly spend because of this shared prosperity and things like that. So if they let it go, like for India, for many years, we were able to say that although there is a big divide between the rich and poor, but at least the rich are doing premium and the care recovery and all that. So you don't believe that there are many super rich people and middle class and upper middle class, which all they need is the market. A market means the government and whatever to let them be as they are rather than always show that they are, part of a shared system. So it can go on, I think. And maybe some pockets do it only, but it can go on because their market was really cheap. It was just that it needed a trigger. But I think it is not bad for India per se. I don't think that beyond some shorter term thing, investors have to sell India to buy China. Because India, I don't think in aggregate, people are overweight. There might be 1% plus minus overweight. So if you were underweight China, that would have come from the rest of the world. India and China, even an emerging market fund combined would be, say, 20 and 25, 26 now. So half the investment of people who are able to move this around is in non-India, non-China. The other thing is if the Chinese market does well, and if the US market does well, the Indian fund managers, the mutual fund guys, they will have less reason to sit on cash. Our premium to emerging markets, our premium to China has shrunk because the Chinese market is up some 25, 27%. So we are some 5-6% cheaper than we were. Just to finish one more line. So meaning the market used to say that Indian market trades historically at some 40-50% premium to emerging markets. And in recent periods, it has become 165-170%. So that does not mean it was 20% overvalued. That means it was 170 divided by 150. Correct? Because 150 is so it was 10-12%. Let us say, if that was one issue, that it was 10-12% more than the longer term average. Now that it would be, according to me, 5-6% more than longer term average, just with China moving up 25%, because that would have shifted the valuation by 5-6% at an index level for emerging markets. So I think you don't want China to blow up and feel happy on that. If they're doing well, it's okay. We may underperform, but we will not be in absolute negative.
But Samir, listening into you, but the thing is, when $3 billion leave the market in 3 days, it does catch people by surprise, right? I mean, we were sitting on a high horse saying we don't need the foreigners and that's fine. We have local money. But exactly, I mean, we've forgotten what FII selling really feels like, and we got a nasty reminder since the start of October. How long can that continue?
But that's what I'm saying. I don't know whether it's related to China only, because there are three issues going on simultaneously. One is China, let's say, one issue. Second is that if people had some model on which they are doing this futures arbitrage and all these millennium kind of guys. And the third is that separately, I think it is going on in parallel that if you have more than 25,000 crores in India, you need 100% disclosure of your end investors. And many of these platform guys will have more than $3 billion and they have to basically reduce their weight in India. So who knows what is the exact reason? But I think the best answer for that would be to call some broker and ask him that, is it hedge funds who are selling? Is it long? Because my big picture thing, without overly knowing this, is that nobody does it like that. No regular long-term or even medium-term investor sells a market which is, at least in the last 3 weeks, zero, to buy a market which is up by the time he ends up buying it 30% higher. And mostly the stocks that he will like to buy are 40% higher. Mostly you do it a little bit more gradually. This kind of thing normally is a burst in the beginning, and that can be easily countered after some time.
Samir, at least in the last couple of years, we haven't seen a fall greater than 5%. So now investors are saying that is this the time to buy stocks or buy any themes that they like? So, if you have to find opportunity now in this little bit of a correction, what would you recommend?
So first thing is that 5% correction can happen without a reason. If this 5% correction has happened for reasons like Israel attack or Iran sending missiles to Israel, or it is because of Hamas and whatever, and it is because of China having done this, then it's a pretty decent market that with only 4-5% fall, it has absorbed all this. So I think the market continues to be strong, because my big picture thesis is that India itself was doing okay. If the rest of the world is also doing okay, then there is no reason for us to feel too negative. The only issue could be this geopolitics, but as of now, even the oil prices are not that high, which show that there is an imminent attack happening, although President Biden said some few things which confused the oil guys for some reason. But coming back to us, so we, first of all, have been more or less fully invested, so we don't have much. But the general big picture thumb rule would be, any stock that you own which is down 5, 7, 8% without any reason, you buy 0.5% more of that. For us, these stocks remain primarily right now in the financial sector, because the IT sector, we have just bought, now we have some 13, 14% in IT, but we need to wait for their results and guidance and language and how they say, because we have all taken it for granted that the worst is over and that there'll be some improvement from here. But let us again hear it from them. And in consumer, I genuinely think that there is a slowdown and that there is too much competition, and we come up with a new excuse every month. Sometimes it is big rain, then big summer, then politics, then cold, because now they are saying it's very cold. So then they suddenly say, oh, let's buy some cream guy because somebody's skin became dry, so they want to buy those shares. So I don't like that. I like very, sort of somewhat reasonable prediction of growth, or sometimes very high growth, like these food delivery companies and all that.
Thought leaders and powering conversations that are shaping the new world order. Setting the highest standards through exemplary leadership. It is this unrivaled reputation for the most comprehensive coverage, action